Okay, welcome everyone to another Sunday session. This one a bit special, I guess. We have our quarterly macro outlook session today. I think this is the one after July 30th and the one on April 30th. And before that, we were doing them almost monthly and now moved them quarterly. Just with the way things have gone, the cycle has continued. So welcome if you're here for an update, and welcome if you're here and new as well. Kind of a really good time for a macro outlook. Lots going on. We have the federal funds rate meeting, I believe this week, and also the US midterm elections are coming up. We've had the Russian winter hitting. We have the Chinese Congress finished. And just an overall great time as we go into winter and see what happens here. The SPR releases are ending. Some of the countries around the world with their last COVID hurrah are ending their defense, and we're going into 2023. It's also earnings season, so we've had some companies report and pretty decent earnings, to be honest. I think people were maybe a bit scared given WTI did drop from 100 plus to 92 in Q3, and a little worry as to what's going to happen. But I think things are panning out pretty good based on the earnings seen so far. So a couple things up front. This macro outlook is a very extended session. If you are looking for something a bit tighter, the Real Vision interview that I did last week is on the website as well, the full interview. If you scroll to the bottom on the homepage under files and seminars, I believe, that will be like a 10 to 15 minute macro outlook. There's also the interview with ROI channel with Ben there. That's about an hour and a half macro outlook. This will be significantly longer. This is built for somebody who really wants to know everything from supply, demand, inventory in every part of the world, the impact of renewables, the impact of EVs, where the general broad markets are, and a very in-depth look at shale, because I think that part of the reason the investment community is so apathetic towards what's happening is that they believe shale will come in and just keep growing production by 1 million barrels per year. So instead of looking at broad-based data as to this is what shale is, we'll look at that, and then we'll look at company-specific data and say, okay, why are these companies no longer going to produce or grow at the rates that even maybe they're projecting today? We saw that with Exxon and Chevron, both saying that they misunderstood their own production. Pretty strange comment to make, but I think they're sort of falling into the same problem where they overestimated the impact of, or underestimated the impact of these DUCs and the rig productivity increases and the impact of XYZ, which I'll discuss. So a few things up front. I'm not an investment advisor, so everything I share today is my opinion. Every slide is a data slide. There is no text pretty much at all in this entire presentation. So I'll be discussing the slides and then my own insight / interpretation on them. But please do your own due diligence. When you're looking at investments, please check your own risk tolerance as well. The oil and gas industry remains a very volatile, very dynamic industry. So definitely lots going on there. I also have a mailing list. So for anyone that would like to join the mailing list, all I do is send out these Zoom invitations. There's no newsletter or anything like that. But if you are interested in getting those and some of the files that go along with that, I can add you on there if you send me a DM or shoot me an email. There's a comment here that the Zoom is showing very blurry. Is that for everyone or just this certain individual? And then, okay, perfect. And then so this seminar is also recorded along with the Twitter space as well. They will be posted on the website and on YouTube. So feel free to have a look after the fact. This new laptop I got is a 4K recording, I believe. So it takes a while for YouTube to process it. So hopefully it's on by tonight. If not, kind of sometime over midnight, it'll be done and uploaded. And the previous sessions I've done are also recorded, again, on the website and on the YouTube. So feel free to have a look at those. We do macro outlooks, we do valuation sessions, we do junior deep dives, and then other supplementary material, data sources and options and whatnot. And with that, I think we will begin. Before I begin, once again, anyone on the Twitter space that would like to join for the Zoom visuals, whitetundra.ca, and scroll to the bottom under events, and the Zoom link is on the left side there. So you can join in and we'll get started. I am planning to have sort of a break every hour and a half to 2 hours. We'll see how it goes with the flow of the presentation, and just kind of keep people refreshed because we do have a lot of slides. This one was one that I've really got a lot of feedback off the July session with people saying, well, you didn't consider this and you didn't consider that. So here we are. And a lot of extra data got put in, a lot of extra slides got put in. That being said, if you have attended these before, some of the slides will be repetitive, possibly just an updated version, which is basically a new slide at that point. So yeah, we will begin. Basically, it can be broken down to very simple topics. We look at pricing, American pricing, Canadian pricing, and kind of European pricing, and then inventories, demand, and supply. The only three things that really matter in the oil industry: you have your supply, which is what's coming in, you have your demand, which is what's going out. Remember, oil is a completely, I'm not sure what the word is, but when you use oil, it's gone. You can't recycle oil. It's for the most part just gone into thin air. So when we say demand, it literally leaves. It's not like a metal. And then we have inventories, which are your savings account. And when we look at those three more in detail, we can figure out basically the entire oil supply demand scenario dynamic going forward. I'm probably going to keep the Q&A session short today, just given the presentation, but we'll cross that bridge when we get there. So let's look at pricing to begin with. We have our 5-year WTI chart. $88 is what it closed at on Friday. And, yes, we have fallen from the 115, 120 range in June, July. But that range was completely out of the norm. It was well above where we'd been for the last 5 years. In fact, for the last 8 years since the crash in 2014. So, since then, 88 is still, if you look at this chart, quite a bit above where we were anytime in the last 5 years. And I got a question, people saying, well, how come it fell from 125 to 76? Well, it was at those prices for a day or two. When we look at the monthly WTI Cushing price, it maybe fell $25, $30, which is still well above where we were in the last 5 years. We look at Henry Hub, natural gas pricing, sort of the same dynamic. In fact, even better here, because a lot of producers were used to this sub-$2, sub-$3 Henry Hub pricing, and we're now double that. So when a company can produce gas for $1, they're making $1 profit on that dollar by selling at $2. Now it's at $5. So even though the price has doubled, their profit has gone 3, 4, 5x. So still well above our 5-year range, looking really, really good here. We have fallen a lot from the $9 highs, but once again, keep in mind, we are in a shoulder season where the heating demand goes away and the cooling demand isn't really here yet. So we get these twice a year when the seasons change, spring and fall, and we're in this sort of zone here right now. And keep in mind, this is with the Freeport LNG down and some other maintenance happening in other LNG. So overall, not a bad place to be, $5.80 US. I think producers would have slapped you if you said that to them a few years ago. More into Canada, we look at Canadian condensate, which is our lighter oil proxy, condensate being used to dilute the heavy oil that goes into the States. So about $89 a barrel US, so just above what WTI is. And we like to see that because condensate, if it's trading below WTI, it almost tells you there's a supply-demand problem where there's a glut in certain part of the equation. But now that it's back above WTI, more information that the physical oil demand is looking really good. We look at WCS, the Canadian heavy oil, the differential has blown out, whether it's the SPR release, whether it's a sour barrels coming in from Russia and the Middle East that are affecting the price. It's still trading at $60 US, which is well above its 5-year high that it hit last year. And then, this was up to $100 a barrel in June, July, which was causing huge problems with the United States inflation and the pricing of products. So this cooling down a bit will help, but I think it's just temporary. And when we look at a 10-year WCS chart, we are in this $60 range. And, we were in this $60 to $80 range in 2010 to 2014. So we're right where we were back then. Again, the differentials do tend to blow out a bit when the WCS price goes up, just a matter of products and refiner margins. But when we look at $60 WCS today or $70 WCS today versus $70 WCS 10 years ago, that 70 WCS 10 years ago, US was 70 Canadian because the exchange rate was roughly 1-to-1. Today, that exchange rate is about 1.37. So this $60 to $70 WCS is now $80 to $95 Canadian, well above where we were in 2010 to 14. So an added exchange rate bonus for Canadian producers, which get paid in US dollars, but their costs are in this Canadian dollar, which is a weakened currency versus where it was in the last cycle. Gas pricing has cooled down a bit in Canada once again, but still well above where we were. This is the year ago line. This is the month ago line. So cooled down quite a bit. Some companies did hedge in this $7, $8, $10 range, doing pretty good. And $5 AECO, still really, really good for the winter and $3.50 for the summer. This used to trade in the negatives or below $1 all summer long. So to see this kind of pricing is very supportive. Now we look at European gas, January 2023, people are saying this thing has collapsed and Europe is fine. Not really. That's the front month contract, which is again, the price to buy it today or the next day contract. This, when we look a little bit further out, is still trading very, very strong. In fact, it's above where it was in February when the first initial Russian invasion happened and people were complaining that companies didn't hedge this in time. Well, we're still there today, and we ended up actually almost tripling from that point in the last couple of months. Winter 2023 TTF, same story, well above where it was in February and March when people figured this was just a short-term issue, not realizing the underlying dynamics of European gas before the Russian invasion even happened. So sitting very, very strong. We look at winter 2024, which is next year out, well, 2 years out at this point, and way, way, way above where you would expect this to trade, where it was trading even 12 months ago. It's almost 4x in the last 12 months, and it's steady, it's staying there. This contract is not as volatile, so it's more of an indication of how people are placing themselves as things go on. So that's your pricing where we are today. Now we look at inventories. So global onshore crude oil inventories. Inventories are the difference between supply and demand. So whatever undersupply or oversupply we're in will show up in inventories. And we look at 2021, this yellow line here, we drained inventories at roughly 1 million barrels per day, crude oil inventories. 2022 so far, we had the Omicron hit earlier this year. We had the Chinese lockdowns. So inventories were roughly flat for the first 6 to 7 months of the year. Since then, we're now back to draining at over 1 million barrels per day, 1.1, somewhere in there, when we look at global onshore crude oil inventories. When we look at crude oil and products, that trend basically doubles. So for 2021, we were draining at 2 million barrels per day. So crude oil at 1 million barrels per day, products at 1 million barrels per day. 2022, this trend has so far been roughly flat, where the drawdowns we see in crude have been taken up by extra products showing up. Once again, keep in mind, this is with Russian oil still on the market. This is with Chinese lockdowns, and this is with the global recessionary risks that are upon us, and the Fed's fund rate and the dollar index where it is. So roughly flat, but it is interesting that the crude is drawing, whereas products are building. But I'll talk here in the next few slides why it's not really as it seems on the surface, and why people are going to get caught off guard here if they only look at these sorts of charts. So we'll table that for the few slides here after this. So when we look at US Big Four storage, so we want to look at crude with SPR, gasoline, distillate, and jet fuel, the big four well-used products. It's drawing big time. It's drawing at that roughly 1 million barrels per day mark since the beginning of the year, sort of exactly even more of a slope than it was in 2021 under Big Four storage. This is the same graph put in a cumulative fashion. So this is yearly, this is the same cumulative, and you can sort of see why this is concerning. We have now fallen below this mark right here in 2008, and we're now at 2004 level inventories in total supply. This is total supply, including other products as well. The slope of the graph has been never seen before for this length of time, and it doesn't look to be easing up. It's not going to suddenly put a U-turn here. It looks like it's going to keep going down, possibly flatline, and then it can build, if it even builds. What is this? This is the same graph again, cumulative, more of a stretched out timeline. So, as long as we continue draining here for another 6 months, we'll be at all-time lows in total oil and products inventories in the US. So let's look at crude a little more closely. What's happening? People say it's not a concern. Commercial crude is building a little bit. Commercial crude is your crude in refinery stocks, in commercial stocks, in pipelines, in terminals, whatever's being used. The SPR is your strategic petroleum reserve. So it's to be used for emergencies, for hurricanes, for wars, these sorts of things. And we see commercial inventory so far has been building, and the SPR has been, the graph almost looks wrong, where how fast these things are projected to continue falling here if they keep releasing at this rate. Right now, it's about 400 million, somewhere in here. And you can see, despite this 200 million of SPR release, it hasn't built in commercial inventories, which it really should have. If you're pulling out of your emergency stocks, you want that to provide a buffer for your commercial stocks. It's done that, but in a band-aid sort of solution where as soon as the SPR stops, commercials will start drawing at that same rate. So once again, something that is going to catch people off guard because the SPR cannot continue forever. The rate has already slowed down. October is about 500,000 barrels per day. November is about 500,000. December is about 500,000. It was over 1 million in September and August, I believe, as well. So the rate has already slowed down, which will draw commercial inventories. And at some point, the SPR just cannot be drained anymore. Is that 350 million? Is that 300 million? It's coming very, very shortly in the near future. Same graph, SPR and crude. You see how the drawdown is so significant. This here blue line is your 2010 to 2014 average. So at a time when WTI oil averaged just about $100 a barrel US, this is how much inventory buffer was in the system. We are roughly 200 million barrels below that, about 20% below that. Not a good place to be going forward. You want extra stock when prices are high, not low inventory when prices are already high. The same chart in a yearly fashion. So you can see the consistency of the drawdown and the slowing down of this curve as they realize, well, we don't have this thing to continue unlimited. Same graph over a 20-year period. So once again, it's never drawn like this ever before. So when you say, well, it's had this impact or that impact, great. What we need to know is what happens after this stops and what happens when this is no longer available. This insurance policy has expired and it was a one-time, one-use thing. So as it drains, when you are driving without insurance, you have to drive more careful or you have to pay a lot more if something happens. That's exactly the situation that we are looking to be going into here. So the SPR is mostly about 30 to 33 API oil. So in the medium to lighter grade, but half of it is sour and half of it is sweet. Same graph of the SPR, but on a 40-year curve. So we are already at 1984 levels and likely to hit all-time lows in the next year at the rate they're going at and at the mandated sales that the government has already mandated till 2027. Now, the other problem, from 2010 to 14, we're about 200 million barrels below the crude inventories that we were. Okay, there's an additional calculation here, is that any oil in pipelines is counted as commercial storage, but it's not really commercial storage because if you empty the pipeline, you can't use it anymore, so everything just stops. There's a minimum level of commercial oil that the system needs in order to run. That includes pipelines, that includes your tank levels, because you cannot drain a tank all the way to zero. There's about 10, 15, 20%. You can't go below. And if that tank is being used for a while, you'll find the bottom 20% of the tank is completely unusable. It's all this heavy gunk that's fallen to the bottom over the years. So when somebody says we have 400 million of commercial inventories, why are you concerned? It's because it's not 400 million. There's about 120 million that's pipeline fill that cannot be used no matter what. So when we think about it this way, we end up at a place where, yeah, you have this much usable, or you have this much commercial inventory, but how much is actually usable? So to hammer that point across, there's been about 50 million of extra line fill in new pipelines that have been built over the last 8 to 10 years. So we're 200 million barrels below 2010 to 14. We're now 250 below because this crude is now unusable that went into pipelines. And we're likely up to 300 million below those levels because another 50 million is likely in the new storage tanks and the new oil facilities that are being built, with this oil now having to stay there for a minimum operating condition on these. And yeah, that's a great point here on the comments. So some of the oil tanks actually end up accumulating water along with the sludge at the bottom. So they keep counting that as oil because they don't care. For them, it doesn't matter. That bottom 20% is unusable anyway. But some of that could be water, sand, solids, wax, asphaltenes, other sorts of things that are not oil, but are being counted as oil. So there's a question here on the caverns where SPR is stored, may deform and collapse. So that was the narrative. I also agreed with this, but there's no evidence so far that this is happening. And it's Fluor, the EPC Fluor, who's managing the SPRs, a very, very strong engineering firm. So unless there's some evidence that comes of this, I think we cannot really take it into account right now. I do think if they refill the SPR and then draw down, that's where the problem will begin. Okay. Yeah, I'll talk about the other SPRs and yeah. Keep in mind that if somebody does go out and buy contracts in the future to refill stuff or to buy, that is an extremely illiquid market. So if you're buying hundreds of millions of barrels, you will pull the entire curve up to a point that people may not even fully appreciate. So just keep that in mind. So that's crude. Now let's look at products. Same old story in the US. We are about 50 million barrels below the 5-year average on our products. So gasoline, distillate, jet fuel, the big three. And once again, just because there's 350 million barrels doesn't mean it's all a safety net. More than half of it likely is sitting in gas, what do you call those? The commercial gas inventories that then feed the retail stations, which can't be accessed. It's sitting in pipelines. It's sitting in refinery tanks that they have to maintain a minimum level of products, et cetera, et cetera. So when you go 50 million below that, running on thin ice, we see this in the diesel margins, in the gasoline margins, with Biden complaining about gas price gouging every day. It's not gouging. It's the fact that there's literally no extra, just like spare gas sitting around. It's all being used in a day-to-day basis. Looking at gasoline specifically, once again, about 10 to 20 million below the 5-year average. When we look at gasoline consumed, this is gasoline consumed in million gallons per day in the US. So about 375 million gallons per day. And this chart almost shows you the pricing on it. So how much money was spent on gasoline per day? And we see it's converging to the 2021 number. It's not that far above even the 2018, 2019 numbers. So as this price gets closer and closer to a 0% year-over-year number, consumers psychologically will just get used to a higher pricing and end up spending more on gas without complaining as much or without it having as much of an impact going forward. This is a big, big factor which cannot be quantified. It's more of a subjective factor that people don't like inflation until they get used to inflation, and then it just becomes the norm. So keep that in mind for future demand going forward. US distillate, jet inventories, very, very low. We're at about 20% below the 5-year average. Again, big problems here. We already see this in the northeast of the US and in other parts of the world where diesel is just unable to be found because people are using it for their farm equipment. They're using it for their trucking. They're using it for even home heating and other road construction and whatnot activities. Jet fuel, very, very low, almost at the 5-year minimum that we've hit. Jet stocks, here's your US jet stocks in a more visual fashion, draining very, very fast. The American travel numbers are going up substantially. The domestic flights are about 10 to 15% above 2019 levels. And I'll share more of that data as here we go on. So basically the point I'm trying to make is there's no glut anywhere. It's the crude is down, the products are down, the SPRs are down. There's no extra oil sitting anywhere on land anyways. And I'll discuss more about the floating storage as we go. Propane inventories, we see propane production rising in the US, but demand is the same and they just keep exporting everything. So the entire world is hungry for propane, whether it's the emerging markets, whether it's China, whether it's Africa, South America. Everyone wants NGLs to use for their transportation and heating and other fuels purposes. So the world is hungry for this American propane. They wouldn't be shipping it out unless somebody wanted it. So there's a demand for everything. And again, all of this will be discussed as we go on. So propane exports with propane demand, the consumer demand is relatively flat. The petrochemicals demand is relatively flat. That being said, the American domestic petrochemicals demand is going to go up substantially this decade because they know there's a source of propane here we might as well use it and convert it into other chemicals and plastics. The propane exports, stable. The world wants these. Even when there's no arbitrage on it, they still keep pumping them out because the world just wants these in this quantity so bad. A build in propane in the last few months. So we saw this in the EIA weekly reports where propane and other oils started to build, whereas the big three were drawing, and we're once again flatlined. And looking forward to see how this trend goes, because a lot of shale oil has become very, very NGL, natural gas liquids heavy. So is this a growing trend going forward? We will find out here. But as long as the world keeps wanting propane, the US will keep producing it, the US will keep exporting it. We'll look at Canada more specifically. We are at about 25 million barrels in Western Canada, and this is the minimum level range that I was talking about. So there's 25 million barrels in storage, yes, but 18 of them are the minimum required to keep these oil terminals running. So really, only a quarter of that 25 million is actually excess stock, and we see that in the graph. As soon as we get to this 20 million level, it just stops draining because there is no oil to drain at that point. You're at the lowest of the low, where everything else is just spoken for. So again, very, very low here. When we look at this more in divided out, we have Hardisty, we have Edmonton, and we have Regina. Very low inventories, well below where we were at the beginning of 2020, almost half in Hardisty and Edmonton. So Canada, from an inventory standpoint, not a major player, but from a heavy oil standpoint and the heavy oil differentials, definitely one to watch. Before I continue on, I will just repeat for anyone that would like to join the Zoom session with the visuals, whitetundra.ca. If you scroll to the bottom under events, the Zoom link is on there and you can join for the visuals. If not, please continue listening on the Twitter space. So more on the inventory side, we want to look at ARA, which is Amsterdam, Rotterdam, Antwerp, a European inventory proxy, and we see gas oil well below the 5-year minimum. We see jet fuel roughly at 5-year averages. Gasoline is a bit higher, but once again, there's only about 12 million barrels of gasoline in this area. So it's more of a transient storage system, not a full-time storage system. So not huge volumes. And fuel oil, again, roughly in the middle of the 5-year average. Now we look at Saudi inventories. So Saudi Arabia has drained roughly 300 or 200 million barrels of their crude inventories in the last 7 years, 7 to 8 years. So if somebody's saying, well, the Middle East has all this storage, no, it's all gone. It was built from 2000 to 2014, and then it all has been exported, where we now seem to be back at this minimum level range where we flatlined. And once again, I make this point, just because there's 140 million barrels here doesn't mean it's usable. In fact, all of this could be unusable stock, which is being used in the day-to-day processes of just running a 10 million barrel per day system in Saudi Arabia. So one thing that's often misunderstood, that's often misquoted, that's a very misleading number, that there's this much in inventory, which is X days of demand or X days of imports. No, we need to take that number from the minimum operational inventory and up, not from a zero level, because you will never get to the zero level in any oil tank, in any oil battery, or any oil terminal, or pipeline for that matter, ever. We look at Fujairah, which is a big shipping port in the UAE. It's getting more and more important. And again, we're pretty much at the minimum level range, about 22 million barrels of distillates and heavy here. 15 looks to be roughly the minimum of where things can go to. No extra stock here either. We look at Singapore. We had some fuel oil building here in the last few months as Russian fuel oil needed a floating storage place to go. And they ended up finding Singapore because it's close to China, it's close to Russia, it's close to India. It's a nice little spot there where you can do ship-to-ship transfers, illegal sanction activity, etc. And it did start to build a bit. And then last week we had this massive draw as multiple ships left the Singapore area, including, I think, that the biggest ship, the ULCC, that can carry 3 million barrels of storage on board. So these ships have left, and we see a normalization of inventory about right here, 2 million tons of products. Chinese inventories. So the narrative and the pushback I get is, oh, China's got this bazillion barrels sitting there that they're just going to keep releasing. Well, no, where exactly is it? Because when we compare the inventory today, crude oil inventory, including SPR, is roughly at the same level it was in the summer of 2019, roughly the same level it was pre-COVID. So there is no excess, there is no glut here, unless somebody can show me data that proves so. Since the peak inventory during COVID, they have drained about 150 million barrels from that point. So when China stopped importing oil, they were already draining their inventories. There's no magic button that, oh, we're not going to import and we're going to use inventory and our inventories keep building. So that math doesn't add up. It's basically a one in, one out system. There's no other complications here. So about 1 billion barrels, 980 roughly in China right now, and pretty much at where we should be. In fact, China being a net importer by a huge margin of crude, with all this refining capacity and also a growing oil demand, should likely see their inventories increase over time because they need to be set to X days of consumption or X days of imports. And if they're importing more, if they're consuming more, you would think inventory should go up, not stay flat. And one thing to consider is, and I'll talk about this later as well, is that Chinese demand went up in 2020, it went up in 2021, and it's slightly down in 2022. So it's a foil of any other country whose oil demand dropped in 2020 and 2021, and then went back to 2019 levels in 2022. So there's definitely a different viewpoint we have to take on Chinese inventories and Chinese demand. This is the same graph over the last 13 months, but in a week-to-week fashion. So when Shanghai and Beijing locked down, we saw the builds, then they opened up, and we'll be seeing draws consistently despite the latest lockdowns and the Party Congress and the Golden Week, et cetera, et cetera. This is more of a historical comparison. So we see the huge build in 2020, yes. We see the drawdown in 2021, and then we see the flat line in 2022 with the build being when Shanghai and Beijing was locked down. Those barrels are gone. In the last 3 months, they've drained 75 million barrels, almost 1 million barrels a day from their oil inventories. So I appreciate the narrative that China will just continue draining inventories. They've already done that. There's no excess left for them to just continually drain and put themselves in a energy security problem. This is the Chinese SPR system, about 300 million barrels here, and most of them filled very, very recently. Small setups, about 30 million each, which are very different to the US caverns, which are multiple caverns, yes, but 4 sites that can do 700 million barrels. This is about 10 sites that do 300 million barrels. So if somebody's wanting to watch these, all you need is a satellite tracker that goes and reads floating roof tanks. I'll discuss this more in a few slides here. And you can tell exactly what's in the SPR. This is not rocket science where it's this opaque system like the US caverns where we can't read the levels unless you work for them. So definitely the point is China doesn't have the excess capacity to just overflood the oil market with oil. Yes, they have storage, but they need that storage for their own energy security, for their own military possibly, and just for their own safety and a minimum stock level for a growing economy. So let's look at products a bit more closer, because I'd mentioned earlier that crude was drawing, but products was slightly building, which meant on a global oil plus products, we ended up flat. So where is the bust in the system? Well, we see light distillates dropping. We see middle distillates dropping. We see heavy, slight build here. And then we see this other products that is going through the roof here. So what's happening? What's happening is that your gasolines, your distillates, and your jet fuels, the three actual products are flat to drawing. But this other NGLs and propanes and butanes, asphalts and road oils, this is the kind of stuff that's building, the stuff that's not really relevant to an economy and its fuel consumption, its products consumption. So people looking at this thing overall may say, oh, we don't really have a problem. Like, we seem to be in a balanced market. We're neither undersupplied nor oversupplied. But the problem is the products that we're not balanced. We're undersupplied in crude, gasoline, distillate, and jet fuel. And we're oversupplied in butanes, propanes, NGLs, road oils, fuel oils, and asphalts. And when you add those together, the market seems balanced. And this is where people are going to get completely caught off guard, because this other product section can just continue to build and have almost no impact on the oil market, given that it's just other products that are not used on a day-to-day large quantity basis. It is true you can blend butanes and propanes into the Asian gasoline pool. Yes, it is true that some of the fuel oils will likely be used instead of diesel. It can be used instead of bunker fuels. Yes, but on the whole, if we take these other products out, the market is about that million plus barrels per day undersupplied. And it's important to view the market in that sense, because these other products are just other products. It would be like you having beer in the fridge and then water in the fridge, and your beer stock is drawing, and then you have this glut of water building, and somebody says, oh, your fridge stock looks good. Well, yeah, it looks good, but it's not the right percentages and the right products and the right mix that you need in the properly functioning economy. Let's look more at floating storage. So this is global floating storage, down about 30 million barrels in the last year. And Chinese floating storage is down from 50 million barrels last year, this time, to about 13 to 15 million barrels. So not only does China not have any onshore excess to throw around, they've completely drained their floating storage, which was oil that they bought during COVID because it was cheap. They took up a bunch of ships and put oil on it and stored them somewhere offshore. That's almost all gone at this point. So there's a comment here. Refiners crack the heavy oil, but can you combine? Yeah, that I don't know the answer to that, Damien, but at some point, you can only blend so many NGLs into your gasoline pool. The entire thing can't be butanes and propanes. As far as I know, there has to be some octane content, you would think. So when we look at more of the floating storage of crude and condensate, we see an even more drastic drawdown. So yes, crude is down. Yes, Chinese crude is down even more. We see that in this Asia Pacific sort of bar, this blue bar here and then this blue bar here, very different. But also the fuel oil storage is now going down. The fuel oil and then the Iranian condensates is also drawing. So it's not just crude, it's these lighter blends of oils also that now continually are drawing from inventory. So there's no onshore inventory, there's no offshore inventory in floating storage. This is more floating storage worldwide broken down. So we have Iran with all this condensate drawing. It's down 12 million barrels in the last year. We see West Africa and North Sea drawing. And then you have Singapore, which is built, but a lot of it is fuel oil. So it's not even really usable crude. It only has one purpose, which is to get it out of Russia so that they don't clog up their tank storages in Russia. Yeah, good timing on that question there, Dennis. And then the other thing now we look at is oil on water, which is what is the total oil on the water that's being transported, not floating storage, but actively being moved somewhere. Oil in transit. Oil in transit plus floating storage equals crude oil on water. So we take floating storage out of this and we end up with oil in transit. And is it higher? Yes, definitely. It's definitely higher than it was in 2019, but by how much? 50 million barrels? Is it really that big a number that people are saying, wow, there's this huge glut of oil on the water? No, not really, no. It's about 50 million barrels compared to 2019. And keep in mind, if Russian transit times have changed, if Russian exports have changed, and the destinations have changed, this is a long-term permanent switch. So just because that extra oil is on the water, again, doesn't mean you can use it in your usable inventory number because it's being transported. And if that's the new shipping route that's going to be used for the next 10 years, that oil in transit is going to be higher going forward. That's just how the number goes. So unless there's an indication that these routes are changing and some of this oil could come back into the usable storage category, I think this is just how things are going forward. And we can't use this and say there's excess oil on the water. Yes, but it's unusable. Same thing here. We see what's really being built is this Russian oil. Yeah, the dark blue, I believe, is the heavy fuel oils, and it's being built and then come down. I should verify this. And then Iran's floating crude storage is also cut by 20 million barrels. So Iran had this massive fleet of tankers with condensates offshore Iran, and that's now being drawn, which tells you how far we are into trying to find every last barrel of extra oil that's just sitting around. A quick comment on natural gas. We see natural gas inventories had gone about 10%, 10 to 15% below the 5-year average. We have not caught up a bit, but that's with Freeport down, that's with other LNG maintenance issues, and that's with US production still going up slowly day by day by day. So still below 5-year average, about 8 to 10% below 5-year average, which then justifies a $5 to $6 Henry Hub pricing. Looking at just inventory, it's supporting the pricing. Look at Western Canadian gas storage. So production is at all-time highs by a huge margin in Western Canadian gas production, yet the inventories are just not seem to be able to build. So when you see this, supply is up and inventories are not building, that means demand has gone through the roof. And that is due to internal demand, US demand, British Columbia demand, and then internal Alberta consumption because of coal to gas switching on some of their power gen facilities. So where does it go? Why is the world not paying attention? What's happening? I don't have the latest version of this, but I will be getting that and posting that on my Twitter feed in the next few days. So the STEO is the short-term energy outlook that the EIA puts out. The EIA being the administration of the US that tracks supply demand. And This is what they told us in March of 2021. Oh, inventories are drawing, no problems. We can just flatline these for no reason. That's our forecast. Okay, that didn't happen. Inventories kept drawing. In September, they said, oh, not only are inventories suddenly going to flatline, they will actually start building for no reason whatsoever. It's just what we think. Okay, that didn't happen. February of 2022, same thing. March of 2022, same thing, and completely wrong once again. So they're just using some forecasting model that makes no sense, that has no explanations on it, and pumping that out to government bodies, pumping them out to companies, pumping them out to the traders, and just saying, oh, there's not a problem here. We are completely fine. And it's always 3 to 6 months down the road. It never materializes. This is the same chart with April of 2022 as well. Same problem. It's the same old issue. And the only reason commercial inventories have flatlined on this April release is because the SPR release started in its massive form around that time. And commercial inventory is ex SPR. So once again, no explanation. It's just the world just uses these models and says, oh, this is what's going to happen, without looking at supply demand in real detail. So what's the real oil demand looking like? Not STEO, what's the real oil demand? It's basically at its 2019 level in August. That is with China shut down. That is with a lot of the world still not back to international flight levels. And that's with tourism not 100% back. That's with the work from home people and everything else in the world. August oil demand was at 2019 levels, pretty much bang on. Where does it go from here? Likely a lot higher. We look at demand in the US, we are still below 2019 levels and rising here. There is some suspicion around this data, the way it overran and then underran here, but it seems to be coming closer to our 20+ million barrels per day average in the US. And we'll see how this continues as the travel season kicks on, as all this deferred demand possibly comes back, and as people go back to working from offices, not from homes. Again, every statement I'm making here, I will back it up with data as the presentation goes on. So not looking too bad in the US. We have rebounded well from this 2020 low. And one of the interesting things here to keep in mind is when COVID happened and the entire economy slowed down or stopped, America was still consuming 14.5 million barrels per day at its lowest and was at 18+ million in no time. So only about a 10% drop in oil demand when the entire world was shut down. Just think about that in terms of people who are saying oil demand will be zero because of this or because of that in 5 years. Not going to happen. Gasoline data in the US looks pretty strong. We have the seasonal slowdown after July, August, as kids go back to school and just the weather stops becoming so hot, and hanging in there, not too bad. Usually this would continue dropping as the year progresses, but we're looking pretty strong. Week of October 16th, in fact, going up right now as maybe some of the pricing pressures have eased off. And we look at vehicle miles driven. There's usually this slowdown in July, August, September, a little uptick in October, and then a slowdown November, December, and then it really picks up in March. So the slowdown will be one to watch this year. How much does this really drop off? Does it drop off by 200,000, 300,000, 400,000 barrels per day? Or does it flatline here with everything going on and people taking advantage of maybe cheaper hotels, cheaper flights, cheaper car rentals, as that pressure comes down a bit? This is our moving 12-month miles traveled back to 2019 levels in terms of miles traveled and hanging in there. And that's with the pricing being way well above where we were in early 2020. We were at about $2.75 per gallon. Right now we're at $3.75 plus dollars per gallon. So almost a 40% increase, and yet vehicle miles traveled are roughly flat. So where does that put us as people get used to these higher prices, as people are just okay with traveling and cutting on other things to spend on their gasoline and tourism and travel and food? When we look at ratio of products demand in the US to where it was pre-COVID, we see diesel has been above 100% basically ever since fall of 2020. Gasoline has been the one that's picked up more, more subject to pricing fluctuations, and then jet fuel is hanging in this 80% range. And the way to think about this is, if global oil demand is already at 2019 levels, yet there's certain parts of the oil consumption dynamic that are lagging, where does that put future demand going forward? And the answer is much, much higher than where it is right now. When oil demand drops during recessions or viruses, it doesn't just come back to its pre-impact level. It comes back to the pre-impact level plus the growth that would have happened without that impact. So just comparing something to 2019 levels is not accurate. We need to add 2 to 3 to 5% above that to get to our normalized oil consumption number, using that 1 to 1.5% of world growth liquids consumption per year. Global gasoline demand. So North America looks pretty good. This is pre-COVID levels on the left side. This is our current level today. So looking pretty good. We see Asia slightly dropping off, but still not all that bad, and a big gain here to go. Asia is still not fully open, China being a huge part of this, obviously. So definitely watching this. And Europe gasoline demand is at or above pre-COVID levels. So for all the talk about European collapse and Europe is a dead and the entire economy is going to collapse, nothing of that sort has happened in terms of gasoline demand, which is a good proxy for overall consumption expenditures on a personal level. So looking pretty good. Everything else is pretty strong here. We see South America, Africa, basically where they were pre-COVID. I would like to see some growth on this going forward. So watching that for sure. But until then, it's good that they're not falling. Once again, with the global recession narrative that's now been going on for 6 months, 8 months at least, with people saying the recession is here, the recession is impending, the recession is here, and we don't see it in global gasoline demand. Road traffic index, same story. Don't see it. There is no drop off, no matter what has happened, other than some Chinese drop off, which is being reflected in the data to some extent. But once again, temporary. It has to come back at some point or another. We see the road traffic by country: Brazil, the UK, Russia, Germany, France, India, China, Australia, the US. Everything looks to be tracking good. Some European countries are about 20% above pre-COVID levels, above 2019 levels. So how can a country be collapsing when the road traffic index is 20% above 2019 levels? And this is something that I never get a clear answer to. It's always, oh, watch, it's going to happen, it's going to happen, it's going to happen. Well, it has to happen at some point in the near term for it to be something that I should be worried about. And I don't see any trends from these 9 countries anyway. US, a bit more updated number, still at that 100% range. When we look at globally, the fleet index, so 100 being 2019 levels, is at 97. Road demand, 43 million barrels per day, and seems to be on an uptick once again. And just about every country, every area in the world is 95% plus. China is still at 95% on the active fleet index, despite all the lockdowns, the party congress, the slowdowns, the shut-ins, whatever. Where does that put China when it really opens? 120, 130? All that extra oil demand is still to come. Diesel demand. So gasoline is more of a consumer fuel. Diesel is more of a commercial industrial fuel. So Asian commercial and industrial activity looks to be strong. European activity, I believe this is the Europe graph. It's about 10% above 2019 levels. So things, despite all the factory shutdowns, despite all the high energy prices, diesel demand is still really, really strong in Europe. North America, looking good. South America is actually rising by about 20% compared to pre-COVID. And the rest are roughly flat. Africa, Middle East, Australia, etc. So diesel, a proxy for the overall economy, looks really, really strong. There's no slowdown. And this is with diesel margins blowing out. There's some places where diesel is costing $1 to $2 per gallon more than gasoline, and the demand is still there for it. We'll look more into flights. So number of commercial flights tracked by flight radar, and getting closer and closer. This black line is 2022. The light blue is 2019, getting closer and closer to 2019 levels. And one thing to note is it's not getting closer because the demand is picking up or the flights are picking up. It's because the flights are not dropping when they should be dropping in a regular seasonal pattern. So one of the factors that, again, is being misunderstood, I think, where people are saying, well, it's just going to slow down like every other year, and you're going to see this gap stay as it is. But this slowdown may not occur this year. And what you'll see is global oil demand, the way people calculate global oil demand, or they forecast it, is saying, this is our seasonal slowdown as the months go on, and this is the increase in demand we see because of XYZ factors, so demand ends up at this. Well, what if you see the increase from those factors and the seasonal slowdown never happens? Now the number is off, and nobody knows if that seasonal slowdown is going to happen. In terms of global flights, not seeing it yet. And remember, this is with the Chinese flight slowdowns that I'll talk about, and yet global flights are still maintaining this strength. Total flights. This includes commercial and military and cargo, private jets, everything else is running above 2019 levels already. So the amount of activity and jet fuel consumption overall may actually be higher. The amount of flights may actually be higher. The overall consumption is lower because a lot of the big, heavy jet fuel consuming international flights are not back yet. So if we're already here and commercial flights are still lagging, we're going to end up completely destroying these 2019 high watermarks for flight activity. Okay, there's a couple questions here. So, yeah, I guess we'll see. Europe will find a way to get diesel. Europe will not collapse. This is not a economy that doesn't have contacts or ways to get what they need. Will they have to pay more for it? Yeah, that's basically what they did with natural gas. They just paid more for it, subsidized it, and gave it to the people. That's exactly what they're going to do with diesel. If they can't find it, they will take it from the emerging markets, and the emerging markets will have to find a way to switch to fuel oils or LPGs or propanes, something else. But yeah, great point. Airline capacity going forward. So let's look at more, how many flights are these airlines scheduling? So we see a bit of a seasonal slowdown baked into here. And then 2023 starts off with a bang. We don't see this slowdown in January and February. That's really where the question lies. If this can continue on and we don't see the slowdown and then continue to grow out of it, yes, it will definitely bypass 2019 levels. Domestic seats are already going towards a normalization. The international seats are the ones that are lagging. And a lot of that has to do due to China, Australia, Singapore, Thailand, and then just that Southeast Asian market where there is this sort of slowdown in general. And the way to think about this is if global flights go up 10%, that is likely going to be your international flights. And international flights can consume 8, 10, 15, 20 times the fuel that a domestic flight addition would. So every marginal flight that's getting added today is going to be a high jet fuel consumption flight. And, or not every flight, but the ratio is going to be way higher going forward. So this is one thing that I track every single day, the number of flights that are leaving and the trends around that. Huge factor for oil demand going forward. Yes, correct. So the newer airline fleet is more efficient. It may have an impact on total fuel consumption, yes, but the number of flights is just going to be well over that, and not every airplane is going to be the new version. There are a lot of old planes still running, so the efficiency gains are always on the margin, not across the fleet. But yes, definitely will have an impact as things go on. And yes, Ahmed, you make a great point. All this activity is with Heathrow having a passenger cap, with some of the Dutch airports having a passenger cap, some of the German airports having passenger caps. There's no pilots, there's no baggage handlers, there's no airline attendants, nothing. So as that part of the labor market normalizes, we should see a more quick resurgence because the demand is there. The demand is there. People just don't want to pay the higher wage, the higher cost to travel, or they don't want to deal with delays and cancellations and other issues. They'd rather just wait for the industry to catch up. So Chinese flights, we have a slowdown in the Shanghai, Beijing lockdown, a quick return, and then a shutdown for the Party Congress and the Golden Week. And then we have now coming back up once again. So how fast will this rebound? We'll see, but just about every part of China now has had its complete shutdown phase, which, conspiracy or not, may tell you that that wave of COVID has gone through those areas. So Shanghai, Beijing, Shenzhen, Guangzhou, and now we're back rising up again post Party Congress, post Golden Week, when they didn't want any disruptions, they didn't want any protests. So there was a natural slowdown in activity in general. Big factor going forward. This rise will not only be mostly international flights, as I will discuss here. It will be Chinese business travel. It will be people entering China who didn't want to do a 10-day quarantine in the past. And it will be Chinese tourists who make up a huge portion of travel demand in certain countries. Definitely want to watch. This is Chinese international travel, well below where it was pre-COVID, about 2,000 international flights yet to return. And these are those big jets, jumbo jets that consume a lot of oil and they go a long ways. So definitely tracking this trend. As soon as this trend breaks here, it's game on. And here's one showing international traffic. A lot of flights that are operating in China are still the domestic versions. The international activity is very, very low. It did pick up during the Olympics and then has flattened out yet again. Travel markets for China. So these are the number of passengers and the countries and how many tourists in these countries are of Chinese origin. Thailand, Japan, Korea, Hong Kong, USA, Singapore, Malaysia, Vietnam, Cambodia. So let's take the USA out for a sec. A lot of Southeast Asian travel is from Chinese tourists. So as soon as China opens up, you will see oil demand in all of these countries pick up substantially. Because when the tourists travel, they need to rent motorcycles, they need to rent cars, they take Uber, they spend money on cruises, et cetera, et cetera. And then the flight demand. The Chinese tourists themselves don't want to deal with a 10-day quarantine. China just brought it down to 7 days. It will likely be brought down even more, which will spur these people to go and spend money in other countries and travel. Along with that, there's 48% of travel in the US. So America itself could see a big bump in petroleum consumption as these tourists return in the near future. Indian flight demand, almost at 2019 levels, slightly below. We'll kind of track this going forward. I am a bit concerned that it's not picking up further given the activities in India, but it is festive season. So things do slow down a bit. People spend a lot of time with family at home. And another one to watch closely going forward. This is Indian domestic flights, I believe. Yeah, this is Indian domestic flights. So watching for domestic flight activity to pick up. India is a big growth oil demand economy. And domestic flight demand is a big proxy for people's general consumption, their general expenditures, and the economic strength, health. So watching this as well going forward, it is again slightly lagging. So not really concerning, but one that I am watching as a extra 2, 3, 400,000 barrels possibly impact if this can pick up, not just jet fuel, but road consumption and the general economy. Australia, slightly below 2019 levels, some catch up to do here in international travel. As I mentioned, Canada is basically above 2019 levels at this point. So picked up substantially, a lot of domestic activity. And with some of the restrictions gone, the international travel is now picking up. That will likely be next summer where we see the huge bump from international tourists wanting to go to the nature areas. Japan just opened on October 11th. You see that right here. And it's an immediate bump in flight activity. So as soon as countries open, there's not only the regular demand of Japanese citizens, Japanese tourists, people who have family there, it will be the international tourists who now want to come in and the deferred demand around that for people who've been wanting to visit Japan for 3 years and haven't been able to. Malaysia, same sort of story. All these countries are waiting on the Chinese tourists to return. Malaysia did reduce some of their rules in May, and you see flights almost doubled, roughly doubled, and now it's flatlining in this range until the Chinese tourists return. South Africa. This is one I mentioned because of the drastic drop-off. So when Omicron happened in last November, right here, South African flights never dropped. They never dropped. There was never this COVID drop-off in March of 2020, which was the first indication that this version of the virus was not as serious as the initial version. And the reason I mention this is because flight activity can tell you a lot about how the country is dealing with COVID and its general economic health. By looking at examples like this, it really makes it clear that this portion of the virus was a lot more stronger, or the people were more worried about it than the Omicron variant in November. Indonesia picking up. This one seems to be picking up in general without Chinese tourists, but it's at a very low range to begin with. So we'll see more tourists here. Again, international travel, huge hub for flights to Europe, flights to the US, and then flights to Australia and New Zealand. When we see Australian flights picking up, you will likely see Indonesian, Malaysian, Thailand flights picking up at the same time. Vietnam, this big resurgence back to its 2019 levels, a slight slowdown here, and once again waiting on Chinese tourists here. Spain looking really good. So Europe has not seen a slowdown, and 10 to 15% of European GDP in countries, in some places like Greece, I think it's 20+%, is tourism. So when we say that Europe is collapsing, there's a lot of people that will come in with their stronger dollar, with their stronger currencies, and spend a lot of money in these countries, of which 10 to 15 to 20% of their GDP is tourism. So just want to think about, if you're looking at how much of GDP is really going to go down as time goes on. Germany, not too bad, still slightly below 2019. They have passenger caps here at many, many airports, so likely a big factor for that. The UK looking very strong. Mexico, well above 2019. Dominican, well above 2019. So we see some of these markets that have chosen to take away restrictions are now becoming the travel destination of choice. For many people, they've opened up airports, they've opened up airlines, new routes, and staying strong going forward, irrelevant of the fact that other travel areas are opening. These areas are still staying well above. We've had permanent migration to these areas, and just places where people want to go with no restrictions. This is Colombia, so almost 25% above 2019 levels, hanging in there, a bit of a slowdown here. Greece was about 20% above pre-COVID levels. And once again, Greece was 20+% of Greece GDP is travel and tourism. You can think about the impact that this would have despite the GDP loss in other parts of the country. And even more good news on the horizon. So Japan returns to normal border measures October 11th. Taiwan ends COVID quarantine for arrivals. Hong Kong to lift curbs on opening hours of restaurants and pubs. This is 2 days ago. So November 3rd, this happens. Australia has ended the self-quarantine. Chinese airlines are flying more overseas. So Guangzhou to New York, Rome, and Jakarta. Air India plans 20 new flights to SFO. To the US, with 6 being to San Francisco. Cathay Pacific, this is yesterday's news, is resuming flights in Russian airspace, New York to Hong Kong. And United Airlines is beginning service from San Francisco to Brisbane, Australia. So previously, United only had 2 routes that went from US to Australia direct. Now there's the 3rd one. All this is adding long haul, high jet fuel consumption, international travel, with about 1.5 million barrels of strictly jet fuel consumption yet to return, along with that other tourism fuels, again, the car rentals, the Ubers, the airports, the motorcycles, et cetera, et cetera. And all this is with global oil demand already at August 2019 levels. The number that we have yet to return is massive. Indian gasoline demand. So consumption is growing. We see diesel and gasoline staying relatively flat. In fact, gasoline looks to be growing quite a bit. LPG as well. And year-over-year changes in the 10 to 20 to 40% range. Jet fuel is up 42% year-over-year. As they build more airports, as the country returns to more normalcy, we will see these numbers continue to increase. going forward. And another thing with India, the highway construction. So they built 5,000 kilometers of highway per year in 2009 to 2014. That went to 9,000 kilometers a year from 2014 to 2021. It went to 11,000 was their target in 2020/2021. They ended up building 13,300 kilometers of highway that year. India's fiscal year is not a calendar year, so it goes from a different month to month. That's why some of these numbers don't quite add up. And then we look at full year or fiscal year 2023, hanging in there. It's in this. Some months are way below 2022. Some months are above 2022. And it's in this, call it 8 to 10,000 kilometers per year range of highway construction, which is going to continue to add more fuel demand, more people traveling, and more people consuming oil. They don't build highways to sit around and look pretty. They build them to be used, and they are being used. A lot of these highways are expressways, so they connect major cities and cut the travel time in half, or 30% or 40%. So people are much more likely to then drive on new highways that are much faster than these old congested highways filled with potholes and other travel, which is in India, you have trucks, you have bicycles, you have carts, and you have cows and everything on the road. So when somebody now has a fast, non-distraction highway, more likely to travel on these roads. All of this is backed up with vehicle sales. So passenger cars are dropping down about 30% in the last 3 years. But what are people buying instead? SUVs. SUV sales are up almost 60% in the last 3 years. So not only are people buying more vehicles to begin with, they're buying heavier fuel consumption vehicles. And people want to go camping. People want to put their sports equipment in the back. People want to go on long road trips. And the passenger cars are no longer doing the job. The same can be seen in utility vehicle sales. The year-over-year growth in some parts of the calculation is about 30%. So SUV sales go up 30% in a year. That is a level of growth we can possibly see even going forward out of these sorts of economies. And let's look at the latest data. Let's look at September 2022. We have total sales are down about 4%. Total vehicle sales are down about 4%. But two-wheelers, which are motorcycles, are down 14% compared to September 2019. September 2019 to September 2022, two-wheeler sales are down 14%. But personal vehicle sales are up 45%. And that's where the crux of this growth will be, is that motorcycle sales will flatline and scooter sales will flatline and stay at this level of about 10 million sales a month. And yeah, I believe this is a month, 1 million sales a month. Whereas personal vehicle sales are going up 10, 12, 15% a year on this growth trajectory until they hit some sort of level like China's hitting, where they're selling 3, 4, 5 million vehicles a month. India is only at 260,000 personal vehicles, non-motorcycles. Indian LPG demand, liquefied petroleum gas used for cooking and sometimes home heating and maybe even in vehicles, is rising at 8% per year. So there's growth everywhere, in every product, in every aspect of the economy. Overall demand is at above its 5-year high. It's at an all-time high. For the month of July, which is the latest number we have, and that is with the fuel prices going up. June, July were the highest fuel prices, and we see very little impact to overall oil demand. Expected to continually grow as the year progresses. Again, it's a seasonal thing. September, October, November, December, January, Indian oil demand goes up. So watching for this to add to the undersupply in oil going forward. Driving demand. So it's about 30% above the pre-COVID levels. This is a overall mobility index, and Indian demand is really going up way faster. It now is on this next uptick phase as the country is now completely done with COVID, is now into its emerging market high growth phase. In comparison, the world's mobility index is up about 10 to 15%. So I always look for countries that have a beat to the global index, and they will be your factors for oil demand growth going forward. Modernization. India built 50 airports from 2000 to 2018. They went from 50 airports to 100 airports. In the next 12 years, they're going to build 150 airports. So there is your exponential growth that we see as the country modernizes, as the country globalizes. Internet percentage. So the internet percentage in 2010 was 7.5%. It's now above 50%. And when people use the internet, what they see is what America has. They see 80-inch TVs, they see barbecues, they see sports cars, they see road trips and travel blogs and airports and pictures of these fancy countries around the world. So what will they do? They will save up money, they will stop spending money on other junk and start saving money or spending money on petroleum, because energy is quality of life. And if they can spend money on energy, they will have a higher quality of life. So I like tracking these internet percentages because the more people that are using these things, the more they're exposed to what's happening out there, the more they realize what they want. A person sitting there on a farm who doesn't know about any other country is not going to care. They're never going to be a petroleum consumer of that sort until they see it on their phone. And then they ask around, and so person in this area has actually been to one of these countries. And they tell them, oh, that's an amazing country. It's gorgeous. The food is amazing, blah, blah, blah. Now it becomes a goal of this person that was never there before. So want to watch electricity as well. This is light time luminosity in India 10 years ago, a few major hubs. Now just about the entire country can be seen in the nighttime lights that are on in the area. I will just put a reminder here. We're about an hour and a half in. So if anyone does want to join for the Zoom visuals, whitetundra.ca, and you can scroll to the bottom under events on the homepage, and the Zoom link is in there, and you can join in for that. If not, feel free to continue listening in on the Twitter space. So a little bit more on modernization. 50% of households in India have a bicycle. 47% have a two-wheeler. That's up from 37% just 3 years ago. Vehicles, 6% 3 years ago, 7.5% today. This is the way the market is going to progress. These people riding bicycles will go into motorbikes and scooters. And the people riding these will go into vehicles. That's just the natural progression of things. And the motorcycle rate is increasing so fast, it just adds so much demand in a country that has 1.4-ish billion people. And once people see too many motorcycles out there on the roads, they will want to move into vehicles, which then double, triple, 4x your petroleum consumption. These will give you 30 mpg. These will give you 100 mpg, miles per gallon. So It's just the way that the society goes. It's the way China grew. It's the way India is going to grow, 20 years delayed. Peak electricity demand in India continues to rise, basically hitting all-time highs month by month by month, to the point that their system is having troubles keeping up, which was a 10-year-ago problem. Then they increased a lot of their power generation and transmission, became less of a problem. Now, because demand is growing so fast, it's now again a problem. Very interesting, and one to watch, because when demand is overriding supply or transmission infrastructure, they will just build more infrastructure. It's the same thing as roads. If there's too much demand on the roads, they'll just build more roads. And then the demand just goes and congests those roads. And then they build more roads. It's a never-ending process. Percentage of households who own air conditioners or coolers, only 25%. So India is a very hot country with lots of heat and desert and pollution. So people are going to buy air conditioners, which is electricity demand, and coolers, which is also electricity demand. So only 24%. The point I'm trying to make is that the market is so massive here that it is once again going to catch people off guard when these countries go into their S curve, as I will discuss as time goes on here. So that was AC and coolers. When we look at actual air conditioning numbers, it's only 8% of people in India have an air conditioner. Compared to some other countries like Vietnam, that's up to 49%. And then the developed countries, Singapore, Malaysia, that are up to 80%. That's where things are headed. Those are the projections we need to use, not the projections of the last 5 years or the last 20 years, when the country is not in its S-curve phase. Okay, so that's India. Now let's look at China. The two big population factors in the world, the big global oil growth factors in the world. China-bound crude loadings. It went up as they took up a lot of oil during the COVID phase, put it into their inventories. Then they started draining it and didn't import as much. And then the lockdowns happened when they just massively were, the oil demand went down that massively, and now it's rising again. So me, as an oil investor, we always like to front run things. Get the data and understand what's going to happen before it happens. And the rise is not just small, it's a huge rise in oil demand or oil imports, and likely continues higher because now their inventories are so drained that they cannot just refine all this, along with the fact that there's extra product export quotas that the refineries have. So they need to now not only refine for internal consumption, they now need to refine for product exports on top of that. It may not be a huge number, it's still an additional impact on global crude. This is the same graph in more of a line graph fashion. So we see the big uptick in 2020, 2021, and then 2022 is now picking up back to this 10 million barrels per day range and hanging in there. And this sort of data is very interesting because you don't even need to wait for it. You can go on data providers and they will tell you the scheduled crude loadings. So I can tell right now exactly which ship China has booked, from where it's going to end up, how much product is going, or how much crude is going to bring into October, November, December, and on and on and on. So this is likely one of the biggest edge that, call it, professional oil traders have in the markets. And one of the major reasons that I got Vortexa was because of this, because people were understanding these things before I was able to, or before it hit the market. But with this sort of data at our fingertips now, it's very easy to see that the China zero COVID is not going to go on forever. It's very, very close to its ending phase in some aspect or another. COVID restrictions, we see the big restrictions. China was in almost like a non-zero COVID policy for almost 2 years. It's not like they haven't done this before, lived with COVID with small shutdowns here and there. It's only now that the Omicron variant is so much out there that it just spreads to everyone, and they need these higher levels of lockdowns. As that goes through the public, as the Chinese mRNA vaccines come in, we will see a normalization of this, maybe not to zero, but at least to this level, when China was consuming just about the same oil as it did at this level. Traffic congestion index. So, one of the big things here to see is that when the Shanghai, Beijing lockdowns happened, the congestion didn't really drop off all that much. So there's still people traveling no matter what. It just happens to be that a few of them on the margin came off. So even if China continues in zero COVID forever, even if we agree to this, that still means it's going to consume 13 to 14 million barrels per day. It's not like the demand goes to zero, like some people seem to be suggesting or portraying in the way of their showing of Chinese policies. This is more on the floating storage tanks. So I talked about this. This is thanks to Samir Madani, I believe, satellite data showing what's happening. We see the tanks. These are all floating roof tanks. So the tank floats on the oil. When the oil drains, the tank comes down, or the roof comes down. We see it's relatively full. This is when Chinese inventories were full. This is a few months later, a good proxy for today. When you see the shadows on these tanks are emptying out. These tanks are emptying out. These tanks are low. This entire area is low. And then you still have your full tanks, but each empty tank is less and less storage as time goes on. I don't have the latest data on this. I would love to get it. So I will be seeing what sources are out there to add to my arsenal, I guess, going forward. Chinese electricity consumption, straight up, did not even slow down in COVID. It's just straight up, and the slope is actually increasing almost. Primary energy consumption in China continues to rocket up. Oil, coal, natural gas, renewables, everything. Just because they're adding the most solar capacity in the world, blah, 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 doesn't mean that other consumption is going down. It's just adding to the overall consumption, energy consumption that this market is doing. Look at India, slowly growing, possibly going to enter this exponential phase. See how this curve changed from this linear curve to this sort of curve? It's if we take this COVID year out, you can see how the slope is starting to increase from linear to exponential. Next will be Africa, probably 10 years down the road to do the exact same thing. We talked about this before, European diesel demand hanging in there, European gasoline demand above 2019 levels. I won't go through this again. Russian demand. Russian oil demand is hanging in there really, really well. So whether that's domestic demand or military demand, it doesn't matter. We're only focused on total demand. And it's really hanging in there. Despite the sanctions and other narratives that the population is not happy and all this, all I'm focused on is domestic demand, oil demand. And that looks to be at normal levels. Their mobility index seems to be tracking any previous year. So, people forget that Russia consumes more than 3 million barrels per day of oil. So we definitely need to watch this country in case there's any large scale economic problems. It will have an impact to global supply demand balances. And so far, things are looking good. Electricity demand, the point I made in graph form. So renewables can grow as much as they want. Natural gas, coal, and oil are still the same electricity generation because you just can't grow renewables faster than what the overall energy demand in the world is growing. It's a very bizarre situation that is, again, misrepresented a lot, where they say renewables are this much of market share, they're this much terawatt hours, but they fail to mention that the oil and coal demand for electricity generation and natural gas has not dropped. So definitely want to pay attention to. And this chart is thanks to Dr. Alhaji. So global electricity generation by fuel. So oil is only 2.5%, which is about 5 million barrels per day of global electricity generation is from oil. So when somebody tells you that windmills and solar farms are in and oil is dead, okay, if you convert the entire world away from oil power generation, great, you just took out 5% of oil demand. So it's definitely not a death stab by any means. And I don't think you're going to convert the entire world away from oil in the next 10 days anyway. So for sure, one to watch. Electricity generation from oil going forward. Any comments on Saudi, Qatar oil demand? So yes, so I will talk about this here shortly. One point to make is that when oil exporting economies do good, as in oil prices are high, the GDPs of these countries can grow 5 to 10 to 15% a year. When GDP grows, oil consumption grows. So you take Saudi Arabia, take UAE, take Qatar, take Kuwait, Iran, Iraq, large populations in these countries, that if oil demand in these countries grows 5% a year, that could be that extra 2, 3, 4, 500,000 barrels that is not being counted in any sort of forecasting. But I won't even go there because it's just going to get too bullish if we start thinking about these things. Workplace patronage. So how many people are going to work in a literal office? So over 100%, or not 100%, the index, over 100% of the index baseline, global GDP weighted. So despite the fact that America is lagging, Europe is lagging, Japan is lagging less than 100%, the global GDP weighted workplace patronage is already at 100%. So that just means more and more people are entering the workforce in other countries, non-America, non-Europe, non-Japan, who are going to the office. Once this trend returns to somewhat of normal, this number is going to go way higher. And why do I think it's going to go higher? Because look at the top 10 cities of office occupancy rate, people actually going to the office and scanning their cards. They're all rising over time. Like, we can say they flatline to some extent, but they all continue to rise year over year over year. So it's just every September, more people are being asked to come back to the office. People are being asked to come back to the office 5 days instead of 3 days, and 3 days instead of 2 days, and 2 days instead of 1 day. That's just how things are going to go. Once people realize that the vast majority of people are not productive the way they're doing things. No matter how you argue this point, no matter how much we all love work from home, there is a productivity loss in the vast majority of people. So the markets I'll be watching will be New York, Chicago, Houston, big for driving to work, Austin, Dallas, LA as well, big for driving to work. San Francisco can take over an hour to get to downtown from the Bay Area, San Jose, etc. So tracking these in pretty much real time as much as possible to figure out what's happening. Retail demand is about 106% of the index baseline. Once again, global GDP weighted. This was absolutely skyrocketing pre-Omicron. It was going up at this curve that was almost unbelievable to see. And then it slowed down a bit, and now it's back in this range, set, ready for its next leg up as Japan opens, as the US sees more tourists and more openness in general. New shops, new restaurants, new malls, new amusement parks, everything. Traffic congestion. So this graph is tracking what the traffic congestion index is. And we see there were some issues in June, July, August, as the pricing of gasoline went through the roof. We did see the congestion come down a bit in certain cities, but now people are used to it. Prices have come down a bit, and it's picking up once again. More than 60% of cities have traffic congestion that's greater than 2019. Okay, I think, let me see here. Okay, I think we'll continue on for a few more slides and then we'll take a break here. After this section would be a good point to sort of stop and restart. So oil consumption growth, the world demand growth, where is it coming from? US still rising, China still rising, India rising, Thailand, Vietnam, Philippines, Bangladesh. What we look for is populations and growth rate, compounded growth rate. Many analysts are taking Thailand, Vietnam, Philippines, India, and throwing on a growth rate as to what it was for the last 10 years, 2%, 3%, 4%, whatever. But when countries enter the S curve, which is coming up here, that growth rate can double or triple, even on a compounded measure. And that's the setup that we're going into here as we go on. So world total oil demand projected to be 103 million barrels per day by the end of next year. I would take a guess this is at least 2 million barrels per day short. The impact of Chinese reopening and the world post-COVID is not well understood. It still needs a lot of dynamic variables, a lot of forecasting around it, but these numbers are always conservative. They would rather not be wrong. They would rather just throw out this number here and adjust it as time goes on, rather than put something out that seems shocking or eye-popping. So this is from the IEA Energy Outlook. I think it's every month, and keep an eye on this. Keep an eye on this monthly, how they adjust this 2023 bar going forward. Demand, where is it coming from? Southeast Asia, India, China. That's where a lot of the demand is. The demand growth. India, China, South Korea right here, Southeast Asia, and then other Asia. Many of these barrels depend on Chinese reopening. The Chinese tourists, the Chinese business, and just an overall opening of Southeast Asia, which is the last area that's really heavily still shut down or not as open as it was pre-COVID. And here's another graph showing you where is the growth coming from. It's non-OECD countries. So not your developed world. It's coming in from these emerging markets, part of the world. How does the world square EM? Yeah, so that's a great question, Jack. So Jack's question is, how does the world square emerging market demand versus supply? The price balances out supply. I think it's going to be a very interesting question going forward. Like, the emerging markets want oil, they want supply. They will be willing to reduce taxation to increase supply and feed that demand. The developed world seems to be going the opposite way, increasing taxation to reduce demand. So who is really going to win out in this? I think is one to really think about, because all that work that the developed world is doing to reduce emissions, reduce consumption, blah, 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 is not doing a single thing. All it's doing is reducing your quality of life, taking your money, going into taxes that is then blatantly wasted on these projects that don't really make sense and don't make the right impact. One of the big reasons that I began doing these sessions is to open people's eyes to the blatant misallocation of funds and the fact that the emerging market is just benefiting greatly from these sorts of regimes that are not properly managed. But I could talk about that for hours. So the non-OECD is your big growth number. It's one we need to watch because a lot of the growth has come from China in the past. Now it's the rest of the non-OECD where it's coming from. And I don't think analysts are putting the right CAGR number on the demand growth on it. Because of the reason I mentioned, things are going from a linear phase to an exponential phase. And the S curve is still coming up, I promise. So Chinese oil imports, linear phase, exponential phase. It's the same old story. It went from 2 million barrels per day to 10 million barrels per day in 20 years. It's that drastic with the population of that size. And the year-over-year growth is just always in the positive. Even if the year-over-year growth is slowing down, that still means it's positive from a very high compounded growth rate. So it's definitely possible. It's been done before. It will happen again. No questions. Chinese consumption, when it began this exponential phase, was roughly 5 million barrels per day. It's now about 15. India's population today, that's a green line, is about 6% larger than Chinese population was back then. And can you see how India is in this linear growth and is now mirroring this Chinese exponential switch? That's exactly what's going to happen. Maybe on a slower pace because India doesn't have the same manufacturing and industrial capacity, possibly, but it's still going to happen at this increased pace, whereas people are modeling this linear phase. Energy used per person in Africa versus a typical refrigerator. There's people on this call who probably know people with 2, 3, 4, 5 fridges and 6 barbecues and 4 vehicles and 3 boats. So there's about 500 million people represented in these 6 countries that are using less energy in a year than one refrigerator. And more than half of these people, almost 80 to 90% of these people are using less than a third the energy that one refrigerator uses. That's the global oil demand growth story. Not this decade, but next decade. That's what's coming as these countries modernize and industrialize. Nigeria likely one to really watch, a huge population that's growing and a country that is thirsty for oil. And this is the one to really watch. The rest of these countries are more of a 2025, 2030 plus story as investments come into these countries. But just the difference in energy consumption between these countries is just bizarre. It's just crazy to even think about that. How much energy does the average American use? And then we're telling other people to move to renewables and buy EVs. Doesn't make sense. So this is the S curve. The S curve is a plotting of energy consumption per year with your human development index. The human development index being quality of life, roughly. What happens is countries grow on this linear phase as they install houses, water supply, medical care, and electricity, etc. And then it goes into this exponential phase because people go from riding bicycles to now consuming petroleum in motorcycles and in cars. Same thing with electricity. They go from reading newspapers to watching TVs and using their phones. It's the same kind of concept that your energy use per thing goes up exponentially. It goes from 0 to X. And about 5.5 billion people are in this box here today. So this is 2018, so a bit earlier, but the same point. 5.5 billion people are in this box that are still not in this exponential phase of the S curve. Here's America up here. Not every country is going to get to America level, but they will try as much as they can. What makes this graph even more compelling is that 4 billion out of this 5.5 are in this box right here. They are on the cusp of this S-curve discovery. The graphs mentioned before prove this point. The exponential rise in airport construction, highway construction, vehicle sales, electricity generation, they're all coming to this point that there's a huge population of the world in this part of the S-curve. China is already consuming a lot of energy. India, Vietnam, Thailand are sort of in this area here. So a little bit less on the S-curve when this exponential phase begins. And they're all going to start consuming energy at rates never seen before, growth rates never seen before, which comes back to why the modeling, using the same modeling from 2010 or 2000 is just not going to cut it. There is a new paradigm here happening in front of our eyes, and we need to take it into account. China is still over here. They could easily consume 20, 30, 40 million barrels per day, just China, if they got to the level of standards or the human development index that the US is on. It's coming, and it's going to catch people off guard. The demand numbers, the oil and energy demand numbers this decade are going to be completely destroy any forecast out there. This is just energy and population. As the population grows, the gigajoules per person on a global basis continues to increase. This is population and vehicle growth. So when the population of an area doubles, the number of households 3x's, the number of drivers almost 4x's, the number of vehicles goes up 6x, and the miles traveled goes up 7 times. This happened over a 70-year period in America. This is going to happen over a 10 to 20-year period in India, in Vietnam, in Nigeria, in the Philippines, in Thailand. So take this cycle of 7 times the number of vehicle miles traveled, compress it into a 10 to 15-year cycle, and take into account that it's 10 times the population. American population went from 175 to 350 million. So there's a doubling that caused this 7 times mile travel growth. Indian and Chinese and other populations have done this much shorter, and the actual absolute population is 10 times. Instead of 350 million, it's now 4 billion people that are in this compressed growth cycle. So one of the pushbacks I get is that these countries can't afford the high price of oil with the dollar being so strong. Okay, let's look at 2011 and 2019. We take per capita oil, we take per capita income, the oil price, the exchange rates, and we come up with the oil share of the income. What percentage of their income is being used in oil? pretty straightforward calculations. In 2011, the US was 3.7%. This is with oil price at $90 a barrel, sort of where it is today. 2019 is 3%. Something like the Philippines, 4% to 4%. It didn't change despite the exchange rates changing 20, 30%. India, 6% to 6%. Despite the exchange rates changing, almost 50% loss in the Indian rupee versus the US dollar. Other countries like, let me just see which one here, like South Korea went from 6.2 to 5.5. Mexico went from 5.5% of income to oil to 4.5%. That's with the Mexican peso degrading almost 60% in those 8 years. The oil share of their income still went down. So these countries are growing so fast, their per capita incomes are growing so fast that the oil share of the income is just getting lower and lower, both in developed markets and in emerging markets. So the impact of this hard dollar index and whatnot is not really a concern as much as people make it seem. And I'm happy to run these. I know the person on Twitter who puts these out. I'm happy to run these at the latest exchange rates at $100 oil price. And I bet almost all the countries will still end up equal or below in the oil share of the income, because in the meantime, the per capita income has also gone up where we are here. New registration of SUVs. So let's look at more in terms of what kind of demand is coming in here. So in 2010, the global share of SUVs was about 13%. Today, 36%. No, hang on. It went from 15% to 45%. And what happens when people buy SUVs? Now they want to go camping. Now they want to do road trips. They want to go to more sports things. They want to go skiing. And now their neighbor has an SUV and there's more SUVs on the road. Now their little car doesn't feel safe anymore. So now they have to buy a big truck or a Yukon Denali or a big, whatever else. At the same time, manufacturers have stopped selling vehicles, passenger cars. They now want to sell SUVs and wagons and trucks. So it's a natural movement. And this percentage went up during COVID. So you would think people wanted to save money. They didn't have jobs. They would buy cheaper vehicles. Nope. They started buying more and more SUVs and expensive vehicles. So it's just the nature of the beast. Once the snowball starts rolling, it will roll. You will see this exact same thing happen in India and in China and in other growing parts of the world, where any gains in emissions reduction or pollution reduction, people just end up buying bigger vehicles that consume more gasoline or diesel. Same thing in Canada. We see cars have just gone completely down. It used to be 50-50 in 2010. Now cars are roughly less than 25% of total passenger vehicle sales. Light vehicle sales in the US are trailing last year. Yes. But once again, we like to front run any trends that are changing. If we look at this, the gap between 2021 and 2022, it was at its widest in May, June, and this gap is now normalizing. That means that on a year-over-year basis, we're now selling more vehicles per month, which is natural because the supply chains have eased, the inventory issues have slightly eased, cars are selling for cheaper, and the world is just more open, so people are buying more vehicles. This is despite all this recessionary narrative that people are still buying lots of passenger vehicles in the US. Globally, same thing. It's the same story. We had highs in 2017, 2018, and then the whole market just had a slowdown. And we're right where that slowdown point was pre-COVID. So should continue to stay here. As inventories ease, as pricing eases, likely more people enter the market and buy vehicles. I know a lot of people just anecdotally, this means nothing globally. People who are just waiting for the market to come down and then they want to buy a vehicle. It's nonstop. You hear it everywhere. RV sales, recreational vehicle sales, we had an all-time high in 2021 by almost 20%. It beat the previous record by 20%. 2022 was expected to be higher, even higher, but we have had a slowdown in RV sales. So May, June, July onwards, once the prices got really high, we have had a slowdown. But you know what? RV sales are still going to be in this 500,000 range this year, which is at the previous all-time high before 2021. So this is one to really think about. When sales of certain things are coming down 10, 15, 20%, that means they're coming down to previous all-time highs pre-COVID. Doesn't sound like a bad place to be for petroleum consumption, does it? Doesn't sound like the way some of these people on Twitter or on TV portray these things when they talk about recession. This is a 10 to 15% reduction in RV sales, and we are at all-time highs pre-COVID. That is the point that I really try to make on a lot of these things, whether it's RV sales, whether it's Apple iPhone sales, whether it's Walmart, whatever. Some of the money-wise and unit-wise, we're not doing all that bad. Things went way too crazy during 2020 and 2021 that a reduction is likely required at this point. And global coal demand, all-time highs in 2021, is going to hit an all-time high likely in 2022, despite all the effort that the US and the EU have done in reducing coal emissions. China is at monster coal consumption and production, same with India, same with other Asia. And that's just the nature of the beast. You can't tell people what to do when their quality of lives are at stake, and when you consume 10 to 20 to 40x the energy per capita that they're doing. So I think let's, yeah, there's a few more on demand. So let me just end the demand section, and then we can take maybe even a longer break, and then continue with the supply portion, which makes up the majority of this presentation, because this is a supply-driven crisis, which is backed up by rocketing demand that just doesn't slow down. So Norwegian demand, we see nothing, about a 7% drop off till 2020. If we look at 2019, about a 4% drop off. Okay, why is it important? Because in those 10 years, EV and hybrid sales went from 5% to 92%. So electric vehicles just took over the market. Same with the plug-in hybrids and the non-plug-in hybrids, and oil demand barely budged. It went down 8,000 barrels per day out of a 200,000 barrel per day market. Here's the same graph, a little more easier to read. This is motor gasoline in dark blue. This is diesel in light blue, and the EV sales penetration number is about 89% this year, XEV, I should say. So plug-in hybrids, fully electrics, batteries, etc. The total oil demand has not even changed. Whatever came down in gasoline has been taken up with diesel growth as people buy a second vehicle for long-term road trips, or for industrial travel, or industrial consumption in the general Norwegian economy. Right here, the same thing, cumulative EV sold, oil consumption in barrels, almost no change. Maybe time to rethink these people who keep saying that EVs are gonna absolutely destroy oil demand. Show me an example where this is the case. Here's your best example, the one with almost 100% EV sales on the new vehicle sales. And it's not like it's only 1 year into it. It's almost 10 years into this now, that some of the older vehicles should have gotten retired. Same story, Norway, Vietnam. Look at the gasoline growth or car sales growth in Vietnam, Morocco, Hungary. A lot of Europe is still underdeveloped. So it's not just Southeast Asia. A lot of Eastern Europe is going to go through the same sort of growth cycle. Peru oil consumption going up at this 5 to 6% rate every year, and 5 to 6% of 100,000 barrels per day is 5,000. 5 to 6% of 200,000 or 250,000 is now 12.5, 13,000 barrels per day. It all adds up as those growth rates continue to increase at that percentage on a higher absolute number. And you can see it in Latin American diesel imports. It is about 20% above January 2019 levels. And maybe September is a better comparison. It's about 20-25% above the September 2019 levels and continually rising. So 25% in 3 years, that's a hell of a lot more than a 2 to 3% growth rate that's being put into Latin America is going to grow at 2% oil consumption per year. No, it's 6, 7, 8%. And that's with pricing being so high going forward. We're already at $9 oil. We're at $30 crack spreads, $30, $40 crack spreads. We're already trading as if oil is at $130. If the crack spreads normalize, we're trading at $110 oil, and demand continues to go up. Not just 1%, 5, 6, 7%. So a bit on refinery outages. We see a lot of refinery outages. The American issues, we see the French strikes and some maintenance going on in India as well. Should come down here. You see the yearly trend. We're at this high peak of the season for refinery outages, and should see about 2 to 3 to 5 million barrels per day of refining capacity come online in the next 3 to 4 weeks. So, and this graph is a month old already. So we're already somewhere in here. Really, really good for oil demand, really good for crack spread normalization. And crack spreads continue to be very, very high, which is a sign of product demand that continues to be high. And we see that from low inventories, high demand, prices are going to be high. That's just the way the math works around the supply demand. And when we look at refinery additions, there's about 2 million barrels per day coming online. About 1 million barrels per day coming online in the next month or so. Some from China, some from the Middle East, that refinery in Kuwait, I believe, and as well as other refineries around the world is adding up. So is the refinery issue going to be fixed? I don't think so. But are we going to prevent a blowout like the one that happened in June, July? I sure hope so, because that was not good for the oil markets. That was not good for consumers. That was not good for producers. So these distillation units coming online, France, North America, Europe, India, along with these new refineries that are being fired up, should suppress those crack spreads in that $20 to $30 range, which is still really good for refiners, but not catastrophic for producers and consumers. A really, really good sign going forward, because one of my biggest worries was this refinery problem that's just consistently an issue, and it seems to be normalizing to some extent going forward. And the physical oil demand, we can see this in the time spreads. So you take the front month and you take the second month, you see what the backwardation is. The higher the backwardation, which is what's represented here, the tighter the physical oil market is. And today, the physical oil market is almost as tight as it was in that June period when oil was $120 a barrel. So from a physical oil standpoint, the market is looking really, really good as an investor, I should say. And a lot of subsidies being thrown out: Alberta provincial tax subsidy, global fuel subsidies, California gas rebates, and Japan's oil subsidy are reducing the impact of demand destruction. So you would normally see demand go down slightly as prices go up. Even that is not happening because of all these subsidies: oil, natural gas, gasoline, diesel, jet fuel, etc. Few points on LNG. This is natural gas production in the EU. It's gone down from about 130 BCM per year to about 45 BCM per year. They have nobody to blame but themselves for this problem that they've created. And it's not going to solve itself, because people are saying, well, Europe made it through all these years with this much storage and this much. Okay, their production was way higher back then. So you had this constant inflow of natural gas coming in that you didn't have to take out from storage. No longer the case. This production is down almost 30 to 40%, even from 5 years ago. So it's not as simple as just saying they've done this before with this much storage so they can get through it. Europe will be paying high natural gas pricing for a long time going forward. And this is with them taking 70% of LNG cargoes compared to 30% in the past. So LNG demand is just going to continue to increase, and very stable source of supply in North America, which is great for dual oil plus gas producers to have that floor price set in moving forward. Global natural gas consumption, there's your trend: linear, and then going to even a steeper slope despite being at a higher number. When your percentage growth goes up from a higher base, that's time to watch out on where things can go. Because not only is the absolute number higher, your percentage on that is even higher, which means your total growth as a BCF per day is gaining per year. And you've got decline rates and other things to deal with. Here's your LNG supply demand outlook. Russia under construction, basically can say goodbye to these. Here's your demand. There's a huge shortfall, basically starting in the next 2 or 3 years, and then becoming wider and wider as time goes on. Good for American gas producers, good for Canadian gas producers. Basically a floor price on natural gas going forward forever at this rate. Asian supply is basically flat. Asian LNG demand continues to go up. Here is the European share that I mentioned. The only reason Europe filled their storage this year is because they went from taking 30% of global LNG to 75% of global LNG. So they pulled LNG from everywhere else in the world, which now have to burn fuel oil, propane, LPGs, residuals, diesel, whatever. Not sustainable. This is not a sustainable thing going forward. So even the gas market looks really, really good. Not near term, because I don't like to make any comments on that as much as I make about oil, but long term, mid to long term, there's demand for gas and LNG and oil. Okay, so I'll stop it there. That ends the sort of the demand portion of the presentation. And inventories, we will move to supply, where we will look at every country that's an oil producer, and US shale in particular in lots of detail here. But we'll take about a maybe a 5, 7, 10-minute break, and let's reconvene at like just before 30 minutes past the hour, and we will continue on. For anyone that's on the Twitter space, would like to join for the Zoom visuals for the second half of the presentation, whitetundra.ca. If you scroll to the bottom under events, you can join in for the visuals. Everything is also recorded, so both the Zoom and the Twitter space, and we will see you all in about 8 minutes here. 30 minutes past the hour. Okay, well, let's begin on the supply portion. So once again, for anyone on the Twitter space, if you would like to join for the Zoom visuals, whitetundra.ca. And if you scroll to the bottom under events, the Zoom link is in there, and you can join us for the visuals and the charts. If not, I hope the Twitter space continues running. I know one of them crashed around the 4-hour mark for me, so we will go with the flow. So I think I always like to talk about the demand portion first, because we want to know where inventories are, and we want to know where is demand going? What's the actual market for this thing that we're trying to sell, this thing that we're investing in, before we then look at supply? Because supply is more of a nuanced discussion. We really need to look at every country detail by detail. But if we don't know what the market for that supply is, the supply could be any number and it would mean literally nothing. So we know demand is rising. We know that we have this deferred demand number to get back to. And we know we're doing it from a level where our savings account, our inventories are very, very low already to begin with. So now the question becomes, okay, if supply can make up for this demand and grow along with demand, then there's no problem here. We will end up in a cycle like we did from 2014 to 2020, where we're oversupplied or balanced, and demand still continues to grow, still continued to grow, but prices were still low. So we need to figure out, can supply really keep up in the next decade, in this cycle now going forward? And really the billion-trillion-dollar question. So we'll look at every country one by one, and then we'll look at US shale in the middle of it to go through one of the biggest sources of supply, which has been American shale. From 2014 to 2020, added huge amounts of barrels. And we'll have a look at what it can do going forward to get this overall view on where supply is compared to where demand is going. So we'll begin with Russia, the big elephant in the room. Literally because of its size. It's a 10 million barrel per day producer, 10% of global oil. Oil is priced on the margins. It's the last barrel on the market that determines what the market price is. So if a producer of this size is now being, has this gray area around it, it literally becomes the elephant in the room. So about a year ago, we had most of the oil going to Europe, some to Asia, and then tiny bits into North America and other places. This has now changed since February and March. As we all know, the European number is declining, the Asian number is increasing. Two things to notice on this graph. One, the overall number is going down. The overall exports from Russia are going down. And we'll discuss this more here as we go. And two, there's only so much European oil or Russian oil that was going to Europe that Asia can take in, due to refinery issues, due to transportation, due to certain kind of blends and grades, due to certain kind of products that they need, whatever. So as this goes on, what you're seeing is that the Asian number is now relatively the same, and it's just the European number that seems to be dropping. Can Europe or can Russia find a home for this amount of barrels, about 2 million barrels per day, by December, when this supposed crude sanction is going to kick in? Whether it happens or not, we don't know. But the point is, at some point in the future, Europe has to replace these barrels with something else. And can Russia change up their trade flows to send this oil somewhere else fast enough? Can they find enough tankers to do it? Because all these tankers would have to be illegal sanctioned tankers that are doing ship-to-ship transfers and other sorts of activities. So Russian supply falling. There's also an issue with Russian fuel oil product. So this product was going all over the world, Europe, North America, other places. Now it's all going to Asia. So when I mentioned earlier in the presentation that Singapore has this glut of Russian fuel oil, residual oils, this is where it's coming from. Russia literally has no market for this product. It's sitting there until it has to be used in the wintertime for maybe power generation, maybe as backup, etc. But there's a lot of extra fuel oil that has no place. And the more ships that get used up in storing this fuel oil, the less sanctioned ships there are to use for trading activity. It's all a big problem. On top of that, a lot of insurance providers will not insure this sort of activity. Are there people that will do it? Yes. But up to 5, 6, 7, 8, 10 million barrels per day, maybe not. So that's where the big question comes in, and nobody has the answer. What we know is that about half of the Russian crude that was going to Europe has been swapped out, maybe a third-ish. The rest now just becomes increasingly difficult to move, same with the fuel oil. You can find home for the first 20, 30, 40% of something. It's that last 60% that becomes harder and harder as things go on. And why it's such an interesting time in the oil markets, because on top of this, you have Russian oil production problems, which I'll talk about here. So we'll just talk about some of the differentials. So the ESPO blend has actually recovered a lot of its loss and is now selling at only -3 to Dubai. Same with Urals crude. It was down as much as -35. It's now -23 or so. So that differential has come up, which tells you there's enough of a market for it at that price, mostly from Asia, probably some going elsewhere as well. But definitely want to watch. And on top of that, the bigger problem is the production. This is what Russian production looks like. These are your offshore ones. These are your onshore ones. It has just started, as of probably 2 weeks ago, to hit below 0 degrees Celsius in Siberia, and even some of the lower parts of the Russian country. When you get below zero degrees is when things start to freeze. Oil and water, for the most part, get thicker, harder to move around. Gas will freeze. And Russia does not have the supply or the service support anymore that it did in the last however many winters. So is there skeleton crews there? Yes. Is there some equipment there? Yes. Is there enough to keep 10 million barrels per day going? No. Maybe in the summertime when nothing really goes wrong, things just operate. Yes. But we still saw Russian production declining even in the summertime. And now that it's hitting the wintertime and we see these big ice sheets and snow everywhere, -10, -20, -30 degrees Celsius, things freeze up. They don't have the parts, they don't have the labor, they don't have the equipment, they don't have the expertise. That thing can be basically say goodbye to it till the thawing cycle in March, April, May. And that will be one of the biggest factors going forward. Is so far there's a false sense of security because that first 20, 30, 40% of product is easy to move around. Oil is relatively easy to operate in the summertime. Both of those factors are changing right as we speak and cracking Russian exports week by week, day by day, to see whatever data we can figure out as to what's happening behind the scenes. When we look at new Russian fields, there's another graph on this that will come later that will tie into this, but Russia was projected to actually increase their oil production this year and next year. So not only are we not seeing an increase, we're seeing a decrease in oil production. And on top of that, any unsanctioned oil field has such huge break-evens because it literally looks like this, that you need so much money and capex to get these fields running. It's in the $60 range, 63, 52. There are some cheaper fields, but those are phase 2 expansions on current fields, which are only good for X amount of barrels. A lot of them are new fields, which are in this $50 to $60 range, break even, before taking into account that inflation is just killing the oil patch right now in new drilling and parts and labor. Let's also look at Libya. This is one that seems to have a major impact on short-term supply demand. We saw it was looking pretty good, and then it just so happened that when the oil prices were the highest, this thing completely collapsed and lost about 600,000 barrels of oil exports per day. And then it's rebounded here. They just had some elections and put in a new leader. But there's two things here. Once again, two things. Number one is that the political structure of this country is still not stable. There's too many gangs and rival groups and people in trucks going out, killing each other and blocking off pipelines, shutting down fields. It's one that's always a possibility. And the second thing is that the issues mostly happen when oil price is high. When the prices are lower, it's relatively easy for people to stay calm and say, oh, this is not worth our effort. But when oil prices go to 110, 120, 130, is when the money starts to get so big that it's worth really going in and trying to take over or do whatever else is happening. And if you look at this curve, the issues happen when the oil price is the highest. That's literally what it is. And we look at going back a bit, we see 2011, the civil war, oil prices were really high, shut down almost all production. They made a bunch of money here. And then 2013, again, there was issue because oil prices were again relatively high. And that issue continued all the way till 2018, 2019. They had a few months of good production. And then with the 2020 outage, even pre-COVID, and now this 2022 problem that happened. So there's always the supply loss possibility up to 500,000 to 1 million barrels per day for extended periods of time. That is not priced in by any means into the market. And there's some issues with the way this thing is governed with the East and West. One gets the money, one is where the oil is, lots of infighting. Definitely hard to track what's going on, but there are ways through exports and other production metrics that this can be tracked. So those are the two that would be the very short to long-term actually impacts that can happen at any time, and ones that I would watch for immediate short-term impact. That Russian oil could just go 500,000 down, or Libyan oil could go 500,000 down for an extended period of time going forward. So two to watch for. And now let's look at America. This is American production in black. So coming out of the COVID crisis, we saw this increase, from 11 to about 12 million barrels per day. We saw the rig counts going up in this linear fashion. And now both production and rigs have flatlined. So rigs, because of literal supply chain issues, labor issues, parts issues, and production because of a lot of factors, which we'll talk about. But overall, the rig count, here's the last month, flat. Here's the last year, growing, and then it flatlines in the last 4 to 5 months, 3 to 4 months, let's say. And one of the big reasons that production was able to grow from 2021 January to 2022 January is what we call DUCs, drilled uncompleted wells. So wells that are drilled but not fracked. The shale industry had a massive backlog of these wells that they kept in the back as a secondary savings account. So if you want to think of inventories and the SPR as a savings account, your DUC is your emergency supply button that we need a lot of supply. Let's go. Let's bring this online. And that's what they did. They fracked way more wells than they drilled in the latter half of 2020, 2021, and the first half of 2022. Now those DUCs are running out. They have ran out. This is the DUCs by basin. So we see the Permian, the most productive basin, has had the biggest drop. The Bakken, the Eagle Ford, etc. You see the monthly change. They were building DUCs and then drawing and then building all the way till 2020 happened. And since then, it's been a consistent draw back to levels that we first saw when they first started tracking DUCs back in 2015. This is the same chart in more of an oil only fashion. So this one has the Haynesville and the Appalachia, which are gas. This is oil only. You can see the drastic reduction from about 7,500 to 3,200-ish is where we ended up. And this insurance policy is gone. All these wells, these 4,000 wells that were drilled with the surface pad ready, with casing in the well, and no need for a rig, were ready to go with the steel already in the ground. So there was other benefits, not just production. They were able to avoid supply chain issues and get these wells on much faster. That is completely gone. These 3,000 that are left are dead DUCs. They are, well, dead plus operational inventory. So there are some that are dead, which means they were drilled pre-2019. They didn't find oil. They drilled the wrong zone. The formation collapsed on the well, whatever. They will never be produced. And then there's operational inventory. When you have a rig on a site drilling 5 wells, you usually can't frack on that same pad. So a bunch of those wells end up in DUC status strictly because it's operational inventory. It has to wait until that rig is off site, and then it can go back in and frack those wells. So it's not really an excess, it's more of a working inventory. And so we have our dead DUCs, about 2,000 of them, and the rest, 1,500, is our operational inventory, about 1 to 2 per rig that's actively working. The same on the latest numbers, we see dead DUCs, about 2,500. We see our operational inventory, about 2,500. And the abnormal live DUCs is basically exhausted. It went from 2,700 to 350. And the ones that are left naturally are the worst ones. And some of them might be dead DUCs. We just haven't had 24 months pass by for us to know that these wells are dead. There might have been some drilling problems in the recent 2 years. So really, when we think about it all, the DUCs are done. There are no more drilled uncompleted wells left. It's now all on new drilling. There's your second Band-Aid or savings account that is now depleted. On top of this, what we're seeing that as the DUC count comes down, producers are adding more rigs. That's what they did for the last 18 months. But each incremental rig is of lower and lower quality and is drilling worse quality acreage. People always drill the best stuff first, and then they go to the next best and then the next best. So rigs that were adding 45 1,000 barrels. I think this is per year per rig. It must be NBT per oil rig. Yeah, something like that. Are now 25,000. So less than half the efficiency of a rig added in 2020 or 2021. It's that big of a drop off. And that's going to continue forever, because every rig that's now getting added is one that was sitting there for 5 years, rusting away in the dust, in the rain, in the snow, and is now being brought back with a cold crew who maybe has never drilled a well before. So each rig added, less efficient, less oil being brought online. This is what Rystad is forecasting. They're saying that, okay, we're currently at about 8 million barrels a day from shale. We will be, in the next 10 years, about 15 million barrels per day from shale. The same growth rate, the same curve. This is what has been sent to the Biden administration. This is what the analysts use. This is what the average person thinks. That why are you concerned about demand? We have infinite supply in the shale oil patch. Why is this even being talked about? Okay, this is where they say the oil is going to come from. The Permian is going to grow from 5-ish million barrels per day. 4-ish million barrels per day to about 9 in the next 10 years. Okay, so that's what we're working with. That's what the average person thinks is going to happen. And that overall shale production hits 15 million in 10 years. So what is that, about 1 million per year growth, roughly? Okay. But then Rystad comes out at the same time and constantly lowers their production estimates. This was in July. In July, they were saying that December 2024, we would be at 13 million barrels per day. Lower 48, non-offshore US oil production. In September, they brought that back down from 13 all the way to 11.7. That much difference in just 2 months. In just 2 months, literally. And then in October, just 3 weeks after the September number, they brought it back down even more to 11.5. This is the way that these forecasts are going to be done. They will show this huge increase, and then as reality comes, they will slowly bring them down month by month by month. None of these entities are going to accept defeat. They will stand by their model and then re-change these things as time goes on, which is what the average person is going to think until these models change. But once again, when I like to invest in these things, I like to front run what the model and the data and the actual trendings are showing, that why was this model changed and can we expect this going forward? So we'll look at some data here. The EIA, the Energy Administration, is saying the same thing. Their forecast in January was this. Then their forecast in June hit this green line way up here. And just in October, they brought it down 900,000 barrels per day of US growth by December 2023 in just 3 months, 3 or 4 months. That's how much of a change has happened here. And we'll show here why this change has happened, what both these entities are seeing, and why I think these production forecasts will likely have to be brought down even lower, not just in the near term, but these pie in the sky forecasts as to where things can get to. So before I get there, we saw that US production was increasing in 2021, and then it's flatlined. It's not just shale. US onshore conventional used to produce more than 10 million barrels per day, conventional non-fracked wells. These wells were being fired up throughout 2021. These wells are being fired up today because there's 1 million of these shut-in wells sitting in the US and in Canada that are not economic at $70 oil. They are not economic at even $80 oil. They may be economic at $90, $100 oil. So people are slowly bringing these wells online. Instead of drilling new wells, they say, oh, we can go fire up 40 of these old wells that'll produce at a low decline rate, conventional, and produce forever. So almost 300,000 of the growth in production last year was from conventional. It wasn't even from shale to begin with, despite what people will tell you that shale is growing again, it's doing this, it's doing that. No, it was conventional oil that came back to its pre-COVID number well before shale ever did. On top of that, the Gulf of Mexico volumes are increasing. So Shell is bringing on some platforms, I believe BP, and I want to say Total has the other ones that were planned to be online this year, adding more volumes. It's not shale, it's offshore and conventional with a tiny bit of shale on top of that. Here's the DUCs more in detail: Exxon, XTO, Chevron, Pioneer, Diamondback, some of the biggest shale producers. You see how they were building, and then it just came crashing down to almost zero. And we were tipped off about this DUC problem in early 2022, late 2021, with Flow's information on kind of where are the excess DUCs remaining. And it just became like a light bulb moment, like, okay, this DUCs is what's causing the growth in shale, or the flatlining in shale. They're going to end in the next 6 months. Frac spreads. This tells you how many fracking operations are going on. Flatlined. It's completely flatlined. It's at a level it was back in February. The US producers don't care about growth. They said, no, if the other frac is going to cost us way more, leave it. If it's a poor quality fleet, leave it. They don't have the rigs to have enough wells to frac anyway, because what the frac fleets were doing were fracking the extra wells while the rigs caught up. Well, now the rigs are flatlined, so there's no wells to frac, meaning the frac spreads just are not going to go up until the rig count goes up, and the rig count is flatlined for various reasons. Here's the Permian frac fleets, sitting about 30% below where we were in 2018, 2019. So just to give you an idea of where things are going, the wells are longer, the wells are more proppant, the wells have higher intensity fracs. So each frac fleet does a lot more, but only to an extent. That doesn't go on forever. And if you're down 30% in your frac fleet count, you're basically staying flat at that point. You're not going to get the same growth for the reasons I'll mention here as well. North American frac count, it's been flat all year in this 300 range all year long. And that's just where it's going to be. If we take Canada out of this, the US frac fleet count has been flat for almost 9 to 10 months at this point. And Permian, not doing anything. The other core oil, relatively flat. In order to see this drill baby drill mentality that, again, I hear a lot that, oh, you're just kidding yourself. People will start fracking and drilling as soon as they get the opportunity. Well, where is it? It's been Q3 averaged $92 WTI. Q2 was 106, somewhere in there. And Q1 wasn't bad either. So where are they? They should be here by now. In every other cycle, they're here by now. This time, it doesn't look like the shale people are here. Pressure pumping spot index. The pricing of everything is going up. Inflation. It's further hampering this drill baby drill mentality. If the pricing of everything is going up, there's supply chain delays, there's timeline delays, you'll say, I'll just wait to see what happens. There's pricing volatility on your product as well, your crude oil, and the price still continues to just keep rising. There's not enough equipment, there's not enough new builds coming out, and everything is just being bid up to the point that there's no extra oil field service equipment out there. Permian operations by week. So frac operations in the Permian, you can see the trend. It's been flat for the last 52 weeks. There is nothing happening here in terms of increasing fracs. This part of the graph would be DUC fracs and new drills. This part is mostly new drills because the DUCs are just completely zeroed at this point. The other thing is bad data. There's a lot of bad data being thrown around everywhere, both from Rystad, not bad data, bad forecasting, and bad data. So Rystad, EIA, IEA, BP, everybody is just not the right kind of data, and people are then making wrong interpretations of this data. So here's the EIA Texas production number. Here's the actual Texas Railroad Commission number, the entity that has the best understanding and gets real data on their production. It's getting wider and wider. You know, the latest numbers may not be accurate from the TRRC, so I wouldn't take this last couple months as accurate, but still the gap is widening. Same with New Mexico. The EIA is just putting out numbers that are not matching up to what the state commissions are putting out. Same with the oil and condensate numbers. This is the EIA in purple. This is what the actual one is in red, good till July 2022. This is the DPR report. So, or no, the 914 report. The EIA 914 is about 3 months delayed, and it tells you exactly how much oil was produced that month. April 11,652. When we look at the weekly EIA numbers, April, it's 11,850 or 875. It's off by 200,000 barrels per day. May, same story. June, same story. July, same story. July, in fact, is off by 300,000 barrels per day, almost. So there's something wrong in the weekly data that is not matching up with actual production. And why do I mention that? Because when we go back to this chart here, this shows the weekly data, the black line. So in reality, we're about 200,000 to 300,000 below this, which means our production today in the US is all the way back to December levels. Nothing has happened all year long, despite the rig count going up, despite the fracs going up, and continual treadmilling of the industry. Okay, where was I? Now let's look at the DPR report. This is the report that every month you will get a notification or a news thing that US production to hit all-time highs. US shale production will be all-time high in October. And massive growth coming out of the US. Okay, let's see what actually this is, what they're forecasting. In February, this report came out. They said February production was 8,598, and March will be 8,707. And the news report came out, maximum oil production reached. Okay, then the March report came out. It brought March down from 8,707 to 8,591. So basically no growth was seen in March. But they still forecasted April at 8,708, another high number. Okay, then the April report came out. Instead of 8,708, it ended up at 8,517, almost 200,000 barrels a day in 1 month of inaccuracy. That's how bad this data is that's being put out. Then they said, well, hang on, wrong. Yeah, then they said May is going to be 8,649. Okay, and the same story continues. September, they said, was going to be 8,983. Well, October was again brought down 114,000 from 9,115 to 9,001. They just keep pumping out the same number every month with the same growth rate and then bring it back every single month. That's literally it. And one other thing to notice here is they were saying the Permian is growing 70,000. Then it got brought down to 66. And now they finally made some change to the model that says it's only going to grow 50,000, which also is wrong. So basically the DPR, if anyone ever references the drilling productivity report production number, just tell them it's completely wrong. You can send them the link to this specific slide that shows you why this data is completely, there's nothing backing it up. It's not that it's wrong. It's just some model that got put into this system. Nobody knows what the model does or how it works. It just pumps out this number and somebody copy pastes it into the actual report. So that's the forecasting side. On the supply side, what we saw is that the drill baby drill is not happening from the public companies or the majors. It may be happening in the privates. So what the private companies did, they saw, okay, oil prices are rising. Let's increase production, increase rigs, and we can try and sell in 2022. It didn't work out because the public company and the major executives knew that the acreage was not good. They just pumped up production numbers with huge drilling and then tried to sell off these things with a massive decline rate, and nobody fell for it. So now these private companies, and I'll show this as we go, are dropping rigs because they literally can't afford to do anything at this point going forward. Okay. The other thing is the new private companies. So in 2016, one private company was getting this $200, $300, $400 million every 3 days. Same with 2017, 133 per year, about one every 3 days. In 2019, before COVID even happened, it became one every 10 days, one every 12 days, about 31 new companies. And 2020 was less than one a month, only 9 PE commitments by year. That's the drastic shift that's occurred in funding this sort of non-cash flow backed production growth, growing production for the sake of growing production, not worried about making money. In fact, losing. The shale patch lost $300 billion of money between 2014 and 2020. A complete waste of capital for the sake of production growth. And this is what happens when you get capital. When you have a reasonable amount of capital, you have this nice growth and a nice production cycle on your resource. When you infiltrate that cycle with cheap debt, zero cost of capital, equity, and free to go bankrupt, no problem, this is what happens. You get this massive production growth with a very small peak, and then the decline rates hit. And you don't have the acreage to keep this level of production going. You had the acreage to keep this level of production going, lower. But now that you've jacked this up with access to capital, and now you're gonna, we don't have the acreage to even keep our production flat, let alone grow from here. Keep this graph in mind over the next 2 to 3 to 5 years. This no debt graph and this access to debt graph. The other problem in these areas is gas offtake. So they built oil pipelines, but now the gas, the field is getting gassier. Lower quality shales, lower tier acreage will always be gassier than higher quality oil-rich acreage. So now it's producing a bunch of gas, and they never built the right amount of gas takeaway capacity. You cannot flare, you cannot vent the gas. So now there's some issues. We saw Waha gas trade at the negatives here last week because there's too much supply of gas and not enough pipelines to take them away. Here's a flaring intensity. Public companies will always do better with flaring intensity because they have to report to the shareholders. They have to report every quarter what's going on, and they need to have good ESG metrics for investors. Private companies are not good stewards of neither capital and neither the environment. Out here flaring a whole bunch of gas because they're drilling in other areas that's lower quality acreage and doesn't have infrastructure. So they naturally need to flare a lot of gas. As these companies get taken out, watch for the growth to slow down even more. And also, as the flaring regulations change, watch for these privates to get reined in even more, because the regulators will make them install processing capacity or infrastructure that doesn't allow for flaring going forward. And it's not just the small privates. Like Mewbourne is one of the biggest privates out there, and its flaring intensity is way above what these bigger public companies have. Here's a GOR, gas oil ratio, slowly rising, as you see. 2016, 2017, 2018, the best wells were drilled, and since then, it's slowly rising. Now, what's happening more recently is companies are moving to non-core Permian, which is your lower quality Permian. This was the forecast in red. This is what's actually happened. More and more flaring is happening in non-core areas, which tells you that companies are now drilling in non-core areas. So the wells are naturally not going to be as good as the core areas. Private operators' contribution to flaring. It was about 50 to 55%. Now it's gone up to 60 to 65%. That tells you that it's the private operators that are going into these non-core, non-infrastructure areas and doing these sorts of activities. And they will get reined in. This is not a free-for-all. As much as Texas is very open to these things, it's definitely not a free-for-all, and the activity will have to come down going forward. The flaring intensity by operator. So the companies that are good at this are good at it already. The companies that are on the edge of this, these privates and whatnot, are actually going the opposite way. Because their core acreage is now fully drilled up, they now have to go, as I mentioned, these private companies, their plan was we'll grow production 2021, 2022, and sell. They did that, except they couldn't sell. So now they ran out of core acreage. Now they have to go and drill in non-core acreage to keep production flat. And when they go and drill there, their flaring intensity goes up. That's exactly what you see here. The blue dots are 2Q22, and then the orange dots is July. And you can see a lot of companies, their flaring intensity actually went up in just 1 month of July as they started drilling non-core stuff. Reserves. The US doesn't have the reserves to grow production or even flatline production for the next 10 years. They are producing almost 10% of the reserves every single year. Okay. Iraq, 1%. Libya, 1%. UAE, 1%. Kuwait, 1%. Russia, about 4%. Canada, Iran, 1%. Saudi, about 2%. That gives you that 20 to 30 to 40 year life cycle at this production rate. The US went crazy. They started producing way too much. And now that production number is so high that it's eating up almost 10% of the reserves every single year. And keep in mind, this is not tier 1 reserves. This is all reserves, including tier 5, tier 7, tier 10 junk that's being counted in here. So where exactly does Rystad think that the US can increase production more than double it in the next 10 years and then produce at that level for a long, long time? It's just not going to happen based on where we see things. And I'll show more data as we go here on this, because it's such a important topic to understand shale going forward. Here is what the people, the shale people, are telling investors and others is the shale boundary. This entire brown line along with this purple line. That we have this much oil and it's good for, this is the US Geological Survey, is saying this is what the Permian Shale is. Okay. And they say it's about a 40-year reserve. 40-year reserve at X reserve at X production, 5 million barrels per day, let's say. Okay. The first thing you notice is if this entire thing was productive, why are there no wells in more than half the acreage? Or why are there 1 or 2 wells that just get abandoned and people move on? It doesn't really make sense, does it? Why is everybody drilling in this area? Because this is the only place where oil is there in any economic, commercial quantity. And that's at $80, $100, $120, $150 oil. Can you drill in these areas at $1,000 oil? Probably, but we're talking in the realm of possibility here. And so take away half your supposed 40-year reserve life, because half of it is unproductive. So 20 years, okay? Of that, they've already produced 5 to 7 years of reserve in the last 8 to 10 years. So that leaves us with about 13 to 15 years of reserve. Of that, probably 5 years of reserve is stuff that would never get drilled unless oil was $120 or $150 a barrel. That leaves about 7 to 8 years, maybe even lower, at this 5 million barrels per day production rate. That's with wells degrading. The tier and the acreage are degrading as time goes on. So that's all there is left. And if they keep producing at this 5 million barrels per day, they're going to be drilling worse and worse and worse wells to keep that production level. And there's maybe 7 years out left, and then it goes, and that's not how things work anyway, because what will happen is they will produce at 5 million for maybe 3 or 4 years. And then the rest of the 3 years at 15 or at 5 million barrels per day ends up at a 15 million barrels per day year reserve life, will be produced at 3 for 3 years, and then 2 for 2 years, and then 1 million barrels per day for 5 years. That's how that goes. It doesn't just go from 5 million to 0 in 1 year. So it'll have that normal curve shape that we saw. But doesn't it more and more look like we're going to see this sort of drop off as opposed to this sort of drop off? Because they still produce at 3 to 4 million barrels per day for 3 or 4 years. They literally don't have the reserve to do that. So do we get to a lower peak and then stay there for longer? Or do they continue to keep going crazy, trying to maintain production rates, and then the whole floor collapses in 2 years? And that's where I see a comment here. That's where I think the energy aspects peak production comment comes from. So keep in mind what people are saying is reserves and what the actual physical data shows is reserves. Just because some geologic survey went and put this as the boundary doesn't mean it's all economic or all commercial. This is just where the supposed formation is that the Permian is. Okay, so let's look at some data. Let's put some numbers, enough of maps and other stuff. So this is your average daily oil production by well, unnormalized. So not adjusted for lateral length. It's just the wells. Here's 2016, 2017, 2018, 2019, and 2020, and 2021. Productivity was always increasing on an unnormalized basis per well. 2022, it's dropped. And it's not just dropped a little bit, it's dropped a lot. Enough that it couldn't even maintain that peak. It actually went down a level back to the 2020/2019 levels of well productivity. Okay, not a good sign for growth, is it? When you see growth, when you want growth, you want productivity to keep going up or stay flat, not go down this drastically in just 1 year. Here's the daily oil production. And I'll make a point here as to why shale cannot grow how people are saying. Look at 2017, the end of 2017, and shale was producing, or the Permian was producing 2 million barrels per day. In 1 year, this base production, so December 31st, 2017 and before, any wells that were producing before that, they went from making 2 million, 2.1, let's say, to about 1.2. So they declined 900,000 barrels per day. Okay, in that 1 year. But in that same time, overall Permian production went from 2.1 to 3.3. So now let's look at the math around this. Overall production went up by 1.2 million barrels from 2.1 to 3.3. But they also had to mitigate 900,000 of decline on the base production. So the actual new production brought online in 2018 was the 1.2 plus the 900,000 decline, 2.1 million barrels per day. Okay, very good job. 2018 was a monster year for shale. Now let's look at the next year. All the wells that were producing December 31st, 2018 and before, they went from 3.3 million barrels a day to, call it 1.4 million barrels per day. So now your decline, your base decline is now 1.9 million barrels per day. But despite that, the Permian still added production, and the total Permian production went to 4.2 million barrels per day. So the 1.9 decline plus the 0.9 growth, 2.8 million new barrels were added that year. Now let's go back and see what happened. 2.1 million were added in 2018, of which 1.2 became growth, about 60%. In 2019, they added, where we got 3.3, about 800 to 900,000 of growth out of a 2.8 million of total new production. So only about 35% went to growth. In 2020, the entire thing collapsed, so we don't really have the data to prove it. But it comes down to this point right here. As your production number goes up, more and more of your new production is going to mitigating decline than it is to adding new growth. So the same number of rigs, the same number of frac fleets is now spending more time mitigating decline than it is adding growth. And here's the same example, but across the entire shale platform. Between December 2016 and December 2017, production fell 1.3, and this was your growth. Between December 2018 and December 2019, there was 2.7 million barrels per day of decline mitigation that needs to be done before any new production can be added. And you see what was happening just before COVID, right here? Not after COVID, just before, right here, just before. We saw this flatlining because what ended up happening was that the decline rate had gone so high that all the rigs were doing was keeping it flat / growing 200, 300, 400,000 barrels a year, a very low decline rate. This is why the Rystad prediction that shale can get to 9 million in the Permian will never happen. Because if the Permian was producing 8 million barrels per day, the base decline would be 5 million. And there's no rigs that can bring on that much production per year. So if this was a conventional field, it would be a different story. but it's shale, which has heavy, heavy declines. And the higher you go, you see how the slope of the decline is getting bigger. You know, it starts off at this and then gets to this, and then a higher curve, and then a higher curve. Same with the growth slopes. It's a higher slope, and then a flatter slope, and then a flatter slope, and then an even flatter slope. If COVID didn't happen, this thing would have had the same thing and peaked right about here. But now that COVID happened, they lost 2 years of good acreage, decent acreage, and now it's just impossible to even grow production. We see the same here in this graph. The decline rate right here is so high that all this new production is doing is keeping it marginally flat. And this is data that goes all the way to August of this year. So it includes the 600 oil rigs, it includes all the frac fleets and everything else going on. And this is where we are with using up 4,000 DUCs that no longer exist, meaning now you got to drill these wells in order to keep this production flat, as they did in 2021 and 2022. You can see where I'm going with this. It's not as simple as just saying so many rigs add so many barrels. You have to look at decline rates and see what the incremental growth is on top of that. What else is happening? The late stage declines are accelerating. So the first year decline rates on these wells is roughly the same over the last 10 years, 8 to 10 years. The second year decline rates are going up. So imagine a well in 2017. We're trying to find out how much did that decline in 2019? Well, it declined this percentage. But these decline rates are accelerating, which means this decline that we're seeing is now getting more and more and more every year, because each legacy well, instead of declining at 5%, is now at 10%. Instead of at 15%, is now at 25%. Why? Because the wells are longer, there's more proppant. That's just the way shale works. The longer your well is, the higher the decline rates are going to be, at the benefit of early production up front, huge IP rates, initial production rates, but the declines accelerate. And we see that, and sometimes drastically. And it makes a huge difference, because if you have 500,000 barrels of 2018 drill, and it was declining at 15% versus 25%, that's an extra 50,000 for 2018. On top of that, your 2019 number is undergoing the same thing. Same with 2017, same with 2020. It all adds up to call it 200,000 barrels per day of extra decline every year. Well, now your 2022 and 2023 drills are just on this treadmill that's not only going faster, it's now on the incline 10 setting, and things are looking a bit dicey as to can they even maintain this production, let alone grow it. Right here, the shale decline rates in green. You can see here's your conventional wells, and this is Brazil here, this is Alaska, this is the Gulf of Mexico, and shale. People are using these decline rates to model shale. Absolutely incorrect. It's not even close to being correct. Conventional reservoirs behave very differently to unconventional reservoirs. Here's the same graph, a bit more zoomed in, and you can see how the 2022 wells are now getting, not only do they not have an IP rate that's good, they're now below the 2021 wells the entire way through. So it's not just that the initial rate was lower, so the well produces more in the long run. The initial rate is lower, and the well is producing less in the long run. Normalize. Let's normalize this for lateral length. So instead of per well, it's per 1,000 feet of drilling. These 2022 wells are basically the worst wells since 2015. That's how bad this productivity drop-off has gotten all of a sudden, because too much tier 1 acreage got drilled, too much production got brought online, and then they said, oh man, we have nothing left. It's all tier 2, tier 3, tier 4, and we don't have the rigs to make up for it for productivity with volume, like quantity of drilling. It's all tapped out. And this is where we are today, and why I'm so bullish on the death of shale, because the data is proving it month after month that productivity has not only hit a high, it has degraded in a way that really nobody predicted. It's below 2016 levels of degradation after all the efficiencies that we saw from 16 to 17 to 18 to 19 to 20 to 21. They now went backwards 6 years in terms of well productivity. Not a good place to be. The water production is also going up. When basins mature, they get more gassier, they get more water production. It adds to cost. The more water you produce, the more cost there is. You got to dispose it, you got to filter it, you got to get it out, you got to truck it out, you got to pipeline it out, etc. I will be talking about the Clearwater here, David, in the quite a few slides here down, but the Clearwater is more of a conventional reservoir, so it doesn't see these sorts of decline rates. And the acreage is much more fresh. It hasn't been drilled for so long, but it is coming up here in the Canada part. So water production, we see well productivity down 18% when we look at production per 1,000 feet in the first 12 months. So not just IP rates, we look at a cumulative production. Here's your lateral length. Keeps going up, your proppant keeps going up. This has been what fooled banks, what fooled investors into buying shale companies, because they said, we have the best wells. No, you didn't really have the best wells. You just drilled longer and longer and jammed more sand into it, which made it seem like you had good wells, when in reality, that was your entire playbook. Your actual productivity per 1,000 foot is down a lot, 18% since 2016. Normalized bilateral length, Permian only, and recovery at 12 months trapped. Here's another one, more closer look at the lateral lengths, keeps going up almost every year, and that was being shown as higher productivity. No, when you normalize it, things get a lot more clear. And we see the same here. Recovery at 12 months, normalized by lateral length, is down since 2016, flat-ish. Texas, once again, flat-ish per 1,000 feet, normalized. Okay. When we look at the EURs per 1,000 feet, and we go all the way back to 2016, here's the Midland Basin, 2016, and then it had some efficiencies, nice acreage being drilled, and now it's the beginning of the end. And I keep mentioning this comment because it'll take 6 months to a year for people to agree with this thesis. We invest, or I invest, front running these theses before these things become clear and obvious, because the data is all out there. There's no excuse for not doing the work and figuring out exactly what's happening here. Were people saying that shale is dead throughout 2016, 17, 18? Yes. Did they have the data to back it up? No. That's why I like to provide the actual data and the charts, no text at all throughout this presentation. The Delaware Basin, which is the better basin, the Leah, Eddy, Reeves counties, Loving counties, once again saw this huge uptick in productivity and then flatlined, and now it's fallen consistently below this 80 EUR mark. Something to watch. I would watch for further degradation here. Going forward, we'll see. Permian oil production. This is JP Morgan telling us what the actual real-time production is. And it seems to be going up a bit, mostly flatlining. But once again, this doesn't break out shale from conventional. There is a lot of conventional wells being brought online in the Permian Basin. And how much of that is in here, we don't really know the answer to that. But the main point is the growth has mostly flatlined here. We're still seeing a little bit of growth. Where's that coming from? Some of the rigs, some of the fracs that were done in March, April, May, June are now being brought online at a better pricing environment. There was a slowdown in wells turned in line June, July, well, not June, but August and September. Those are now coming online. And I really look forward to see this chart and where it goes, because I mean, this is your end all be all on US shale growth. And we'll discuss more here as we go. There's a lot of data I have to back up what's going to happen going forward. Permian supply. Let's look at the top 15 producers. So here we are. We have Pioneer, Conoco, and just look at the trends and what you see. This is 2017. This is 2022. It's all growing in 2017, 2018. They're all growing up and up and up. Look at the last 6 months. Pioneer is flat. Conoco is down. EOG is slightly up. Devon is down. It's actually down here. Diamondback declining. Oxy declining. Mewbourne down. Chevron flat. Endeavor big time down. You don't even need to really look at anything else except just look at the data. This chart will just tell you growth, COVID, flatline to a little bit of growth again, post-COVID, growth to declining in the last 6 months. This is the top 15 producers. This is probably 60% of Permian shale production, maybe more. That can be seen on this graph. And pictures tell 1,000 words. Share of US oil produced in the Permian, about 43% of US oil is in the Permian. And this is what's happening to it. Almost half of the US oil is in this state right now. The well counts by production rate. So more and more wells are completely shut in. More and more are ending up less than 10 barrels per day, might become economic or uneconomic. And a lot of wells are just getting to this below 100, below 50 barrel per day range, where they become a headache because they're declining. They have a lot of water production. They need a lot of maintenance. And there's hundreds of them for the wells, for the same oil that a one new well can produce. So they get less and less attention. They get ignored, and production continues to fall because there's just too many wells out there compared to where there were last year or 2 years ago or 3 years ago. The total wells has gone from 20,000 in 2018 to 40,000 this year. More wells, it requires more money, more time. The break-evens continue to go higher. People won't drill unless oil is a higher price. It's just how any formation works. And we'll look at some wells in the Midland Basin where a lot of the activity is, good wells. The IP24s are coming on at, 2,000 BOEs per day, 1,500 BOEs per day, 1,000 plus BOEs per day. But because the quality of the acreage is so degraded and not everybody has good acreage, the other half of the Midland Basin wells are not that good. Less than 1,000 barrels per day or BOEs per day, and some as low as 300, 400 BOEs per day, which we never saw before. The wells were all good because the acreage was all known. Now there's companies going out and drilling step out wells and riskier geology wells that are not panning out, further affecting oil supply. when every well was good, we could model production as X growth per this many wells. Now 5% of the wells are not panning out. This is going to grow to 10%, 15%. Eventually, companies will say, we're done. We're not going to waste $10, $12 million a well, Canadian dollars per well, drilling this junk. And we'll just stick to our core acreage, produce it down, blow it down, and move on. Same thing for the other Texas completions. Some of these wells are just not good. Like, these wells are just never going to pay out. When you spend $8 to $10 million Canadian on a shale well, and it comes on at 400 BOEs per day, your NPV is negative. It's never going to pay out. Unfortunate, but the reality. And we look at New Mexico, Delaware, really, really good wells, 4,000 BOEs per day. And then there's one that made 100 BOEs per day. So once again, these private operators are just drilling bad wells because they don't have the right acreage and they're trying to make a go of it. New Mexico, Delaware, same thing. There's one well here by Coterra, 6,000 BOEs per day. There's one well that made 3 BOEs per day. So we're seeing more volatility in the lower end because these 6,000 BOEs per day wells were always there. Devon was drilling them, Exxon was drilling them, but we never had these bad wells, which are now coming at, and everything makes changes on the margin. It's the 5% of the wells on the margin that are not panning out that are affecting the growth in the very, very, very short term. Here's the Permian Basin counties, New Mexico, Texas. For those who are not familiar with the area, this is the Delaware Basin. This is the Midland Basin here. So the Delaware Basin is mostly Leah, Eddy, Chavez, and Reeves, and Loving. What's the other problems? Let's talk about other headwinds in the Permian. Water disposal. The water disposal is getting massive. 1.5 billion barrels a quarter need to be disposed. And when you dispose it in this quantity, you create seismic activity. It's not fracking that causes earthquakes. It's water disposal that causes earthquakes in this area. And we see the earthquake magnitude is exactly where the Delaware Basin is and exactly where the Permian Basin is. It's not a coincidence. It's from the water disposal. Look at the Eagle Ford. That's exactly where the Eagle Ford Basin is. That's where the seismic activity is. So I always get a few people who say, you're completely wrong on this and the earthquakes just naturally occur. Well, how come they are exactly in line with where the oil production in the state is? Maybe one to think about. And how come the activity has gone up exponentially ever since they started disposing all this water? You know, the seismic events has gone up 7x in the last 5 years. From what? From water disposal. The entire Oklahoma patch got shut down because of this issue. They had a number of 5+ magnitude earthquakes. I think one was 6+, and the commission stepped in and said, nope, you gotta stop this, whatever's going on here. We cannot have these sorts of earthquakes happening. Here's your water disposal activity, and here's your earthquake activity. It's, no matter how you want to show it, it proves the point. And the Gardendale area has already stepped in and reduced volumes, blocked off wells. This area is relatively uninhabited, so not as much pressure on it so far, but it will get there when there's a big event in this Midland Basin or anywhere really. And it's only a matter of time. It's not that it may never happen. It will happen. It's just when. Because the more water you dump into these zones, the more you pressure them up, the higher chance that something fractures and overpressures. The water disposal wells, I think there's some shallow disposal wells, I want to say 6,000 feet. And then there's some deeper disposal wells like 10, 15,000 feet. But I don't know that for sure. So I can pull that data up I just don't have it right now. And let's see what's happening on overall activity. So biggest earthquakes in Texas ever. This is the top 20 list. 5 of the top 10 are in the last 2 years. 4 of the top 10 are in the last 1 year, including 2 of them, which were 4.9 and above. Okay. On top of that, 13 of the top 20 were in the last 2 years. 12 of the top 20 were in the last 1 year. What happened? Did something suddenly change that the seismic gods happened to get to this area? No. It's excessive water disposal off of 5 million barrel per day Permian that's causing these things. They're now getting in the 4.5 magnitude range. It's only a matter of time before a 5+ hits. And it's not that I want it to hit or I'm praying for anything. It's just, I look at data, that's what the data tells me. And the Railroad Commission in Texas is very lax, very lenient. But if something was to happen in the Midland, Odessa area of a 5+ magnitude earthquake, people would be not all that happy, even though it's their lifeblood, the oil in the Permian Basin. Inflation is also impacting the Permian. So 2022, we saw about 25% inflation. This is showing 45% activity plus inflation, inflation being 25%. Next year, almost all of the increase in CapEx is going to inflation. That's it. About 9% more inflation seen next year. Likely a conservative number. We'll likely end up 2 to 3x that number after a 25% inflation. And this is shale tight oil, is what I'm talking about. It's already being seen in the Canadian oil patch, in the Canadian shale basins. This is not just a US thing, this is any shale. We saw capital efficiencies and then a very conservative number for capital cost in 2022 that completely got ballooned out. Another 15%. Likely same thing happens in 2023. American shale and some of the lower quality Canadian shales. Rig day rates back to 2012 levels, 2013 levels, adding to inflation. Oil country tubular goods. This is steel in blue, and this is the tubing and casing in white. So the steel prices have come down, but the tubing and casing is just so backlogged. Pricing continues to rise, adding to inflation, adding to break-evens, suppressing the drill baby drill mentality. So before I kind of keep going here, once again, a reminder, anyone on the Twitter space that would like to join for the Zoom visuals, whitetundra.ca. And if you scroll to the bottom under events, you can join us for the visuals. If not, the Twitter space, I'll keep it running as long as it runs. So far, it's been good, but I haven't touched anything. It's an Android problem usually that these things crash, but so far it's been good. Fingers crossed. One more on gas takeaway capacity. You see the total capacity, effective capacity, and there's this bottleneck from late 2022 until mid 2024. There's a gas capacity bottleneck despite new pipelines coming online. The play is just becoming so gassy that they cannot get this gas out, affecting economics and affecting production and affecting development. You're not allowed to just flare whatever you want forever. There's limits on that, and there's times around that. And if you can't do it, you got to shut in production or reduce your development plans going forward. Okay, so we know this is happening in the Permian, but not good enough. I think we need to figure out where exactly is the growth coming from in these counties. The same way we looked at oil, big three, gasoline, diesel, jet fuel, and then we looked at the other products building. Just because they add up to be a balanced market doesn't necessarily mean that's the case. And that's what's happening in the Permian. Certain counties are dropping production and certain counties are growing production. And what we need to know is the counties that are growing production within that county, how far can they go? How much more runway do they have left? Because when they stop growing and making up for these other counties that are losing production, that's when you likely see a plateau and then shale production dropping going forward. So Leah and Eddy counties are the top two most productive counties in the Permian by a long shot. They also have the most wells these days because people go to productive areas to drill. That's where they'll drill, and then they'll move to tier 2, tier 3, tier 4 after. And what kind of acreage is out there? The public independents have way better acreage than the super majors, then the large privates, and then the other privates, which are your small scale private equity firms, have really, really bad acreage on a economic basis. Keep in mind, just because the wells are a little bit less productive, like 30% less productive, that really impacts your economics on a shale well. So public independents, super majors, and then the privates have even worse acreage. Okay, what about the portfolio mix? Who's drilling there right now? Very little of the public independents, mostly these large privates, which decent acreage, nothing great. In fact, in 2022 have the worst acreage, and then the other privates. So the public independents drilled a lot of wells in the last few years, and now it's moving on to the private companies who, this is their last hope. They need to drill Leah and Eddy County, jack up their production, otherwise the entire deck of cards comes crashing down. And okay, so this is Texas here in orange. You see how production is flatlined in Texas in the last 18 months? Here's New Mexico, still going up and grew a lot in 2021 as well. So I'm going to say Texas is the one that's flatlined / dropping, maybe slight growth, depending on where things go. And New Mexico is really the one we need to watch because that's your big growth factor. Here's Texas pre-COVID, roughly at the same number. Here's New Mexico, quite a bit higher, 15, 20% higher, 30% higher. Okay, so let's look at New Mexico. What's going on? We have Eddy County and we have Leah County. Both seem to be growing at pretty decent rates. The curve is flatlining a bit on Leah County, and Eddy County continues to grow, but it still has this flattening slope to it. Okay, let's look at the biggest producers in these two counties. Let's go right into the details, producer by producer, and figure out who can grow and who's the king sitting there without clothes on. So, okay, we have EOG, nice, huge growth. We got Devon, flatlining. We have Newborn Oil, massive growth, and then has slowed down here, flatlining. We have Exxon, doing pretty good. We got Conoco dropping. And then we have Oxy, Taprock, et cetera, et cetera. Okay, let's look at EOG. They did all this growth to get to here. Where are they? This is the entire Leah and Eddy County. Acreage in colored, and then the wells are this darker part. Okay, so here is EOG. They've pretty much drilled their entire core large package position here. They have these, there's still plenty of runway in these other areas. And then this is fringe shale. This is not good. This is way western, Eddy County, not that great. This is what you should pay attention to. This entire big core block is looking a bit drilled up. Efficiencies, the largest efficiency block is basically all filled in with this dark stuff. Okay, now we got Devon. similar sort of story. We have Conoco, or no, this is Exxon. They definitely have a room to grow here. But what has Exxon told us in the corporate presentations and the conference calls? They say, we're not going to grow. We're going to keep flat and produce this thing for 7 to 10 years. Smart, very, very smart. Because they know if they increase production massively, they don't have the acreage to keep that level going. So they're not going to make the mistake that EOG has done here, where they've drilled up everything and now they sit here looking for things to buy with this huge growth rate. Exxon is sitting here at this sort of production level since mid-2021, just going to flatline it. Okay. And then we got ConocoPhillips. Not bad. They got a lot of land, but a lot of it on the fringe as well here. And still some room, still some running room here for sure. They have quite a bit of open land actually. But they're doing the same thing. Conoco right here, keeping production in this 120 to 150,000 barrel range. Not interested to drill any further. This one is interesting. Tab Rock Operating, private company. It got to about 80,000 barrels per day right here. They had this massive growth spurt. Look for this color right here. Got this massive growth spurt. And let's look at Tab Rock's acreage here. Completely drilled up, completely. You can't even see the lighter portion of these lands anymore. I talked about this before in the presentation. Jack up production in 2021 and 2022 and try and sell. They couldn't sell. Now they sit here with a declining asset that's declining at 40, 50, 60% a year and nowhere to drill, with land here selling for $10, $15, $20,000 an acre. Bust. It's a complete bust, failure, because nothing can be done in this area. They might have acreage elsewhere, which is fine, but their Lea County acreage is completely done. And okay, let's look at Coterra. I believe it's Coterra. Let me see. Yeah, Coterra. Lots of acreage, lots of runway here. They're not really doing much. Lots of fringe land, which may or may not be productive. This is Chevron. Chevron, again, is doing the Exxon way. Drill a few wells a year, keep this thing flat, and produce it for a while. We don't want to jack up production and then run out of acreage. So where do we end up with? We end up with the big growth that's happened in the last 2 years is out of acreage. The companies that have acreage don't want to grow. They want to keep production at this rate for many, many, many years. Where does that put Lea and Eddy County and New Mexico going forward? A sharp flatlining / lower slope growth to it going forward. And this is happening as we speak today, where these counties might grow at 50,000 barrels per month for the next 3 months. Then it goes to 20, then it goes to 10, then it flatlines. And then it depends. If Exxon and Chevron can keep that production strong, Lea and Eddy can stay flat. And if the other companies that are running out of acreage, like this, can't keep their production flat, that is the end of the Permian Basin. That will be when you see not production flatlining, production dropping, because these two counties have been making up for the other declines in other parts of the Permian. So when these counties stop growing, even if they flatline or go to slower growth, the entire Permian as a basin of shale will start to flatline and then drop. And remember, well productivity was down in 2022. Doesn't mean it can't drop further in 2023. Nobody has said that it's going to stay here at this range. Well productivity could drop further, and with the same amount of rigs, you see the correlation I'm trying to make here. Okay, let's look more at a cumulative, what's happening in the entire county. This is Eddy County, rate versus time, unnormalized. Productivity dropping. This is the same thing normalized by lateral length. The lowest productivity we've ever seen 2017 onwards. So it's at least less than 2017 productivity normalized. This is cumulative oil versus time. See how 2021 looked like the wells were good for 6 months, and now they're really falling behind. 2022 might be an absolute catastrophe here. Depending on how these wells pan out, there could be some major reckoning coming up. Let's look at Libyan County. Unnormalized, it's looking bad already versus 2021. When you normalize it, once again, the worst wells since 2017. Cumulative versus time, the 2021 wells aren't too bad here, but the 2022 have completely gone off that chart. Why is that? Because the private companies and the other majors that are drilling up their acreage are now moving to worse and worse and worse Leah and Eddy County acreage. And the private companies are now drilling complete trash. They're just looking here to hang on and try and keep production flat with the minimal acreage they have. And they're out here drilling really bad wells that are not panning out, that may never even pay out. And the beginning of the end of the Permian right here. Okay. So there's a question here on, would you consider shorting these companies? I don't think I would short any of these companies, because if oil prices go to $120, I mean, all these companies are still going to go up. Now, I know it's a pair trade you're saying against another company, but I don't short anything. I think it's just a risky thing to do, because what could happen is you might short it, and then somebody might say, oh, at $120 oil, if we can get it for cheap, 3 times cash flow, we'll just buy it. And then you end up getting a takeover at some higher price, or too many dynamic variables with this sort of thing. But it is a way to hedge yourself, I guess, if you would like, but not my way of doing things. And it's not just me saying this. This is Enverus now has figured out the same thing in the Delaware Basin. So don't believe me. Believe there's other people now saying, we not only have lower IPs, the declines are way faster than these older wells. And that's where we sit today, with people telling me that shale is going to grow 5 million barrels per day in the next 5 years. Not if you put the work into it and really look at what's happening, unless there's some sort of technological miracle with CO2 injection or some other refrac method. There's no way, there's not a chance anything like that happens. Even with those technologies, it's just very difficult to get those working in a shale reservoir. And where do you see companies panicking? You see the Firebird acquisition that was done about a month ago. 2P reserve value at $80 WTI was paid for that asset. Howard County was it, or Ector County? There are companies trading elsewhere, non-shale, for less than 1P reserve at $70 oil. So companies are panicking and saying, oh my God, our production is dropping. We can't have this. They'll go and buy something, overpay for it. And now all they do is now the entire thing starts declining. So even a little bit of inventory is worth its weight in gold these days. Even if the wells are not all that economic, it's about keeping production flat and not having this massive drop off that's going to spook investors. Obviously, if your production drops 10% in a quarter, people are going to be really worried. Here's Shale innovation. All they did was fool investors with just drilling longer and longer and longer wells and made it seem like productivity was increasing. But when you normalize it, there's a big problem here on an overall basin basis. Okay, and this is not just happening in the Permian. Here's your Haynesville, your gas play. These 2022 wells are so bad. The IPs are worse, and it's still below the other wells here. Same thing, just drill longer and longer, jam more sand into it. That's all the innovation that they've done. And it's now hit a point where the acreage is not good enough and the diminishing returns has started to come in, where you're not getting any benefit. You might be, in fact, going backwards by drilling them too long. Okay, so what time is it? 3, okay. Look at the Eagle Ford. I'm not going to spend too much time on it. The same thing. High growth when the production was low. High growth, then it started flatline, then the lower growth formation, and then the eventual decline. The perpetual decline into perpetuity because they don't have the acreage and the production is just too high to maintain at this level. This will continue to decline into the future. Okay, Eagle Ford production, this was 2019. We see some growth here, but again, flat line and then back to its flat to lower cycle. There's no indication that this will increase over this 2019 level. It was already flat in 2019, and now they've used up 3 years of more acreage and inventory to get to where we are today. Once again, a lot of wells going to this less than 10 barrel per day range, where they become a headache to operate, to less than 25 barrel a day range. There's very few wells left in this greater than 100 barrels per day range, call it. Yeah, in fact, almost nothing, only these 3. Same chart, just represented a different way, more accurate or more updated 2022. Look at these, the number of wells under 10 barrels per day, getting more and more and more and more. And these under 0 barrels per day, the suspended and abandoned wells, getting more and more and more, maturing, declining asset bases. Same thing here, just like we have Leah and Eddy County, we have DeWitt and Karnes County. So companies in these counties are going to do good, naturally. They are good counties, but it's, can they make up for the declines in the rest of the Eagle Ford? That answer is no. And we're seeing a 5-year advancement of where the Permian will end up. Keep in mind, the Eagle Ford was not overcapitalized the same way the Permian has been. So you might see a lower declines on it as a basin than what will end up with the Permian down the road. And with these sorts of counties, you get different well results. Just because Conoco and Marathon are drilling good wells in the Eagle Ford doesn't mean that the rest of the acreage is good. It just has to do with their specific company. Permitting data, not bad. We're seeing permitting come up to the 2019 levels, indication of future activity, but nothing that's showing us it's going well above. And in fact, it's still quite a bit below, maybe 10 to 15% below the 2019 levels. Once again, top 15 operators, the graphs tell you the story. And what's happening here? Flat to declining. This was your final hurrah at growth. COVID, flat to declining. Not a single company here that's showing any signs of growth in the last 18 months. Here's your Eagle Ford, Karnes, DeWitt, your core, and then the rest out here. Production by county. just more of the same, that there's certain counties that are really pulling the weight here. And once they start to degrade is when the problem amplifies. Bakken, almost a similar story. High growth with the growth rates flatlining. 2015 was the crash. The next growth cycle is even less per year. And now it goes into this flat to declining phase. Bakken oil, almost no growth. It's basically flat, all the way since where it went to in 2020. Summer of 2020, we're basically at the same oil production level. Decline rates are accelerating. This is not just a one-off thing in the Permian. We're seeing this almost everywhere, where it's the entire US shale that is beginning to get into this terminal decline phase going forward. Bakken, okay, again, some operators do have good acreage, Devon, Marathon, Conoco, Enerplus, etc. But the vast majority of it just degrades so fast in the quality that the rest of the people have. Hess, Continental, and Whiting, big producers, have middling mid-tier acreage, is what's left here. As you see, the thickness of the bar represents the number of wells drilled, and the length is the average productivity in 12 months. Gas oil ratios rising in a maturing acreage basin. This is only till 2017. This continues to go higher as the basin degrades and matures. The Permian is not new. We have some data to tell us what's sort of going to happen going forward. Bakken wells, 2022, not too bad, not too bad. The productivity is actually pretty decent and hanging in there. Why is it hanging in there? Because it wasn't overcapitalized like the Permian was. They figured we can produce the Bakken at 1.2 million barrels per day for 10 years. If we overcapitalize it, we get this decline rates on the entire basin. That's what's happened in the Permian and will be the big unknown factor as to how fast does this decline really happen once we move to tier 2, tier 3 acreage and higher decline rates in late stage. Bakken, top 15, almost a similar story. There are some growth plays like this Grayson Mill Energy, and I think Continental, relatively flat, nothing really happening. It's a big change since 2018. When people would say shale is dead in 2018, and you showed me the left side of this graph, it doesn't really add up, does it? How can you say shale is dead when there's all these companies growing production? Can you say shale is dead now? The shale growth? At least there's some data and pictures that back up that statement with more legitimacy. Bakken, inactive wells are growing, abandonment liabilities are growing. Watch for your companies, see what their abandonment liabilities become with these shale wells as the basins mature. This is the Bakken right here. So if you thought the Permian was drilled up, this is the core of the Bakken. Each line represents a horizontal well. And acreage tier degradation, there's only about 700 wells left in the top tier on a 5-tier system. And about 60% of the remaining well bores are in the tier 5 category. That's just how these basins are. And people are drilling this right now, trying to keep production flat. Eventually they're going to run out of this. And we move into this very, very high decline rate, high water cut, high gas oil ratio, could even be just gas wells range. That's what's coming in the Bakken. these are infill drill wells, I believe, so not the best ones to use, but as they keep drilling more and more of these, 81% decline in 11 months. That's how difficult it is to keep these wells and the basin flat. When you have such a high decline rate, you got to drill so many of these, and there's not many left to begin with. Gas oil ratios in the Bakken, the new wells, not only are the old wells becoming gassier as time goes on, the new wells are way gassier to begin with. So the entire Bakken has gone from 15% gas in terms of BOE to about 30% in the last 9 years. Okay, so there's a couple questions here. You betting against Russian oil dropping, oil price increasing? Yeah, I really haven't even talked about Russian oil dropping in my thesis. More so it's an overall supply issue against a rising demand at a time of low inventories. Yes, I do think some US companies are looking in Canada. Yes, I know for sure, in fact, that they are. And there's going to be some massive acquisitions here that are going to be fun. It's going to be fun because it's going to bring value back to the sector up in Canada. And it's going to have Canadian companies re-rate a little bit to where their US peers are trading as time goes on in this cycle, I should say. Okay, few other things to watch. Just because some US societies said the entire thing is prolific, doesn't mean it is. There's an economic commercial zone in every basin, and then there's other areas. Is somebody going to drill this at $500 oil? Yeah, probably, but it's not going to happen until we get there, and we're not anywhere close. EOG wells. The longer you drill these wells, as we saw in the lateral length discussion, you might get better rates, you might get better per well economics, but you end up recovering less oil per foot. So the 2-mile wells, you can see, are about 20% lower recovery per foot. What that means is that the reserve life of a certain acreage is even lower because you're recovering less oil, leaving more of it in the ground. And there's companies going up to 3 miles of lateral length now. So just look at 3 miles will be somewhere like this, and a lot of stranded reserve in the ground. This is a private company that did the exact same thing in Canada as what the private companies in the US did. Drill these massive wells to show huge IPs. Nobody fell for it. They didn't get bought out. And now the wells just died and are very, very poor wells compared to even the 2020 and what are we here, the 2018 wells. Huge loss in acreage quality and poor production operations because they were looking to jack up production rates and sell. Didn't happen, and that affects the reservoir and productivity of that well once you weren't able to sell and you overproduced it in the first 6 months. Productivity is dropping in the privates, in the publics. This is a 6-month oil cumes normalized for lateral length, and we see the privates have worse acreage in just about every basin. And if they're the ones doing the drilling, the ones that are adding growth, not doing a very good job because they don't have the right acreage to drill those really, really good wells. Almost twice, like 100% lower quality, or the publics have almost 100% better acreage than the privates in the Eagle Ford and certain other plays. And what is this here? So when we look at the public companies where their acreage is, it's in the core of the Delaware. Look at the private companies, they're on the fringe edges where they're trying to make their money here. That's where the difference in acreage quality comes in. Same thing in the Eagle Ford. We talked about Karnes and DeWitt County right here. The public companies are in the core. The privates are on the edges. and no longer an impact, even if they go drill, baby drill, which they can't because they can't afford it and they don't have the acreage anyway. If for some reason they decided to do that, their wells quality is so bad that it doesn't make the impact it did a few years ago, I guess. 6-month cumes in the Eagle Ford. See how the public companies are just way better. And the public companies don't want to drill. They just want to keep production flat or let it decline and make cash flow, pay back debt, pay dividends, share buybacks. That's the mantra going forward. Yeah, so thoughts on a company like Range Resources that have this. So any company that tells you they have so much reserve and so much resource, yeah, they might have it, but is it economic? Is it commercial? At what price? Is the break-even number they're giving you on 10% of that reserve, or is that break-even across the entire reserve? These are questions that I would ask these companies or try and figure out, because there's bazillions of barrels of oil everywhere, but at what break-even price and how much of that is recoverable, and what are the economics around that? That's really what makes a difference to running those sorts of numbers, because it's not like we're going to run out of oil, but people will just have to pay more for it. And that's what we as investors look for. We don't look for a product running out. We look for supply-demand imbalances and people having to pay more for those things into the future. So who's added the rigs? It's been a lot of private companies that have been adding rigs in the last 18 months, and their productivity is lower, which leads to some of these issues we're seeing. And let's look at some of the major players and what they're saying. This is Exxon. They just reported last week, liquids production US, almost no growth, 2% growth in 12 months. Chevron, they were at 888 in second quarter of 2022, 891 in third quarter of 2022, 3,000 barrels per day. That's it. Chevron, the one that I showed you, has the biggest remaining Leah and Eddy County acreage. Exxon, that has biggest remaining Leah and Eddy County acreage. Very, very disciplined. Mewbourne, one of the top oil producers in the Permian, private. This big growth cycle and then flatlining now. I don't have the latest data, but they are flatlining, which we saw in that top 15 producers list. Same with Endeavor, this big growth and then slowing down here. Exxon as well is playing tricks with investors. They'll say their BOE is increasing, barrels oil equivalent. So October 2019, they had 210,000 barrels oil, 110,000 BOEs gas, 66% was oil. In just 2 years, a lot of their growth was in the gas, not in the oil. So their BOEs may be going up, but the barrels of oil itself are flatlining and could possibly start to decline here going forward. Companies are slowly agreeing with this thesis. They will not do it at once. They will do it slowly. US overall production, per well productivity, they are revising them downwards 10 to 15% in some cases. Oil mix is going down, is being revised down because the plays are getting gassier. I don't need to wait for Goldman to tell me this. I don't need to wait for JP Morgan to tell me this. I don't need to wait for Rystad to tell me this. The data is out there as to what's coming. And we have the analysis to understand that and really invest according to that before it's mainstream and out there. Same with overall production numbers slowly getting revised down as time goes on. 2023, 2024, 1%, 1%, 1% at a time, which is about 125,000 barrels going forward. Look at the growth. They're already saying the growth is only going to be 400K per year in the next few years. So gone are the days of the 1 million barrels a day growth like just forget it. It's never going to happen again in the Permian or anywhere else in the US at this point. Big companies, rigs, strong capital discipline across the board. Nobody's out here drilling like crazy. Exxon, way less rigs than they were running in 2019. Other majors, Shell, BP, Total, Eni, Equinor, Repsol, OMV, and Galp. We add all these up, they're about 12, almost 13 million BOEs per day between these companies. In 2022, they are going to be flat at the end of 2024. Say goodbye to any growth from these companies. So where does that take us? BP, Thunder Horse production, offshore Gulf of Mexico, declining. It's not even meeting their own internal estimates on production. Oil is getting harder to find. The oil that is being found, people are running models on it as if it's top tier acreage. It's not. If it was top tier acreage, it would have been found and drilled earlier. So we're seeing hard decline rates, more problems, more water production, more issues, even in the Gulf of Mexico conventional reservoirs. But that is really where the growth is going to be, is deep water. This is onshore LNG, this is onshore, this is shelf, so continental shelf, deep water and ultra deep water are the ones that are getting the projects going forward. So that's it on shale. I think I've made my point. Now we'll look at the rest of the world supply, what's happening in the rest of the world. So growth will be from the offshore, growth or production decline mitigation in a way. The Gulf of Mexico is a nice one because they have a lot of unutilized capacity. So the floating platforms and the pipelines, they do have a lot of capacity. Some of them are running at 20, 30, 40% of their capacity because things have declined so far. So if anybody's looking to make some investment, it could be a good place for some of these companies to go and tie in wells to existing platforms. That being said, the geology has to be there. You can't just use up platforms when you don't have the geology to produce into that. But it is getting some action and it's getting more expensive. Both drill ships and semi-submersibles are getting very expensive, about 40 to 60% higher than they were pre-COVID. So it is going to stunt the capital allocation in the near term. And likely these rates continue higher because there's just not enough drill ships out there or semis out there compared to what people need. Yeah, great question, Mark. So I'll be answering this exact question over the next hour, I think, with the rest of the countries. So the US has become a crude exporter, net crude exporter, crude and products exporter, and it's a shifting dynamic. The US used to import crude and products. Now it's becoming a net exporter, which means the world, A, is relying on the US, and B, the world wants this. The US is not just pumping stuff out into the ocean to store or into random countries and shoving it down their throat. No, the world is wanting this oil and products. That's why the US is shipping it out. So there's such a global pull on the US, which makes this even more of a problem because the world thinks the shale can grow 1 million barrels per day and feed this global economy. May not be possible. And one of the big reasons people are not happy with how shale has progressed, because America has taken its energy security of shale, overcapitalized it, and sent it across the world to other countries to use. Doesn't seem like a very smart thing to do from an energy security and energy resource standpoint going forward. At the same time, companies have stopped investing in CapEx. They're interested in dividends and buybacks and debt repayment. Annual spending is down big time from about 800 billion in 2013 and 14 to 400 billion, 500 billion for the next few years, not projected to increase. It's expected to stay in this range as capital discipline really is strong in this cycle. This time is different, is real. We have never seen this much capital discipline in any cycle ever before. Share of spending, it's not going into CapEx, it's not going into R&D, it's going into dividends and buybacks. Another tailwind to a higher for longer environment going forward. The same point in the past, as the price went up, the CapEx started going up, 1 for 1 almost. And now we don't see it. The oil price is going higher, the CapEx is lagging. This is what I like to see as an oil investor. Same thing, CapEx is 3 times or was 3 times larger in 2014 at that price of oil than it is in 2020 or than it was in 2021. And just because CapEx is going up doesn't mean supply is coming online. There's a lot of inflation and exploration work to be done that doesn't lead into direct supply being brought online. Because we haven't invested in exploration for 8 years, that money now has to be spent without it directly leading into production. Now, we saw this, like the I3 Energy well that came out dry. CapEx was spent, nothing came out of it, not even a future development plan. And because of this lack of exploration and development capital being spent, there's about 10 million barrels of oil production that has been lost that could have been online by 2024, but because the money wasn't spent, because XYZ person said oil is dead forever, nobody spent that CapEx. Now we don't have that oil. Almost 10 million barrels per day of missing oil supply because nobody spent the CapEx. And Shale came in, overcapitalized, dropped the market. Nobody's going to spend anyway at $40, $50, $60 oil. Supply response. Here you go. This time is different right here. Energy CapEx as a percentage of operating cash flow. Relatively in the 50 to 100% range. Every previous cycle, it's now in about the 25% range. Nobody is spending CapEx. They're all worried about debt payback, dividends, share buybacks. And exploration problems bite because of this. You have oil being discovered, gas being discovered, but the reserve replacement ratio is less than 1, which means if you produced X amount of barrels in a year, how much of that did you add in new reserves? Well, 2021 was 0.15. 2018 was 0.35. So for every barrel produced that came out of reserves, you only added 0.35 of new reserves. Not a good place to be into a undersupply going forward. If there's no reserves to drill, even if you have the money, you don't have the reserves already discovered to go and drill them and produce oil. So the cycle is just going to take longer as people explore, and then they make plans to develop, and then that development comes online multiple years down the road. Same graph showing you all the way back to 2000. Green is the oil discovered per year in new reserves. You can see how it was not too bad in this 10 to 15 billion, I think it was barrel range. And now it's in the 2 to 3 billion barrel range. Yeah. 10,000, yeah. Okay, so this is a different point on that same concept. So it's never been that the prices have been high because we ran out of spare capacity of oil. That's not how the system exactly works. The prices get high because the spare capacity gets lower. It gets to below a 2% safety net range. Where are we headed now? We had high spare capacity 2015 to 2019, and we're now headed back into this low spare capacity. This is 20 billion barrels that was produced, I believe, 20 billion and 40 billion. Either way, there is very little reserve replacement going on. And now we're running out of spare capacity. Spare capacity doesn't have to hit zero for oil prices to spike. They have to hit below this range where people are comfortable with how much excess oil is sitting out there. And we look to be headed back there. 2022, 2023 looks to be about that 3%, 2.5% range. And then 2024 is less than 2%, which brings us back where we were in this $100 plus oil environment, 2010 to 2014. Okay, I think, what time is it? Okay, we'll do a few more slides and then take a break here as well, because we are quite a bit into this right now. Finish up the supply part and then, yeah, maybe end it there or take a break there and then continue on. Would you say reserves and break-evens on production rate are one of the biggest factors? Yeah, 100%. It's getting expensive to explore to begin with. It's getting expensive to develop stuff. And the volatility is just not conducive to somebody doing some sort of investment on a long-term supply basis. But when I look at my investments, I definitely look at reserves. How much reserves does this company have? And then what's the decline rate on it? If it's a huge decline rate, not the best place to be in a high inflation environment, unless they have huge amounts of reserves. So it's not a one-size-fits-all answer. It's more of a reserves plus decline rate plus break even in a certain sort of factor. Okay, so the way that conventional oil works, conventional oil today is about 60% of the world's production, non-shale, non-oil sands, conventional oil. And the way conventional oil works is when you hit about half of the recoverable reserves, you go into a terminal decline. So you produce about half of what your recoverable reserves are, you go into this terminal decline. You might be able to keep it flat at the top rate for a few years. And when it declines 40, 50, 60%, you can add some water flooding, some infill drilling, etc., and keep production slightly flat, but not at the peak range at all. We saw this with US conventional oil. This is the Hubbard linearization curve. We produce about half of the reserve and into the terminal decline from the 1970s onwards. Okay. Let's look at Ghawar field, the biggest oil field in the world that the world has ever seen. It was producing over half of Saudi Arabia's production for many, many, many years. And because this field is so prolific, they kept it at this 5 million barrels per day range for many years, 20, 30 years. And then it started to decline because it produced more than half the recoverable reserves. So this was about 2000. In 2019, when the Aramco IPO came out, they said Ghawar was producing 3.8 million barrels per day. So we take 3.8, bring it across, and roughly 2016 to 2020 range. The latest number puts it at about 3.2 million barrels per day. 3.2, bring it across, about 2021, roughly. These fields that were producing at this 5 million per day range for decades are now in terminal decline. This is the Ghawar map. The red is oil dots, oil wells. The blue is water injectors pushing water into the oil wells, into terminal decline. Okay, it's not just this field. Almost every field in Saudi Arabia is in the same maturity level of its life cycle. Almost 10 million barrels per day are in that phase of decline. Now, we have a Hubbard's curve on a US conventional type of field. We don't have a Hubbard's curve example on a field of this sort, like Gawar. And if the production declines on this 10 million barrels per day in its late stage of a field like this are 5% instead of 4%, or 6% instead of 4%, that's an extra 200,000 barrels a year. Compound that over 4 or 5 years, that's 1 million barrels per day of extra decline that the world has not baked into anything, because we don't have the data. We don't know what the actual decline rate on these things is once they get to a certain point. Add to that other fields in the area in the exact same situation. Burgan field in Kuwait is missing targets every single year. The production has never recovered from the shutdowns that they've done. And it just continues on this decline down to 2.4 million barrels per day in 2021. It has recovered a bit, but terminal decline, very hard to maintain because you've already produced at this max rate for decades. So there's a different way. There's a different way that these fields will behave, possibly, that could lead to higher declines because you produce so much of it already. By the time they get to the terminal decline, even though it's half of the reserve, they've been pumping away at these rates for way longer than American conventional did. It all leads to this: OPEC Plus is yet to restore pre-pandemic output. So we hear this everywhere. The graphs show it, that the OPEC Plus in September was still not where it was in February of 2020. And terminal declines. You can't just say we're going to get back to this rate, because that's not how it works. If you're in terminal decline, you will decline in 2020, in 2021, and in 2022. Other than the new fields that are being brought on, which are very few, other than UAE and Iraq. And we'll discuss all these countries here as we go on. OPEC Plus rigs, they don't seem to be in a drill baby drill mood either. They seem to have about 275 rigs going in OPEC Plus compared to 425 pre-COVID. So a very slow drilling atmosphere, a lot of missed quotas. The only countries that are meeting their quotas are Iraq, barely, or that can meet their quotas are Iraq, Kuwait, Saudi Arabia, and UAE. Really, those are the main ones. And Iraq is basically tapped out, Kuwait is basically tapped out, Saudi is basically tapped out. It's UAE that's really the one with spare capacity, actual sitting in their productive capacity. OPEC land rigs, down. OPEC offshore rigs, down. This is not just Baker Hughes, but also Morgan Stanley's other research as to what they're finding from OPEC. The OPEC Plus supply overall, the last 2 years, it grew as the quotas came off, and now it's relatively flat for the last year and a bit. So anybody looking for OPEC to keep adding barrels, not going to happen. They just don't have the capacity. And we almost saw it here when they came out and said, we're going to cut this much. Yeah, some of it was them proactively looking at where the market's headed in terms of possible demand destruction, recession. Very, very proactive on that, but also a little bit of, well, hang on a sec, we're producing at levels we've never produced before in Saudi Arabia and Iraq and Kuwait. We don't know if we can maintain these levels, and we need to cool down a bit. It definitely helps them on a production capacity standpoint to also reduce their production, because they probably wouldn't have been able to maintain it anyway. OPEC crude loadings, once again, relatively flattened out over the last 12 months. Products are going up. So some new refineries in the Middle East area, they have been exporting more products. Some of it could be resold Russian products. So let's not ignore that point. There's definitely possibility, but overall, crude plus products are roughly flat out of OPEC plus Middle East. Condensate, crude and condensate loadings are down. They never got to their pre-COVID level. When we look at OPEC plus as a whole, it's down big time. With Saudi Arabia and UAE really maintaining their production, the rest of OPEC plus is just down. So Shale can't do it, America can't do it, OPEC plus doesn't seem to be able to do it, which is about 30 million barrels of global production, is not up to the task of increasing supply to where the demand is headed, as we discussed earlier. Saudi production, they've never maintained this level ever before. So definitely some questions being asked as to how much they can really produce and what do the numbers end up at here as time goes on. Are they willing to produce at 11 million for more than a few months and show us if they can do it? Well, they seem to have tapped out early on this round. We'll see on the next match what happens. And power sector demand. So Saudi has a lot of power generation from fuel oil. So they were burning all this crude burn and diesel and whatnot for their power gen. And look what it says. The demand was satisfied by fuel oil imported from Russia. So they're importing fuel oil and then burning that and then exporting crude. So is their true productive capacity really 11 million? Or did they just get lucky with collecting Russian fuel oil and getting to export more oil per se and show it as production? One to ask. Their upstream investments are also going up. Oil is getting harder to find. Oil is getting harder to produce. It goes from 30 million or $30 billion a year to about $40 billion a year for the next 3 years, possibly even more, because we don't know these numbers in 2024 and 2025. So they themselves are saying, look, to maintain the same productive capacity, we're having to increase our CapEx 30 to 40%. It doesn't translate to direct increased supply. It goes into decline mitigation, exploration, getting new terminals set up and infrastructure set up may not translate to actual increase in supply. And that's a lot of money, $40 billion a year. And this is what they're saying the money will give them. They have 12 million productive capacity today. Questionable. Never got even within 1 million barrels of that on a sustained period. And that was 2019. 3 years down the road, there's some declines on those 12 million barrels, which isn't really put into here. They're saying 3 new fields are going to come online: Zuluf, Marjan, and Berry at these rates. We just saw what happened with BP Thunder Horse, where the newer and newer infrastructure and production fields that are being brought online are declining much faster than the older proxy analog fields. So we don't know what the surety is around these numbers, nor do we know this, Safania and others. And then we have decline rates here built in to the calculation, and they get to a productive capacity of 13 million, which is what you hear in the news. Saudi is going to have 13 million of capacity by 2027. Well, number one, they've never produced within 1 million barrels of the capacity. So it already gets brought down to 12 as their max production. Next, decline rates on existing production. There's a big question mark if those decline rates end up higher. And the third thing, these new fields coming online may not come online at these productive capacities and may have higher decline rates to begin with. So we end up with Saudi saying they can get to 13, but multiple question marks around it, and possibly they never even hit 12. But we'll see going forward. It's not enough I should put it this way, it's not enough to have an impact if global oil demand goes up by 5 to 7 million barrels a day in the next 5 years till 2027. A lot of question marks. They're also raising their OSPs, so they keep charging more and more compared to the dated Brent or the other contracts for their oil, because they can. Because the global oil supply demand is so tight on a physical barrel that they can charge $5, $6, $7 above what the other blends are trading at and still sell their entire export number. Should give you a hint as to physical market, paper market. One can't be manipulated, one is being manipulated. Russian oil production plans, we discussed this earlier. Russian oil production was expected to grow till 2025, 2026. We can say goodbye to that. Let alone growth, this thing might decline majorly going forward. So there's another 10 million of possible supply that is not increasing production. North Sea, this is your offshore UK, offshore Norway. In its terminal decline, in its flatline phase, we saw the Johan Sverdrup platform come online a couple of years ago, which helped a little bit, and back into its terminal decline phase. It's going to drop from 3 million barrels today to about 1 million barrels in 2040. About 100,000 barrels per day, or per year of loss of supply. The UK is also putting on a bunch of windfall taxes and other taxes. It's going to further stop supply in this part of the world. This is the topmost prospective wells in the North Sea that was created. So they said, okay, these are the top prospective prospects for biggest oil discoveries, for most impactful reserves. Almost all of them came out dry. This, I believe, is from 2019. And the wells were drilled after that. Almost all of them came out dry. So it's getting hard to explore for oil. No random mom and pop company can go and do offshore drilling. This is a big boys game, and they're not finding much success other than certain parts of the world. The North Sea, not finding success. And if they are finding success, the average discovery is just so small that it's not impactful. In the 1960s, in the 1970s, in the 1980s, the average discovery was about 100 million standard cubic meters of oil equivalent. Now in the North Sea, less than 10. The easy oil is gone. It's gone, it's been explored, it's been produced, and it's gone into thin air. That's how oil works. Once it's consumed, it just disappears. There's no recycling on oil. Norway supply, a little bit more on the oil. You see the Hubbard's curve here. Green is oil. It hit its peak, it went to terminal decline, and now they can keep it here for a little bit, and then it goes into another terminal decline phase going forward. Norway has also missed its production budget target every single month. 9 out of 9 months, they've missed the forecast, and the production is less than 2021. Some of it has to do with gas reinjection no longer happening. Some of it has to do with the same BP Thunder Horse story, the same story across the world. They're using decline rates from better, more prospective acreage and production and slapping it onto these new drills. It doesn't work that way. When the drills are less productive, the reservoir is not as strong, the decline rates will be higher, you're going to miss production targets. One thing that very rarely gets talked about is that a lot of new big fields coming online are missing production targets month after month after month, year after year after year. Reserve replacement in Norway, under 100%. Gas, almost every year is under 100%. Some of it's negative. When the reserves were put as reserves and never ended up being productive. Mexico, a big conventional producer, they lost their Cantarell field to nitrogen injection issues and declining, terminal decline. Another big producer, about 2% of the world's liquid supply. This is what happened with Cantarell. Overproduced, over injection was done, and the complete reservoir just collapsed. Once again, we don't know how these fields are going to decline because we've never been through it before. So certain things could have a permanent damaging impact on this oil that nobody is even thinking about at this moment. This is the entire conventional oil of the world. It hit a peak and it went into terminal decline. It's the exact same story on all these countries: Germany, Romania, Indonesia, Egypt, Syria, Malaysia, Argentina, Colombia, Ecuador, UK, Australia, Norway, Brazil, Angola, China. Conventional oil hit a peak when it was projected to. It's the other oils, the shale oils and the oil sands, that have stopped us from hitting peak oil in the last 20 years. It's not conventional oil. Brazil, one that's been touted as a big growth producer. Yes, they are growing, about 3 million barrels per day as we speak. But they've also continually missed their targets. Every single year, they miss their production numbers. A lot of exploration has left Brazil because they aren't hitting these sort of wells they would like to. And we see this here in Latin America. The rig count is way lower than it was in 2010 to 14, when this growth phase really happened in Brazil. West Africa, not in a good place at all. The shortfall was 600,000 barrels per day in 2021, and it's projected to be a 650,000 barrel per day shortfall by 2026. So all this production they lost during COVID, it permanently got damaged, and forecasts were all adjusted downwards in all of West Africa. When we take forecasting to reality, we look at Vortexa once again on actual crude loadings, you can see the terminal decline. You don't even have to really think about it. It's right there. Okay, before I go into areas where growth can actually happen, new supply can happen, I think we'll take a break here, and we're about quite a few hours into this, so I believe there's about 80 or 90 slides left. So let's take a break here and we'll reconvene at, let's say 5 minutes past the hour. There's a bunch of slides on where supply can actually increase. We've talked about places where supply is not going to increase or is declining. We'll talk about where supply can increase. And then there's about 40 countries, maybe 20, somewhere to 20 to 30 countries, where I will show you graphs from those exact countries and their production and why they are no longer candidates for growth. We'll talk about Canada quick, and then we'll go into a bit of global macro, few things on things that are being misrepresented, I think, out there. And we'll finish it off with a little Q&A session and leave it there. So yeah, let's get back at about 5 minutes past the hour here and continue on. Okay, off to the power hour here, I think. Quite a bit into this, so we will get started. Once again, for anyone on Twitter that would like to join for the Zoom visuals, whitetundra.ca. If you scroll to the bottom under events, the Zoom link is in there, and you can join us. And we will get started here. So there's a question here, Seppo. It's a great question. I think one that the answer may be a bit conspiracy type, but for many years, the OPEC reserves have just been put at the same number, despite them producing those barrels. So I almost wonder, like, reserves is not an exact science. There is a lot of subjectivity around it, and you almost have to wonder that how much of the reserve is really recoverable and how much is a recovery factor being put in, just making a prediction about the future that may or may not occur. So I don't really know if I have an answer to your question, but I think some of it is yes, because they don't overproduce these fields either. They would rather keep them at a certain level for 20, 30, 40 years, as opposed to a higher level for less time. But I'd be happy to discuss this on a future Twitter space, because I think many people have differing opinions on this exact question. For those who can't see the chat, the question was, why is it that OPEC produces, or why is it that non-OPEC produces twice the rate of OPEC barrels per day, but OPEC has twice reserves as non-OPEC countries? So definitely one that's interesting. But there's a lot of gray area around reserves and what it really means going forward. So okay, so we'll get started. So some of the countries that can increase supply. So Guyana, a big frontier, one of the big booms of offshore exploration and development in the last little bit, producing somewhere around 360,000 barrels per day right now, and projected that they can hit about 1 million barrels per day by 2028. Exxon just made 2 new discoveries. I believe that was last week that was reported. So very aggressive growth plan in this area, and it can add 1 million barrels per day in the next 5 years. Yes, not add. It can get to 1 million barrels per day in the next 5 years, which puts it at roughly 150,000 of increased supply per year. So not huge in the grand scheme of things. It is a country that's very small, so they will get a lot of benefit from this for sure, and definitely brings material supply on the market. However, if global demand is growing at 1 million barrels per day per year, it's only about 15% of that Guyana can take up, and that's after the entire world's decline rate is mitigated. So there's countries that are losing production. So Guyana is not just an extra incremental, it has to make up for those countries as well. On the right here is the total government take from these sorts of projects. So the fact that some of these companies are going into these countries where the government takes over 60% of the revenue, call it revenue or profits from these fields, just goes to show you that how much there's not any easy oil left, that they're going to give up so much profit and still take on the exploration and development risk, because there is no other way. There's no other easy jurisdiction that takes less money but has the same kind of oil left. So Guyana 60%, Brazil 63%, Suriname 66%, so quite a lot. This is the Guyanese production right now, so about 360,000 barrels per day. Some big downtime in here as they get things going. They were also having problems with their compressor on one of the platforms. So I guess we'll see how well Exxon and Hess do here as time goes on. I don't think I would bet against Exxon. Pretty strong operator and developer. Yeah, so all that we're really worried about is the pace of construction and the pace of development on these assets, because there's about 15 billion barrels of reserve that's being found, supposedly. So that can maintain a 1 million barrel per day range for a long time. Suriname, right next to Guyana, more gassy acreage is what it seems like, but still a lot of oil here. Investments are reaching $22 billion in the next 10 years. Some exploration, some greenfield, and some development. So yeah, so we'll see how things go here, how things get FID'd, a final investment decision. This is the projection that this is $1 billion on the left, and the year of final investment decision. Once that's done, it's going to be 3 to 5 years before the platform comes online and is fully working. So this is at least 2026, if not further out. And if we're talking about any sort of material production, I mean, we're looking at 2030, 2032. So it's almost too far out to matter, but definitely one that I watch. Any FID, any exploration, any development work being done, and any acreage, lease acreage sales, block sales, I should say, on these. So Guyana further ahead in its development cycle, Suriname maybe the next. Not enough reserve here yet to really make a decision as to what's happening. There needs to be more discoveries, more exploration work being done. So not a factor in the near term. Namibia. So we have Total with their discovery here. We have Shell with their Graph prospect that ended up hitting oil. And then we have Chevron that just came into block 2813B up here. And a few prospects here, pretty interesting space and possibility of a lot of oil here, but it hasn't been found yet. So there is some exploration success. There needs to be more. And then the FIDs will happen in 2025, 2024, so that production can come online in 2027, 2028. Once again, not a near-term issue. It's more of a watch this and see what happens going forward. But again, more offshore exploration, because that's really where the oil is left. Everything onshore has basically been discovered at this point. Where are the majors? They are in Namibia, so Chevron and Total. They are in the Middle East. They are in the Malaysia, Indonesia area, where they're doing some drilling, a bit in offshore Gulf of Mexico, and then East Coast Canada. So this gets put out every month, and I watch this very closely. And where are the majors spending their money in exploration? That's really what we want to know, because they will be the ones to make the big discoveries. It's not going to be some random mom and pop junior that's going to be out here making massive discoveries. There will have to be some sort of tie-up, or the initial oil exploration and finds will be done by a major. And then the other companies can come in, possibly drill something. So nothing here too crazy. There's no new areas I'm seeing. There's nothing here I'm seeing that's really, really prospective, that can bring on millions of barrels in the short term. Offshore is a long-term game. It's a 5 to 10 year cycle by the time you start exploration and by the time your oil comes online. Yeah, the same thing happened in Guyana. Exxon first found oil in the early 2010s and then kept drilling, more exploration, FID, the first FPSO. They all got brought online, and now they're coming online every year as things go on. Argentina, so the Vaca Muerta shale. This is one that was mentioned to me, like, watch for shale in other parts of the world. Okay, so they actually have pretty decent geology in this area, and they've been growing production relatively fast. But if you really look at it, they've grown 100,000 barrels in 3 years from this shale, high decline shale, that now they have to keep going on this treadmill. So how much can it really add? We don't know. I'm more so watching to see how things go here. How much can they get up to in a short period of time? When we look at the Vaca Muerta shale, all it's doing right now is making up for the conventional declines, really. Production is flat from 2015 to 2022, even though the shale has gone from 0 to about 240,000 barrels a day. The overall country's production is flat because of the conventional declines. And this is something that's so important to think about. When something is adding production, don't think about what it's adding. Think about how much decline is it mitigating first. And then you can think about what sort of incremental barrels is it adding on a global supply-demand thesis. And the Vaca Muerta shale is now running into other problems, as any shale play would. They don't have the drilling rigs, they don't have the fracking fleets, they don't have the water. Remember, each frac takes about somewhere between 100 and 150,000 barrels of water. So lots of water required. And then the natural gas pipelines, the same problem with shale. Shale is a gas driven. There's always gas with shale. It's not 100% oil ever. So you need the pipelines. You're not going to flare the gas. You're not going to vent the gas. So definitely want to watch for. And it looks like it's hitting some supply chain issues going forward. So not a huge production growth, but still a couple 100,000 barrels here and there. I will watch for it. So far, not concerned, because they don't have a supply chain. They don't have the infrastructure. They don't have that growth pattern that the US does, given that the US has roads, it has labor, it has towns everywhere, it has access to expertise everywhere, it has pipelines everywhere from the conventional oil times, it has surface pads everywhere, it has electricity everywhere. It's a completely different growth cycle on it. And corruption, yes, there is a possibility that there's corruption here too, yes. Stage efficiency. So one thing that any shale company in other places other than America and Canada has is that they no longer have to go through this experimental cycle. They already know the best fracking techniques, the best drilling techniques. They have the best geosteering. They have the best steerables. They have the best development cycle, the best well spacing, etc. So you're not going to see efficiencies. Once they get to this point of using all these technologies, that's it. You don't see efficiencies like shale saw, where they got longer wells, they got better fracs, they got more sand. It is a one-time thing. They have the best, they continue with the best. So stage efficiency, flat. There's no growth on it. So you're basically tapped out with the best of the best shale technologies right off the bat. And that's your peak. There's going to be no way to really increase your IPs or reduce cost. It just is what it is. A pro and a con, most likely a pro for the company, but for overall production and growth phase, you already have the best. So how can it get any better? One more on government take. just to compare some countries, you have the cash flow to the government and the revenue per barrel that they're getting right here. Look at these, Canada and the US. They have some of the lowest government take in the entire world, which number one, makes them good investments as investors in these companies, but also tells you that there's very little scope for growth in these countries if people are willing to go to Iraq and Saudi and Kuwait and Libya and Malaysia and Nigeria. That these two areas are pretty much tapped out, whether it's geology, whether it's politics, whether it's development, whatever the reason, money is not being put into these plays to massively grow production. Iran, producing about 2.6 million barrels per day as we speak. Their internal consumption is between 1.6 and 2. A lot of geopolitical risk here as well on these barrels. So think about that. And their internal consumption keeps going up. Last summer, they put out a notice that said, stop consuming natural gas. We don't have enough. We need to export it. The population needs to stop wasting, not even wasting, just stop consuming natural gas. The same thing is happening for oil. When countries like this get a bunch of vehicles and diesel and farms and everything else, their internal consumption can go up unknown to the rest of the world. So how much can they really export if they came back to their pre-sanction level? They're at 26 now. The max was about 3,800. So they can increase production by just over 1 million barrels. Is it going to happen right away? No, we have the data that shows it takes over 2 years to get to that level. That's if the American sanctions come off. That's if there's no other geopolitical internal turmoil. And that's if their internal consumption doesn't go up at the same time. Because you put a 3 to 5% growth rate on their internal consumption, they could be consuming more than 2 million barrels per day as we speak. So 1 million barrels per day over a 2-year cycle, if sanctions come off, one-time event. Not a bad risk to have on the supply curve. Along with this, the fields have not been in good shape. They have been ignored for almost 4 years now. So how much of it is rusted away? How much of it is actually in workable condition? Probably the majority of it, but not all of it. So there is going to be a time to get this production online, especially at a time that we don't have the expertise and the engineering support to really get these things done. So one to definitely keep an eye out on, but nothing has happened so far that makes me think this is a problem here in the near future for oil supply. Do you think the protests in Iran will have material impact? We'll see. We'll see. Refineries were shut down. Some of the processing plants were shut down. The oil wells could be next. We don't know. And I believe the Houthi rebels were taken off the list of sanctioned entities as of October 1st. So some more possibility of geopolitical turmoil in this area. The tankers. A lot of tankers that Iran was using are very old. They're 15 years old. 84% of them are 15 years old or more. And now Russia wants these tankers for their illegal activity. So there's only so many sanctioned tankers out there. And the more that Russia starts using these, the more that these have to be taken out of service for integrity problems, or they crash or they break up, the less and less that this shadow fleet can operate. We also have flare index. So we can track the real-time flaring going on in Iran using satellites and figure out how much oil are they actually producing. So 2016, the flare index was up here. The latest ones we have from December, I think this is, we have down here, and it sort of correlates to the rough change in production that we have. So this number is not just made up from random information. It's being put together with some various kinds of data and trying to come back to what the production can be. Yeah, I don't think these tankers can be extended very much. If something goes wrong with them, that's basically it. They go into the scrapyard, as you said, and get used for metal, because who's really going to fix them and take the chance that something else breaks the next month after it? These are not maintained very well at all. Iran exports to China. More and more are going through ship-to-ship transfers. So they'll take the ship, fill it with Iranian oil, take it to Singapore, put the oil on a different ship in the open waters where it can't be tracked, and then sell it as some other kind of oil. So this tells you that the sanctions are ramping up on these ships, that in this time, in 2018, they were doing what they were doing. And even in this time, Iran would go and do these, just sell this oil blatantly. Now it seems to be becoming, they want to hide this activity more and more. Also, we discussed this in the inventory section. Iran is selling or consuming its flotilla of condensates, its floating storage. Maybe an indication that there's a problem here, either with production or with demand going way too high. Something has happened that's changed their excess crude that was being sold, or excess condensate that was being sold and stored on the markets. Here is the same pictures. This is the flotilla of Iranian condensate offshore. This is the same picture a few months after. The ships have gone down a lot. So we have all this kind of data. It can all be tracked, and it's just about having access to these things and can get a very good idea of what's happening in the real world. Okay, Venezuela. So the other one here. Venezuela's oil production over time. So this is the 70s, it's the 80s and 90s. We're going to look at the most recent time frame here. So they got up to 2.7 million barrels per day. Right now, they're at 700,000 barrels per day. Right here, 700,000 barrels per day of exports. So how much can they increase their production? Maybe somewhere around 2 million barrels per day over you see how long it takes them, over a 10 to 15 year period, they can increase 2 million barrels per day. But if the Venezuelan economy starts going at its full speed, you would expect that the internal Venezuelan consumption also comes back to where it was before the socialist regime came in. So 600,000 barrels of increased internal consumption, that's a 10 years ago number. That could be up to 7, 8, 900,000 million barrels per day. That consumption comes up if things really start changing in Venezuela. So of this 2 million, let's say 800,000 goes to internal consumption over that 10 to 15 year period. That leaves about 1.2 million barrels to be added over a 10 to 15 year period. Once again, it's not enough to really crater this supply demand thesis. That's only about 100 to 200K barrels per year. And that's assuming they can get to this level, which was last in 2014. A lot of their fields are cannibalized. The pipes are broken apart. The engines are stolen. The equipment is sold to finance operations. This is a long haul with a lot of money, a lot of engineering support, which is just not there. We don't have that sort of expertise out there that's willing to do this, go to Venezuela and take the risk where pipelines are getting blown up, people are getting shot. Not the safest place to be. The internal oil company also doesn't have money. Their debt is rising. They don't have liquidity. They don't have money. and they're liable to one buyer, basically China or Iran, and not much sales going on. And they're playing around with tankers. They also had a bunch of crude that got sent back because it had too much water, it had too many solids, it had too much sand. The refineries are not up to snuff. So they're getting poor quality crude and products getting sent out. That's then being rejected. And who's covering the cost? Venezuela. They might even be not making any money at the end of the day after everything that goes on with these kinds of countries. And here's what we have for projections. So in a robust recovery scenario, assuming things go good, we have a great recovery here. Oil output only increases 200,000 barrels by the end of 2024. This is the base case decline, and this is the slight decline. So don't expect this to go up all of a sudden and get to 2 million barrels. It's not going to happen. As soon as there's some news that Venezuela has any chance of coming back online, 200,000 barrels per day in 2 years. That's all it can add. Absolutely a nothing burger in terms of today's oil supply demand and the short-term oil supply demand. Colombia, oil production in purple, declining, cocaine production rising. We can see where the country wants to make its money from. And this oil production might rebound a little bit, but once again, it's well below where it was in 2014, 2013, and it's going to take a lot to get it up there. Colombia also has the Magdalena shales, so watching what happens there. Another shale play that could possibly be interesting. Colombia also has a lot of oil field equipment to feed its conventional and water flooding wells. So watching right now, nothing major to report on the shale Colombian supply. There are other companies growing production in Colombia, 10,000 barrels a day, irrelevant on a global supply demand scale. 5 small but relevant countries. These countries add up to 3 million barrels per day. Colombia, Azerbaijan, Indonesia, India, and Egypt. Look at the trends of all of them since 2014. It's just down, terminal decline. We add them up, you can see the added decline. They lost 1 million barrels per day in 8 years, which is why I come back to the point. When you say Guyana is going to increase production by X amount, are they really increasing production, or are they just making up for other countries that are declining? Keep that in mind when you run your supply demand globally going forward. It's not incremental barrels unless it really is, and you can prove that they are, which in most cases, it's going to decline mitigation as much as it is to new incremental supply. The UK, down big time, 400,000 barrels down in 3 years, 4 years, let's say, into its terminal decline phase. Qatar, down and then flatline here. Oman, flatlined, slightly increasing, nothing major, 10,000 barrels a month. Not enough to really matter, and not a sustained growth past this. Mexico, we talked about this before, an extreme example of terminal decline. Kazakhstan, they brought the Kashagan field online, they have the Tengiz field, both major fields, operational problem after operational problem, and now it's basically controlled by Russia at this point, because their oil flows through the pipelines into the port of Novorossiysk, and that is on Russian land and on Russian seas. So they are basically controlled. Their oil flows are being controlled by what happens between Russia and that part of the world. Not a stable investment place right now, even though they have a lot of oil, not a stable investment climate. China, production is down to flat in this 4 million barrels per day range. They say they've discovered shale gas, nothing major on shale oil yet. So keeping things as is right now, until I see some major growth out of this region, I think we'll leave it at this 4.2, 4.1 million barrels per day range. This is Sinopec, a big producer in China, and you see how their curve sort of is. There's never any major growth going on here. It's just this incremental supply that goes to mitigate declines, and then you get a little bit of growth on top, and then you go back into this minor growth phase. We see this in the overall China curve as well. Basically, 50,000 barrels a year. That's it. They don't go into huge development cycles because they're worried about longevity, not peak production. They want to produce at this rate for many, 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 many decades. Canada, for all the talk about Canadian production is skyrocketing, it's not really. It's at the same levels it was in the summer of 2019. So 3 years with almost zero growth. That includes any debottlenecking, that includes the Clearwater, that includes conventional, that includes any new mining operations, everything. And production is pretty much flat and down 100,000 barrels in the last, call it 3 years, roughly 3 years. Here is the Clearwater. The Clearwater has grown from 30,000 barrels in 2020 to 90,000 today. So 60,000 barrels in 2 years. But look at what it has to do. Once again, it has to mitigate the Viking, the Cardium, the Bakken, the Charlie Lake, and the Shaunavon. So at the end of the day, it really maybe added 20,000 barrels a year. Not enough to make a difference as to where the global supply demand is, where the undersupply is going forward. And the Clearwater is a play that's never going to get to 1 million barrels a day. It's going to get to 200,000, maybe 250, and that's that. Other places where multi-leg horizontals can work, yes, closely watching, but nothing has really showed the promise that the Clearwater has with these 200, 300, 400 barrel per day wells and the Baytex 800 barrel per day wells. Nowhere else has shown that sort of promise in that sort of volume so far. But definitely what I'm tracking, not just for supply demand, but for my own interest and for my own investments going forward. Here's the Clearwater activity and which companies are in here. So Tamarack, Delta Stream, Spur, Headwater, CNRL, Baytex, Woodcote. There's only a few players here. It's very easy to track and project where things are going on a production basis here. Brazil, we talked about them missing targets. So they had this growth phase, grew in 2020, and it's down about 350,000 barrels since January of 2020. Huge decline rates. There's a reason people aren't investing as much here as they should, given the reserve that's accessible with some exploration, drilling, and development. Here is the Brazil offshore discoveries. All the major discoveries are in the shelf, in the shallow water, are in the 70s and the 80s. In the deep water, they didn't really discover much in the deep water. And then the ultra deep water, a lot of discoveries happened in 2010 to 2014, but it's expensive. It's a lot of exploration, it's a lot of development, it's a lot of money. And with a huge government take in Brazil, it's not as prolific as people and even the Brazilians make it seem. As much as the government makes it seem it's this gem. If it really was, you'd see more development going on here. And possibly we do. So we will watch this as time goes on. But so far in Brazil, production is down 350,000 barrels in 2.5 years. Not conducive to something that's going to grow all that fast going forward. Australia, flat to down. Gabon, down. Equatorial Guinea, terminal decline. Nigeria, some issues here with theft and corruption and issues that can be fixed. They also had their first offshore auction here recently, 7 blocks, I believe. So potentially this can get back to this 1.6 million barrels per day range, but we'll see. The trend has not changed so far. It just keeps dropping and keeps dropping. And there were some force majeures that got taken out in September. So watching October and November production to see where it rebounds to and whether it can sustain there. Algeria, terminal decline. Angola, terminal decline. The Congo came up a bit, down again, not a major player. Azerbaijan, terminal decline. Malaysia, terminal decline. Iraq, one of the big growth stories out of the 2000s decade and the 2010s decade, looks to have maxed out at about 4.5 million barrels per day. They want to get to 9 or 10 million barrels per day by, I think it's 2025 or 2027. Do they have the reserves and the geology? Yes. Is the investment climate stable enough? No. Do they have the expertise of the multinationals? No. So more of a wait and see. What can they really do here? There is that Shamaran Petroleum owned by the Lundin Group that is active here. And I think one that's a really, really good source of information if anyone is looking for how stable is this area really. So one that I'm going to be focusing some of my research in here in the next few months to see what can really happen here, because this is one country that can add 5 million barrels per day of production in the next decade and keep it there if they had the right amounts of capital and the right stability, which I don't think is coming anytime soon. The UAE, another growth story in the last 15 years. They have production capacity, spare capacity of over 500,000 barrels per day as we speak. So just about the only country in the world that sits here with untapped production. But as long as the OPEC Plus agreement is in place, the UAE is tapped out. They cannot do anything. And not a single peep was heard out of them after that OPEC Plus 2 million barrel per day cut, which means they don't mind making more money and just keeping extra reserve for when the time comes. They're not going to flood the market on their own anytime soon. And they do have growth capacity till about 5 million barrels per day. They can get there over the next 3 to 5 year period. They just drilled the world's longest well, the longest horizontal well ever drilled. So they have the technical expertise, they have the backing, they have the drill rigs, and they have the money, but they're not going to flood the market. They're going to keep that spare capacity as a buffer in case Russian production declines, in case something happens in Libya, in case the Saudi production starts to decline. OPEC Plus will want this sort of spare here as a insurance policy of their own, almost like a SPR or a DUCs. Algeria exports going down. We saw Algeria's graph here earlier. Unplanned oil disruptions. So Iran, Libya, Nigeria, Venezuela, Russia, and other. We've discussed all these countries and what their scope is going forward in the near term and the short to mid-term. Global decline rate. What's happened with the invention of shale is that the global decline rate of 6% per year, roughly, which is rising. It is rising, contrary to popular belief. That decline rate on the conventional production seems to be going up. What's the world's decline rate? Now you've added 16 million barrels of shale, oil plus NGLs, natural gas liquids. That declined at 33%. So you add these two numbers and you get a global decline rate that's now in the 11% range. That's how much investment needs to be done every single year to keep this production flat. It used to be 6%, now it's 11%. That shale treadmill, that guy on the shale treadmill better make sure they don't fall off, because if they fall off that treadmill, the world is in big, big trouble in oil supply going forward. So not really a stable place to be. From oil supply, you don't want decline rates this big without the supply available in the short term to really mitigate these things, let alone a geopolitical climate that's not stable in various parts of the world at this point. What else? Petroleum engineering graduates, don't have them. A lot of them graduated between 2014 and 2018. They're gone. They moved into other parts of the sector. They moved into other industries. They moved into software. They moved into tech. My own graduation class in 2018 was about 75-ish students, the biggest class that the University of Alberta has ever had. And I can count on one hand the number of people who are still in oil out of 75 in terms of actually working as a petroleum engineer in oil. They've just been shot out of the sector, just given the timing of how things have been. And since then, you're getting some of the lowest class sizes that we've ever seen because of the whole narrative around oil is dead. People don't want to go into oil. There's a social stigma, whatever. The point is the expertise is not there to go and do exploration, to go and do development, to go and do sanctioning of new projects. And that's that on supply. We've discussed almost every single country in the world that produces oil today. And if there's any other countries that are not mentioned, please let me know, shoot me a DM or an email, and I will add that to the next macro outlook session, January 30th. So that's how these presentations have been built. Every single iteration, I get questions back and I add them to the presentation going forward. What do you think of CNOOC? Have not heard nothing that they will be increasing production massively. Are they the ones that hit that shale field? Shale gas in China can grow a lot, yes, and same with offshore. But I don't see anything right now that's really troubling me in terms of their production. But if you have some information, please feel free to email me, and I will be more than happy to have a look. Chad, I don't think I have looked at that country before, so I will check it out, but doesn't seem like I've heard about them at all in terms of oil production. So where are we? That's that on supply. Now let's talk global macro a bit, and where are we in the cycle? We are about at this an older graph. We are just about here roughly. So we're 30 months into the cycle. Oil prices have gone up, the equities have gone up, but this is the way they go up. They first go up a little bit. The early people who've made a bunch of gains exit, and then the big boys come in and they just jack up the equity and the valuations on these companies. And these cycles go on way longer than people think. 2009 to 2014 was not really a real cycle. The real cycle was 1999 to 2014. In the middle, you just had a one-year recession. That's not a cycle-changing recession. The entire cycle was 15 years long, where oil prices went from $20 a barrel to $100 a barrel, stable. Yeah, so I'll talk about the recession risk and whatnot here as I go. There's no proper answer to this question, but people have been saying recession for almost a year now, at least 8 to 10 months, and nothing really has happened. I'll show you exactly the performance of this sector as we go on here. So that's the cycle. The length and the torque on it is maybe underappreciated by many of us. Big oil is cashing in huge profits. Money is not going to capex, which means it goes to cash flow and free cash flow, which comes in as profits. Q2 was a record. Q3 will be in the $50 billion range for these big 5 companies. Pay back debt, buy back shares, pay out dividends. For us, struggling oil investors since 2014, weathered the storm, it's time to get paid. This is, again, an older chart, but it shows the narrative that we all discuss. The equities are reflecting a lower WTI price than what the WTI is. And it's been like this for many, many months. It has sort of narrowed in the last 3 months as debt is being paid back, but it's still not there. So there's this underlying arbitrage between the oil price and the equities and what they reflect. Energy also trades at way lower than its earning potential. So 0.58 times forward earnings. Things like IT and tech are over one times the forward earnings, the forward index earnings consensus. Another chart showing that in the past, when the price of oil goes up, the equities go up, the XLE. This time, there's a huge divergence between these two things, the underlying arbitrage. Short interest is also the highest since October 2020. And I pity these people who are out here shorting energy stocks right now. It will take a massive global recession and depression to be worth shorting these things. I understand not buying them because somebody doesn't understand the supply demand, but to go out and short these things, picking up pennies in front of a steamroller, you can do it for so long, but when you get crushed, you will become crushed, absolutely crushed. We look at oil performance in the last 1 year. The XEG index, oil index, is up 57%. The clean energy index is down 25%. We look at it on a 2-year cycle. The XEG is up 301%. The clean energy index is down 3%. So in this entire time, the clean energy index has done nothing. It's flatlined the entire time. The oil index has gone up 301%. So it's not just a matter of outperformance for a short period of time. This is an outperformance across any time period, across any length of comparison that you want to do. Any information on Chinese well operators in Sudan and Iran getting kicked out for not doing maintenance? No, I'm not aware, but sounds bullish. So if you have any information where that data is coming from, I'd love to know. And I will also look into that on my end. Oil consumption year over year versus the cost of GDP. So we see here the year over year consumption in the green bars. We see the percentage of GDP in the blue line, and then the price of oil in the green line. So when it gets to about 5% of GDP is the oil cost, is when you see these declines in year over year consumption. Very few years that this actually happens. And it takes up to 5 to 6% of GDP. We are right now about 2 to 3% of GDP because GDP has kept going up and the oil prices haven't. The oil cost percentage keeps going down despite the prices being higher. So it would take a lot more to get there. Energy also makes up only 4% of US consumer spending. In 2010 to 14, it was 6%. Now it's down to 4% because there's other things money is being spent on, and the entire money supply is just way larger overall as a society. So if oil prices could stay in the $100 range from 2010 to 14, why is there so much talk about demand destruction at 4% of GDP? Definitely want to think about. A lot of the information on Twitter is completely misguided. It's narratives based on no data. It's just stuff thrown out there because it gets a lot of likes, it gets a lot of people agitated, and people don't like seeing energy doing well because they don't like spending on gasoline, they don't like spending on natural gas, they don't like spending more on flights, hotels, whatever. So they would love to see this sector just getting crushed year after year after year. US gasoline prices as a share of hourly earnings. Once again, 2010 to 14, 16%. Today, 12%, 12 to 13%. Despite the huge crack spreads, gasoline prices can definitely go higher as a percentage of average hourly earnings. People are also spending less money on food. They were spending a whole bunch of money on food in the last 20, 30 years. It's going down, which means there's more money to spend on other things, luxuries, transportation, travel. Look at it a different way. The household energy burden, so gasoline and other energy, till Q4 of this year, same story. It was about 4% of total personal consumption expenditures in 2010 to 14. Today, it's about 2.5%. So no matter which way you look at it, the price of gasoline is more a political problem than it is a financial consumer problem. It's more just people see that price of gasoline on every billboard, every corner, that it becomes a problem. Otherwise, nobody seems to be all that concerned, and they really shouldn't be. There is no price gouging going on. It's all what's being told to the people. As a share of expenditures, it has never been cheaper, other than maybe the COVID times, which is not really a good comparison anyway. So there's a question here on the Cardium revival. There can be a revival. It's just not going to be the volumes that make a difference. Like 10, 15,000 barrels per day, it is just not meaningful enough to change Canadian production or worldwide supply demand. You would need something that can add 500,000 or 1 million barrels in a short period of time. The population living in extreme poverty. As soon as oil and coal and natural gas have become mainstream, the number of people not in extreme poverty has gone way up, and the number of people in extreme poverty has gone way down. That's at $1.90 per day and under is extreme poverty. So what's responsible for this? Energy. Energy drives GDP, energy drives quality of life, energy drives modernization. It is the lifeblood of the economy. It is the lifeblood of humans. So for people to go and say oil is a polluter, you're killing the earth, you're doing this, you're doing that, without energy, without oil, without coal, you would still be living in those huts and going out hunting with spears and using rocks to make fires. So I know there's people that would like for us, the entire society, to collapse and for us to go back to that, but it's not going to happen. It's just the humankind so far has been about creating more optionality, more freedom, more quality of life, a higher standard of living for the people, and that is going to continue. If the developed world wants to try and fight it, they can. The emerging markets will not care. They will do what's best for their populations, what's best for their people. And it is completely blatant ignorance to think that you can sit here and tell people what to do and ask them to reduce their consumption when other people, when it makes no impact to the actual problem that's out there. And the same graph on a global scale. For all the renewables and biofuels and solar and wind and nuclear and everything else that's being done, the global energy consumption continues to increase. It's not that something got replaced. Every new source of energy just added to the world's energy consumption. So it would take a Herculean effort of impossible scale to go and not only take up the incremental growth in energy consumption, but to also make up for all of this. The proof is in the pudding. This graph is right here. It tells you exactly, for anyone talking about peak coal, about peak oil, about peak gas, and this and that, at the end of the day, nothing has really changed. We just continue to consume more energy. And where the White Tundra slogan comes from, we bet on the world's growing thirst for energy. And this graph is living proof that that thirst continues to grow no matter what. A little bit on renewables. So solar panel prices, the narrative was that they would continue coming down, it would get cheaper all the time. We know physics doesn't work like that. So it did come down, now they're rising. Lithium prices are through the roof. They've gone up 5x in the last 18 months. Lithium, one of the big components of EV batteries. So there's not even enough lithium right now for the current supply of EVs, let alone what people are projecting. Energy density. We have always gone from a energy source of low density to high density, from wood to coal to oil to even natural gas. They're all high energy intensity, high energy density molecules. Now you're telling me we're going to go from 40 megajoules per kilogram to lithium ion right here, which is 1 or even less megajoules per kilogram. Doesn't really make sense. From a physics, from a math standpoint, you would need battery storage capacity to the tune of we don't have, something we just don't have. Until there's a technological advancement, it may not be the right time to really be pushing these things to this sort of level. What do people look for when they want EVs? Are they looking for the speed? Are they looking for luxury? Are they looking for what? Well, they asked Canadians what they're looking for. They're looking for tax deductions, free infrastructure, charging infrastructure, incentives, cheaper insurance, free registrations, free parking, free toll roads, free HOV lanes. It's all about money. What costs X person less to run? That's it. There's nothing in here that says we're buying EVs because of the climate. Nothing. Not a single one of these responses. What happens as there's taxes on electricity vehicles, of EV vehicles, for the road construction? What happens when they have to pay more for insurance because they catch on fire or they have X accidents or whatever? What happens when they pay their fair share of charging infrastructure? And when the subsidies go away, the upfront subsidies? Yeah. The EV penetration we're seeing today, this number, this percentage, is based on a very highly subsidized number. And when people can buy something cheaper, they will, irrelevant of what it is. Most people just want a point A to point B vehicle. And if it's cheaper, they'll buy it. So one to think about the history of left-handedness. This, it's not a relevant curve at all, the graph, but this is what I expect the EV number of sales to look like in North America. You have this growth as people are given benefits, they're given free HOV lanes, they're given free parking, blah, blah, blah. And once it gets to a certain number where it's too much of the vehicle fleet, the governments have to start charging road taxes and other taxes, charging for the infrastructure. And that's when people just say, it's not really my thing. It's cheaper to run gasoline vehicles or hybrids, possibly hybrids. And here's the data that proves it. This is EV market share for these countries, August 2020, August 2021, August 2022. And what you see is things grew a lot and then they just flatlined. In the last year, the number of EV sales out of new cars has flatlined. After growth, flatline. Spain, same thing, 9% to 8%. Italy, it's gone down from 10% to 8%. So running the same growth model forever is a nice sales pitch. It's a nice marketing tactic. It doesn't translate to the real world. And where are EV sales coming from? China. It's mostly China. The rest of the world has not grown their EV sales or their market share percentage. It's been mostly China, which has done an exceptional job with their infrastructure, with the pushing of the electric vehicles, motorcycles, bikes, scooters, cars, trucks, whatever. Really done a really good job at that. Other countries, I don't think, have the willpower to really push these things through that they need to. I'll answer your question here at the end, Trev, just to complete the flow for whoever wants to just attend the presentation. We're quite a few hours into this, so I'll get to that here at the end. Thanks. So the global vehicle stock, even with the most optimistic electric vehicle sale targets by 2050, conventional light-duty vehicles peak in 2038. Because just because you're not selling all the vehicles as gasoline or diesel, that still means X percentage is getting sold as gasoline and diesel. So the vehicle stock continues to grow, even in the most optimistic electric vehicle sale projection. Zinc, here's another one. Lithium has gone up. Zinc is the exact same problem. We literally don't have the materials to do this. Copper. The copper ore grades have degraded from 1% in 2000 to about 0.6% today, to about 0.5% in the next 3 years. Why is that important? There's a couple of reasons. One, it's just getting harder to find. It's the same problem as oil. The battery metals are getting harder to find. And the second thing, the lower the ore grade goes, the more energy is spent to mine these ore grades. If you have 1% copper, you have 99 tons of waste for 1 ton of copper. If you have 0.5% copper grade, you have double the waste for that 1 ton of copper. And guess what mines these things? Diesel, heavy consumption of diesel, tractors and trucks and equipment and melting furnaces and smelters. It's all diesel, fuel oils. It's not clean by any means. Battery supply demand, same thing. It's the same thing. We don't have the battery supply that we need to meet these sorts of goals. I am fully appreciative of what people are trying to do. I'm all for it. I'm not here trying to pollute the earth unnecessarily, but there has to be a fine balance put between it where this is feasible. We can go at this rate. Okay, you're trying to accelerate these things way too fast. The world is not ready. The world is not prepared. We don't have the resources to do it. Copper, lithium, cobalt, all in a supply shortfall in the next year or two. So where is the rest of this going to come from? Exactly. No idea. And nobody is even willing to discuss it. Minerals used in power gen. It's not just an EV problem. It's a renewables problem. Solar and onshore and offshore wind use 18,000 kilograms of minerals per megawatt created. Natural gas is 1,200. Coal is 2,000 kilograms of material, minerals per megawatt. Electric vehicles have about 500 pounds of weight of minerals used per vehicle. Conventional cars have around 60 pounds. It's that drastic, the amount of minerals required for every single vehicle. Power sources. This is European Power Source, 2020, 2021. For all the work they did their coal consumption went up 18%. When push comes to shove, people will not go hungry. People will not stay cold. They will burn whatever damn thing is out there, coal, lumber, biomass, whatever. It will all be burnt and emissions will rise if you try and push this transition too fast. Solar installations, all in China. Once again, China is doing a really good job at all sorts of renewables without making a big fuss about it or trying to be in the news all the time. So a lot of the growth in EVs and solar is coming from China. The rest of the world is basically flat and doing very little in annual installations. And then you have the ups and downs, as many of us know already. Wind energy up and down, solar up and down. It all needs to be backed up by natural gas. Perpetual demand for these sorts of things forever for fossil fuels. They always have to back up the renewables, always. Same thing that are, even though the renewables increases, the fossil fuels percentage continues to stay the same, and the fossil fuels demand continues to stay the same, irrelevant. And hydrogen, this was brought up to me, and I had to look into this because I hear a lot about hydrogen. So what's being said is that in high case scenario, hydrogen technologies going forward, it will be 0.2% of energy consumption by 2030. I once again appreciate what's trying to be done here, but hydrogen has literally no energy density, and it is not going to take over the world. 0.2% in 8 years of global energy consumption in a high case scenario where everything goes well. It has its uses. This is not one of them. And how much are the people willing to take? Electricity prices in California are up 7 times more than the rest of the US this decade or last decade. How much are the people willing to take? There's going to come a cracking point where people say enough. We just want reliable power. We don't care where it comes from. Same with any country that's done more generation from renewables, the price always goes up. It's literally a linear curve, 1-to-1. Are people willing to pay for it? We'll find out. Global oil demand with and without decarbonization. It goes up in both cases till 2030. With decarbonization, it goes to 106 million barrels per day. Without, it goes to 110 million barrels per day. Where is the demand destruction here? Realistically talking, it's not there. It's just a fairy tale that global oil demand will suddenly fall out of nowhere. I'm going to skip that. Actually, Canada and the merchandise trade balance is a lot from energy. The only reason the Canadian currency is even as strong as it is against the US dollar is because it's an oil producing nation. Other countries have gone absolutely slammed. So I think the Canadian government will be careful not to kill the golden goose here. And they've been shying away from windfall tax discussion for a long time. And I think it continues that way. They're already making money from royalties, income taxes, and now corporate taxes, as the companies are making way more money than they used to for the past few years. We need investment in everything. This is not just an oil problem. This is a oil, renewables, electricity, and energy efficiency problem. We have not put enough money into the real world. It's gone into tech and building other stuff that has literally no use other than some guy had some idea and built some app or some robot. We need real world stuff. We need coal, we need oil, we need natural gas, we need solar, we need wind, we need electricity, power lines, generation networks, everything going forward. The oil market is bigger than the rest of the metals, all of the metals in the world combined by a factor of about 5x. So something like gold or silver can be manipulated forever in the paper markets because it's just not a big market. Oil is about 5 times bigger than the rest of all the metals in the world combined. And secondly, oil goes away. Metals can be recycled and stored somewhere. Oil, as soon as it's used, it's just gone into thin air. So you can't print oil, you can't create oil. And at some point, the physical markets will take over, and it will be a glorious day when the real price discovery comes to oil. And that day, I don't think is all that far away. Misleading graphs. People are talking about recession. They say Chinese cement production is down year over year. They'll post this left graph saying that things are collapsing. When you look at it on a non-year-to-year graph, year-over-year graph, things don't look so bad, do they? So if you're looking at any graphs on recession, on oil, on anything, any year-over-year graph, throw it out the window. Look for the absolute graphs and how things are going. Especially important comparing anything to 2021, which was a COVID-ravaged year. Nothing really makes sense when you compare it on a year-over-year basis. My favorite one is that Shanghai container index graph. Oh, it's down 20 weeks in a row. The global economy is collapsing. And then you find out that the price, that index is still double where it was pre-COVID. So, okay, it's down 20 months or 20 weeks, well, 20 weeks in a row, big deal. It's still double the price of what it was pre-COVID. So the demand is still there for that specific thing. Just bizarre the way everyone just wants a recession so they can be right. It's not about being right. It's about making money and how you make the most money in this market. And that's really what I focus on. I don't care about being right. It's about making money and finding the data that helps me do that. I'm going to skip that. US consumer balance sheet, pretty decent shape. Nowhere near where it was in 2008. Household debt to GDP, it was 100 in 2008 recession. It's 80 today. Less debt. There's way less debt on the consumer balance sheet. The household debt service payments as a percentage of disposable personal income. How much of their disposable income is going to debt service? In 2008, it was about 13%. Today, it's about 9.5% with the rising interest rates. Not that big a deal yet. Definitely want to watch going forward. Household net worth, it's looking really high. Yes, it's gone down a little bit because the housing market has come down and the stock market has come down, but the overall net worth of households is well above what the trend puts it at, despite the drawdown. We've seen this before in Canada. Average consumer deposit balances are well above pre-pandemic levels. Whoever had less than $2,000 in their bank pre-pandemic now has 5 times that. 2 to 10,000 pre-pandemic has 3 times that. And 10 to 20K has now 2x that. There's a lot of money still in people's accounts before they're worried about losing any of their toys or their ATVs or quads or trucks or whatever else that they bought during COVID. Personal savings rate. This is one that's very interesting and almost always is misrepresented. When the personal savings rate drops below 5%, which is the lows of the 2008 level, that still means savings are going up because the absolute number of savings is still going up. The savings rate is an incremental rate on top of that. It has nothing to do with how much money is being spent. It just tells you how much savings rate out of the disposable personal income. That means people are still saving some part of their incomes. It is not a negative number. It is a positive number that adds to incremental savings. And that exact point is being made here, that even though the personal savings rate has gone down, people are still sitting on more than $2 trillion of extra cash in their accounts. And that's going to last a long, long time at this rate, especially if the labor market stays hot, which it seems to be, because the government tax receipts are looking really strong, well above the pre-pandemic trend. The withheld income and employment taxes are through the roof. They're up 13% from last year, which was already a very high number as the labor market and the unemployment rate dropped. So people have the money, people have the savings, people have their jobs. As long as that stays true, they will continue to spend no matter how expensive things are. And things are getting cheaper now, which both psychologically and from a financial standpoint changes the way people view these expenses going forward. Unemployment rates, very low. The new weekly unemployment claims, despite I saw in June, July, people saying the tech industry is going to blow up and there's going to be mass layoffs. I don't really see it, not yet. And people who are getting laid off are finding different jobs right away. Doesn't seem to be a problem right now. So where are we? Inflation adjusted WTI price is roughly $80 a barrel today, 88. And during the 2008 high, it got to about 190 US WTI. I know this is not 100% accurate because not all the oil is consumed in US dollar currency, but it doesn't change the fact that people's per capita income has gone up with inflation. So at the end of the day, this is for the most part accurate as to the percentage of income going to oil sort of correlation. So we still have a long ways to go here. A long, long ways to go, especially if crack spreads normalize. There is a leg up here possible. This is how commodities super cycles work. There's a consolidation for 10 years, then there's a breakout. Then there's a consolidation for 10, 15, 20 years, then there's a breakout. We've just had a consolidation for almost 15 years, 2008-ish onwards, 2009 onwards, and now we see a breakout in the commodities index. And that is going to be a supply-driven breakout supported by roaring demand and low savings accounts, I shouldn't say savings account, low inventories of oil, which is the oil's savings account, and people who have no tendency to stop spending if they have a bunch of savings sitting around. And oil is getting harder to find, oil is getting harder to explore, it's getting more expensive. There is likely to be a breakout anyway to spur that new investment. It's not happening at $80 oil, it's not happening at $90 oil. We may need 120 plus for that investment to take place. I won't talk about this. This is a trader positioning, very low contract open. And if we see this go up, these lows in trader positionings have been really good entry positions for oil. January 2019, March of 2020, December of 2020, and then this actually ended up being a really good entry point here as well on this low, that December of 2021. And when it goes up, it's sort of that exit point and things normalize and looks to be consolidating in this sort of area right here, possibly setting up for whatever's coming here. So I've got lots of supporters on these macro outlooks as we've done these. I've got lots of people saying, sell, that you're wrong, everything's going to crater, everything's going to collapse in a recession, everything's going to break up. Okay, let's look at what's actually happened. April 30th, year to date, energy sector was up 37%, the XLE. The tech sector, XLK, was down 19%, 37% positive versus 19% negative. Okay, July 30th, when I ran the previous macro outlook, Energy sector was up 44%. Tech was down 17%. So tech roughly flat. Energy was up about 8% from where it was in April. This is July. Now let's look at today. Energy sector is up 66%. Tech is down 25%. So tech has fallen further 8%. Energy has gone up about 22% from there and remains the only sector in the green with a almost 100% percentage difference to where the tech sector is. And the second sector is consumer staples, down 3.34%. So about a 70% beat outperformance on the second leading sector in the index, and continues to not only beat its peers, it continues to stay in the green, as in every time we do these, the energy sector index continues to go up. And we sit here today at $88 oil, staring at this risk reward scenario that has been presented today. And with that, I will end it there. So thank you everybody that joined in. Been a very, very long session here, but I like making these very detailed. There's plenty of sources for a few minutes or a couple hours macro outlook out there. I like to cover every single base for anyone that's interested in absolutely everything. Every question I get from this presentation will be added to the next presentation, January 30th, I believe it is. And yeah, I will definitely have a cold beer. I'm gonna go to the hot tub here, and we'll be having a beer or two, do a little barbecue. So yeah, certainly. And yeah, 376 slides, Albert. That's what I had, and I knew it was going to be long. And once again, I'll reiterate, for anyone that wants a 10 to 15 minute macro outlook, the Real Vision interview is now on the website. On the homepage at the bottom, there is a picture there of the Real Vision interview. That's the entire interview without the paywall. And then the my interview with Ben at ROIC channel is about an hour and a half, no data. It's more of no charts. It's more of a conversation type macro outlook discussion on that. So for anyone that's curious, I will leave that with you. And I guess we'll do some questions here. And I think I do want to end this in the next 10, 15 minutes. So we will get through these and leave everybody to it. I think the futures are open, so it should be interesting week here with the Fed meeting as well. Okay, so yeah, so I hope that answered the question about the recession and where I see things going. A recession can happen with oil demand still continue to go up, especially where we are today. What commodity stands to gain the most? I think it depends what you view. I'm very confident on oil. I think it's a much easier commodity to figure out, and it's more transparent. Natural gas can be switched out with oil. It can be switched out with diesel. There's the LNG. There's domestic consumption. There's too many factors that have question marks on them for me to be that comfortable in investing in 100% natural gas producers. If you have some dollar to invest in oil, would the Clearwater be the best choice? This is not investment advice, but I think you really have to think about this, because the Clearwater might have the best economic wells, but if you're paying for that upfront, it may not be the best investment. So I'm always looking at risk reward. What is trading cheaper than its peers for the same quality or for the same quantity, the same reserves, the same production, etc. And that's what I use. It's more of a peer-to-peer comparison. And when I look at pure play Clearwater companies, they are trading way too rich for me to be interested in buying them at this point in time. Keep in mind that the Clearwater technology can be applied elsewhere too. So if you're looking to front run Clearwater-esque exploration and success, there's other companies doing the multilateral drilling in other parts of Alberta and Saskatchewan. No, I don't think I'll ever buy any coal stocks. I know nothing about the industry, and yeah, I just don't know anything about it. And I'd rather focus on quality over quantity. I like my stocks. I know them. I know the management teams. I know the acreage. I can go and look at any well result anytime I want. It's just more of my comfort zone and more of my expertise, I guess. Yeah. And yes, the portfolio is fully public, whitetundra.ca at the homepage. Both portfolios are fully public there for anyone that would like to have a look. The White Tundra portfolio is a fully private fund and is not open to outside investment. So I just want to put that out there. I always get some messages and I do appreciate the support a lot. But I just don't have that sort of avenue at this time. And yes, this will be uploaded to the YouTube channel, yes, and the website as well. Yeah, you bet. Yeah, thank you. Appreciate everyone joining. Yeah. Yeah, like that's really what makes this trade so compelling, is that it would take a recession of a global massive variety to bring this thing down below that $80, $75 range. And then OPEC comes in and says, we will protect the economic supply demand going forward. We will be proactive at this. We will not let a 2008 scenario happen. And I sit here thinking, okay, so that means if there's any sort of catastrophic thing that happens, OPEC will be willing to cut 4, 5, 7, 10 million barrels per day. Demand never falls that much, but just to get the point across, that they don't really care how much they have to cut to keep the market in balance. And I think, so what really could happen then, where I see this as a bad scenario? That's the answer that's the question I try and answer in these macro outlooks. And I believe in data. I don't believe in narratives and needless conversation around things. If you have data to show me what is going to happen and why, and what the expected percentage chance of that is, my email is always open. My phone is always open right here. You can call me at my number. You can email me. You can Twitter DM me. And I will always be here because I love seeing other perspectives, other charts, other graphs. What are people focusing on, etc. What are your near-term thoughts on WCS? I think WCS is getting beat up here, not because it's a heavy oil. It's getting beat up because it's a sour grade. And the reason I say that is because I looked at the latest pricing on sweet versus sour, and it doesn't look all that bad. Or I looked at the pricing on light versus heavy, and it doesn't look all that bad. But the sweeter grades are definitely getting preferred right now. I think because of the fuel oil issue and a bunch of heavy oil that OPEC has started to export in September, October, when they were at their full production capacity. But I don't think this WCS differential is going to be a long-term issue. And I really wish that Trans Mountain pipeline would just get built. Like, it's delay after delay after delay. And that is going to alleviate a lot of problems. I think a couple of refineries coming online in the US should help as we go into this post-maintenance season. Will definitely help, especially heavy oil pipelines. And we just need more takeaway capacity. Like, we just need one pipeline to the coast. That's it. If you build the Trans Mountain and you never build another pipeline ever again, it's totally fine. But you need one access to the coast that's 750,000 barrels or more to give you that flexibility on where crudes get sent when something like that BP incident happens or something else blows up. You just need that extra avenue that is not there currently, and just leads to dislocations, because this is not an inventory issue. There is no inventory in Hardisty. There is no inventory in Edmonton based on what Vortexa is sending to me. So it's not a inventory problem. it's more of a dislocation in a certain part of the market that's just creating this pressure on WCS. I look forward to MEG results. I'm very happy with this company. The net asset values are going to be reflected. The 50% free cash flow going to shareholders is a big deal, I think, in a company that has such a strong shareholder base. If you can slap out those marginal traders and the people day trading stocks and the tourists, you can really drive that re-rate on the share price itself. And I'm not sure if that CNOOC block is still out there, but that would be a nice little Christmas gift if they go and buy that 11% block, or yeah, I think it's 11% block, and just retire it right away. It would cost them $600 million. It's not out of the question. It's definitely not out of the question to go and do that. Yeah, that would be pretty nice. Nice little bonus here as we go into the end of the year. Yeah, I don't really have an answer to this question, but I think Canadian companies are my preferred because I know the acreage, I know the production, I know the management teams. I'm getting the 35% bonus on the exchange rate and not as high of an inflation problem, lower decline rates, higher reserve lives. It's just all in all a better place to be because I don't like shale, I don't like high decline, I don't like beat up acreage that's all matured and declining. Not my kind of investments overall. If the dollar index continues to strengthen, the price of oil is going to come down. It just seems to be the way things are. But so far, it has had less of an impact than people would have guessed. And I think OPEC will, they will give some support to that. And also, the world is not going to be happy with the US if they continue to let the dollar strengthen. It's not a good look. It's not a good way to run the global economy. Like, America is not liable for anyone. They're not anybody's dad, but they really are. The world looks to America to provide stability in many, many situations, whether it's military, whether it's the economy, whether it's energy, in many things. And if America wants to maintain that going forward, they have to be supportive to the rest of the world. That's why things like this export ban and whatnot make no sense, because you would help the American consumer marginally and you would totally destroy South America. You would totally destroy Europe. Like, it doesn't make sense from an energy policy, from a political approach as to how you treat your allies going forward. Any thoughts on AECO pricing? I think I was worried about AECO pricing, and then I saw that news yesterday that 1.3 BCF of pipeline has gotten installed and will be online this week. So 1.3 BCF is more than enough to take up all the extra capacity right now, supply. So I'm not really all that concerned. And as long as AECO stays above $3-4, that's really all I run in my models. I don't need $7, $8, $10 AECO anyway. So I think AECO pricing should stabilize now with this expansion online, and just overall production should stop this huge growth trajectory. But we'll see. Canadian gas producers are not being very cooperative. They just want to drill, baby, drill, and I think it's not going to be a good look for them here if they continue to do this going forward. Yeah, I didn't talk about natural gas all that much. It's mostly a oil macro outlook, but I did talk about production and demand and some coal to gas switching numbers. But I don't really focus on AECO pricing all that much. Yeah, for sure. I've had many suggestions, Al, on the length of these presentations. I think if I wasn't recording them, I think I would break it down into part 1, part 2, part 3. But just the way that I run my life, I guess, it's easier for me to do it all in one day and just block off the day. And then people who can't attend can then go to the recordings. And I'm always here for questions anyway. So it's not like you have to attend this thing live to ask questions or anything else. So yeah, like just the way I run my life, like even when I'm doing research, I'll just sit down and do like a 6 to 10 hours research session and then have the rest of the week free, rather than split it up into few hours every day. So it's just me. And I think maybe what I'll do is when I post it, I can post it as like a supply, demand, inventories, 3 different videos or something. Might be easier, but the way that I think about this is oil is a $10 trillion industry. And if you are new to the sector and the volatility that the sector brings, I don't think you're doing yourself any favors by doing a 10-minute session or a 30-minute session and then going and buying oil stocks. Because what's going to happen is the first down day, you will sell everything and say you're never going to invest in oil again. And my whole mandate, if I have a mandate, is not to get people to invest in my stocks so I can pump and dump them. It's so people understand the sector in the sort of detail that we need to share the investment opportunity with others and just share the importance of oil with others. Because many people are completely ignorant, like to the point where they have no idea anything about oil or energy. It's pretty bizarre how you can look at things, everything is made with oil, everything consumes oil, everything uses energy, and you can afford to live without even thinking about it. That's all kudos to the oil and energy industry that has provided that sort of opportunity for people. I know nothing about leveraged ETFs on the equities, so never took one out. I have no interest in buying ETFs because I just think I can do a better job, just my opinion on the portfolio construction. Yeah. I've never even seen a leveraged ETF holding oil equities. Yeah, not exactly sure which ones you're referring to. Yeah, so the technology that Surge is doing is the multilateral horizontal drilling, and it is getting bigger and bigger, so I would watch it for sure. It only applies to certain fields, yes, but people are using them in areas I would have never guessed people would start using this. So right now, it's not really a concern. It's more of a wait and watch sort of thing. And if I see it getting big and big in certain parts, then it will have to get added in to the oil supply number. But right now, it's not enough. It's just not enough, because these wells are like 80 barrel, 100 barrel per day wells, and you'd need 1,000 of them to really make any sort of difference, if that, because they all decline as well. So you would need a field that can have multilateral drilling with a big scope, like lots of acres, and then water floodable. It's very rare to find things like that. If I'm only able to buy MEG on US stock exchange, I don't know the answer to this. Like, I've never traded any OTC stocks or anything like that. I know they can be illiquid, so that's about the only thing maybe that makes it any different than buying it on the TSX. Okay, HEU, I will check that out. I've never heard of that. So yeah, there's no ticker for ACO. It's just an ACO gas. I'm sure you can trade it, but I'm not sure. I'd have to get back to you on that. I don't think it's tradable in that way. Yeah, I have no opinion on the 9-point energy funds. I just look at what they hold and what sort of percentage they make and use that if that information is relevant to my holdings. But Eric's got his own way of running the show. He's done a lot for Canadian oil, as much as the people like to argue about fee structures and performance and whatnot. I think you got to look at things going forward, not looking backwards. And you know what? He's got his mandate, and he's done a lot for bringing people into Canadian oil. So getting the word across, and that's really what's important at the end of the day. After that, you can argue all you want, but there's plenty of people charging 5, 6, 7% overall MERs who have given you a minus 40% this year. So I think a little bit of credit where credit is due. You can't be putting people into get the spotlight on people and ignore others who are way worse performance and charging the same or even a little bit lower fees. Yeah, I think oilfield services are going to make a ton of money. I just don't have the expertise to predict how much money they're going to make, what the margins are going to be, and where they end up in terms of pricing power going forward. So if I'm seeing E&Ps trading at 30% free cash flow yields, I don't even bother dipping my toe into other things. I'd rather focus more on making sure I pick the right E&Ps than to get myself caught up in all sorts of sectors and subsectors. The labor force is tight in general in the oil field. There's just not enough people out there willing to do these sorts of jobs. So I'm not sure when that eases up. Probably not in the near term anyways. So yeah, and offshore drilling takes a lot of people. Yeah, I'm not sure I'd be concerned about it pulling people from onshore, but offshore does end up taking up a lot of people to do each drill and exploration. Yeah, it's more a supply chain problem. The US has just way more shale production, which means they need way more rigs, they need way more frac fleets, they need way more sand, way more labor, way more steel, everything else. And it just becomes a supply-demand narrative. And Canadian producers have a bit more equipment sitting out there, and they just don't seem to be suffering as much inflation, especially on the conventional side, compared to US shale, which some of the numbers I hear are sort of eye-popping. I'm thinking, they spend that much money on a Haynesville well or a Delaware Basin well, and like that thing is never going to pay out, even if it makes 800 BOEs per day or 1,000 BOEs per day on its IP 30. Like, what exactly is going on? Are they just drilling wells for the sake of drilling wells and keeping production flat? And if so, great, because that means they're using up tier 1 acreage or tier 2 acreage and not making any money off it that can be used to go and drill, baby drill onto other things. Fantastic. Keep using away the acreage, the minimal acreage that's left. Yeah. So hopefully that answers the question. And yeah, we'll see. China's building these not concentration camps. They're like COVID quarantine camps. And people are saying that means they're going to do zero COVID forever. I think opposite. I think they're waiting to open the entire economy, and they want these like hospitals and quarantine camps built because they know the cases are going to rise, and they're just going to grab people and slam them in there for 14 days and let the rest of the economy continue instead of locking the entire cities down. And it makes sense to me. Why would I go back into zero COVID now after everything that's happened? It just doesn't make sense. It's more so we don't want people dying on the streets and us having hospitals overflowing. We want to prepare for this, and then we'll open up. We know the cases are going to rise. We'll throw people in there, and that way the rest of the economy can continue running. That seems to make more sense than building all these massive quarantine camps just for a zero COVID policy, which is not sustainable anyway. So yeah, so I think demand at least 2 million barrels per day. And then on top of that, you have demand in other countries as the Chinese tourists return. So kind of a double whammy. And I don't understand how people can say China will do zero COVID forever. Like it just doesn't make sense, because there's parts of the country, various huge parts of the country that are completely open and have international flights traveling. It doesn't correlate to a strong zero COVID like mindset. Okay. Yeah, that's an interesting question. I think each company is sort of its own thing. Like Cenovus is a oil sands producer with a gas upside and refining upside. Suncor has a lot of good production that's refinery, diesel heavy. So they're getting a lot of benefit from the high diesel spread. Suncor also, if they can sell those gas stations for $5, $6, $7 billion, they would pretty much be debt free at that point, like really, with the money they're making. So it opens it up to a large possibility of like a massive, substantial issuer buyback or other ways to re-rate this company. They don't seem to want special dividends, but they could go out and buy a huge chunk of the float all at once. And the new CEO will want to come in and put his imprint, his or her imprint on the company. And also they have that proxy battle going on. I forget the name of that company, but Elliott, to make some changes here. So that's that. And CNQ is just CNQ. There's nothing special about it. It's going to make money all day long and pay dividends all day long and buy back shares all day long. There's make solid acquisitions all the time. That's literally what you're getting. There's nothing that's a question mark there. So it's all going to depend on your own subjective thoughts, what you're looking to hit. CNQ also makes like almost 2 BCF a day of gas, I believe. So if you believe in AECO price going up, these are not bad companies to be in. Very well integrated. CNQ doesn't have refineries, so then it would be Cenovus. Suncor would be your diesel play. Yeah. Yeah, 1.3 BCF per day of pipeline capacity on the AECO system has come online this week, I think, or will come on this week. I can post the exact number. I never looked into it. I was just busy making this presentation, but possibly I check it out more on Twitter. I think it's the NGTL system, and there's a few comments posted on Twitter on that. No, I have no interest in working for any government body or any other organization. I love my freedom. I love my freedom to work my own hours, to do my own thing. And you know, the best thing about what I do is that if people want to listen, they can listen. If people don't want to listen, they can choose not to listen. I really don't care. And that's why I think I'm not a good employee or a good consultant for that matter. Where people are paying me specifically to do a certain thing. That's just the way I operate, and I love every second of it. So appreciate your support, but no, I got no interest in working for any government. Yeah. Which oil investors do you follow? Yeah, Josh, Eric. Honestly, like not that much. I almost like running my own numbers, my own analysis, and then comparing with other people, discussing with other people. Pierre Andrand is really good. Yes, he's had a lot of success. Gore Rosen is really good. If you read their stuff, and then Cornerstone Analytics, obviously, that is somebody who caught on to the global demand inventory missing problem very early on. And that's what I would say for more of the macro side. But I don't specifically look at anybody's holdings and compare. I more so use a lot of information from other people on oil macro and their information on supply, demand, inventories, recession, et cetera, et cetera. So yeah, for sure. Yeah, I've never even spoken to Eric. I mostly discuss a lot of things with just retail investors, to be honest with you. People who call me and I've built a relationship with over the last 2 years, year or 2 years, and we just talk stocks, talk macro. I like to talk to other reservoir engineers, production engineers, because they see things in the industry that I no longer have access to directly, as to any new technologies, any new drills, any other new interesting innovations coming about, and whatnot. Yeah, Rosen, yeah, GOROZEN. Yeah, they could get this quarterly newsletter out. That's really good and updates you on what's going on. And then I just use all my data sources. I love data. I love looking at stuff and charts and graphs and yeah, different insights, interpretations, etc. No, I never went to Toronto to see Eric. No, I'm not sure. Yeah, I'm not sure if that's an inside joke or what, but yeah. No other sector. I have no real interest in any other sector. I have some holdings in other value stocks that I think are interesting because they provide some game-changing technology. But I think I'm just going to be drilling wells with my money. I'm going to go into the private side, and as we speak, and find my own land and drill some wells and produce them into the future. And when the commodity cycle stops, I'll just sell everything and move on. So until the next cycle, I have no interest in being on the lower end of the cycle. But I think that's a long ways away. It'll keep me happy and profitable for a while here. I hope, anyways. So I think I'll end it there. It's been a long day, so I'm gonna go and post the recording here on the YouTube. And thank you again for everyone that joins for these sessions. I have no plans right now for any sessions in November. When something does come up, I will add it to the website, probably third week of November-ish. Take a couple weeks off here. And the interviews are also online, as I mentioned. Price targets will be updated after Q3 here as things come out. Still going to take my time with that. And then I got 2 Seeking Alpha articles coming out, Meg Energy and Prairie Provident, as I've mentioned on the Twitter post. So yeah, just take her easy a bit, enjoy San Diego, and yeah, thanks again for everyone that joins, and we will catch you at the next one. Cheers. Oh, sorry.